Down 45% so far this year. Will they fall even more off the back of this news? Of course, we also mind the steel makers as President Trump signs that directive doubling steel and aluminium tariffs to 50%. That came in at 5:01 a.m. London time, so we mind the likes of ThyssenKrupp, ArcelorMittal and Salzgitter as well, Anna.
Yeah, absolutely. We had a heads up on that news flow over the weekend, didn't we? And the steel makers, they moved on Monday. Is that all done? Do we have more to price in? Perhaps we do in Wednesday's session. We'll look to that sector to see if we get any movement there. But apart from that, then, our focus goes to the French market for any big moves in Rémy Cointreau, in Airbus, as Lizzie, you were just nicely setting up for us. The European markets are open, not doing a huge amount just yet. The FTSE 100 is flat. Stock 600 managing to eke out gains of 0.2%. So, if anything, a slight bias to the upside. And this fits with what Paul Dobson was talking about earlier on. So far this week, it does feel as if these markets have had some kind of bias to the upside, was his view, given the way we traded around the various news impulses that have been hitting this market. But for the moment then, Lizzie, we are modestly higher across European stocks. So even the FTSE 100 actually up by 0.2%. The futures picture for London was a bit more muted. We have the CAC then up by 0.4%. The DAX up by 0.6%. So in the absence of a huge amount of negative news flow, perhaps we trade higher. Seems to be the momentum behind markets this morning. Lizzie, what do you see beneath the hood?
Well, that's the geographical picture, green across the screen, and it's pretty much the same, Anna, when it comes to the sectors. So you've got 19 out of 20 in positive territory as things stand. Basic resources leading the gains up 0.9%. Energy at the bottom of the basket down 0.2%. And if we just dive into some of those individual names that we were flagging, so Rémy Cointreau, as we expected, down 0.4% after it withdrew its guidance on the tariff outlook. Airbus shares up 1.7% on this Bloomberg scoop that China's considering ordering hundreds of Airbus jets in this major deal. And we were looking at the steel makers as well. Look, yes, the doubled steel tariffs have come in at 50% today, signed in by Donald Trump, but actually the steel makers appear to have already priced that news in, because all of them that I'd flagged are in the green. So ThyssenKrupp, ArcelorMittal and Salzgitter actually up about 1% this morning.
And it's interesting, basic resources then, the best performing sector, Lizzie, but yesterday we were talking about that on the back foot as a result of that Chinese data. So it's sort of a day down and a day up for the basic resources sector. So not a huge amount of standout news flow, I suppose, at the corporate level this morning, but we have, of course, got Rémy to focus on and Airbus.
Indeed. Well, should we get some analysis of what's really happening in these markets? And Doe, portfolio manager over at Julius Baer, joins us around the desk. Good to have you, Anne. I mean, we've been debating it all morning and all week, really. How much more upside is there for European equities amid all of this uncertainty?
Good morning. Thank you for having me. Look, in terms of the European trade, we are still running an overweight to Europe, albeit we are being a lot more selective. So since February and beginning of last year as well, we've had a thematic in Swiss stocks, and that's our element of sort of protection, defensiveness within the portfolio. On top of that, we have high-quality companies, whether in luxury autos, whether in semiconductors. So we like to hold over the long term. So if we think about the European trade so far, there's no longer that steep discount. You know, the Europe at 15, 16 times, there's no longer that steep discount versus the rest of the world. So I think the easy money has been made. It's time to be a lot more selective at this point.
I mean, your view isn't as simple as sell America, is it? So, you know, when you're looking at the US, what's actually worth buying or holding on to in US assets?
There's still room for US assets that are truly unique. If I take a step back and think about the earnings season that's just been, the Magnificent Seven or the large cap tech in the US is still growing earnings at high 30% year on year, whereas the rest of the market is in high single digit, and you're seeing much slower growth elsewhere. So there's still room in portfolios for truly unique US asset, albeit it belongs to a mix of broad regional diversification within the portfolio.
What makes you say then that the easy money has been made in Europe and that it's time to be a lot more selective? What makes you so convinced that we don't have more of this to come? I mean, is it in the hands of Europe or is it in the hands of the White House?
That's exactly the conundrum that we're in, because the European trade, it's a bit of both, right? It's about the push factor away from the US, but also about how much Europe can take matters into their own hands. Then coming back to valuation, we have closed a lot of the valuation gap versus the rest of the world. Europe is still cheap, but that steep discount is no longer there. In terms of the spending that we're talking about, it'll take time for that to come in, so that more into the second bucket of how much can Europe take matters into their own hands. So I think there's still a bit of time to go until we can see true momentum to materialize in Europe when it comes to the fundamental economic picture.
And how are weaker rates in Europe factoring into, or an expectation of cuts in rates in Europe factoring into your thinking then, Anne? Because we have, I was looking at the longer term inflation expectations. I think it's 10-year break-evens in the Eurozone versus the US. And in Europe, we've seen a real retreat in those expectations, and inflation now down below 2%. Yeah. Job done. But over in the United States, that's not the case. How much of that is the rate cut environment helping Europe, do you think?
There is, in our view, there's perhaps a clearer picture, a clearer pathway for rate cuts. So we'll see tomorrow what the ECB delivers, but at the same time, we expect tomorrow 25 basis points cut. But for 2025, we're actually more dovish than the market. We expect 75 basis point cuts versus the market. It's around 50 basis points. Exactly because of that reason, there's more of a disinflationary momentum. But at the same time, that comes with weaker growth. So you have the good news coming from lack of pressure from price levels rising. But at the same time, that comes from more challenges to growth, more risk to growth in Europe. So that rate cut picture, I think, is clearer in Europe versus the US at this point.
Well, yeah, exactly. So you're pricing more cuts than the market, but that's because it's to compensate for the growth hit. Interesting, though, the timeline that you set out, the tariff hit to earnings is kind of long, is into the immediate thing, but then you've got the fiscal boost in the longer term. Just turning back to the trade story, though, you had all this relief from the US-China tariff deal, but the Truth Social posts come thick and fast, and the complaints from both Washington and Beijing about the other side post the Geneva deal. Are investors too quick to price in the optimism before we see some real lasting trade clarity?
On the trade front, on the tariff front, I sense that's a degree of tariff fatigue. But at the same time, what we're seeing is markets are reacting less intensely. Every round of tariffs that come around, every round of retaliation that comes around, ever since the pause in the Liberation Day tariffs, I think markets have been reacting less aggressively because we see a bit of a playbook, we see a bit of a Russian function coming out of Trump and the U.S. administration. So there's still nervousness for sure. I think all the investor surveys out there still shows a level of nervousness. At the same time, we see less of a market reaction negatively when it comes to news flow.
So they're fatigued, by the, every little headline, but how much would it change your equity outlook if you had a US-China deal or a US-EU deal?
Look, I think we're not calling for a deal at this point. We think there's still a lot of back and forth to be seen. But at the same time, taking a step back, that policy picture, I think the closer we are to the midterms, the closer that we are to re-election, that policy mix and the tones coming out of the White House could sound a little bit more positive. We are seeing a little bit more tax cuts now. We're seeing talks of deregulation. So a lot of the bad news or the less pro-market angle of the administration has been front-loaded so far year to date.
Yes.
But some of the positive sides are coming out as well.
Okay, so you think that closeness to the midterms might have an impact on the extent to which the taco trade is in play, or the reaction function of the White House to what we see in markets around trade. What about the closer we get to the midterms, what does that mean for the fiscal outlook in the United States? We've still got the bill, big beautiful bill, trying to make its way through Washington. And are we going to see more market reaction to that, do you think, now than trade headlines?
We definitely have seen more of a focus on the fiscal angle. I think there are periods of time where it seems like the market can only focus its attention on one thing at a time. Is the tariffs or is the fiscal angle? But I do think the fiscal impetus that the Trump administration is putting out has more impact on the bond market. So the bond market has seen more weakness in the U.S. U.S. Treasuries on the 10-year and 30-year selling off on the back of that fiscal deficit growing. That said, there is a limit at which point where that higher rates in the U.S. can impact the equity market as well, because you have that discount rate factor coming in. But I don't think we're there yet.
Well, yeah, I mean, Musk calling the big beautiful bill a disgusting pork-filled abomination, and we were talking about the potential impact on the dollar with our previous guest Jane Foley. Surely that would have an impact through the currency avenue on equities.
We've seen a sell-off in the dollar year to date, quite an aggressive sell-off. That said, periods of dollar weakness can go on for a few years. There are valid structural reasons to be concerned, not least around fiscal deficit, not least around what the U.S. administration is talking about in terms of potential capital controls, etc. But that said, I think a lot still comes down to the outperformance of U.S. assets, the uniqueness of U.S. assets that I just talked about, whether that can continue. And I think as long as there's still room in portfolios for allocation to those U.S. assets that merit an allocation, we've had a period of rebalancing, and we'll see if there's more to go.
Okay, thank you very much. Thanks for your perspective. Anne Doe, Portfolio Manager at Julius Baer. Let's have a quick look at the core six then, in Guy's absence. Let's keep track of some of these large heavyweight stocks around Europe. A little bit of a downside move in Nestle, not much at all. Ferrari as well. But elsewhere, we see some upside coming through. Novo Nordisk is higher. So we'll keep an eye on that. With the addition, I think we just got an Airbus price just flashed up, so that's a bonus. Let's get to Joe Easton, who has some individual stocks on the move for us. Joe.
Well, Airbus investors getting a bit of a bonus as well today. Nice segue there. So Airbus, we're up around 3% on that one today. The Bloomberg deals team and the transport team writing potentially China going to be buying hundreds of jets from Airbus, potentially even 500 planes, both potentially wide body and also the shorter haul jets as well, maybe around 300 in terms of the likely number, but a big boost. Airbus, one of the best performers today, so we're up around 3% on that one this morning. Then a stock going the other way on the same exchanges, Remy Cointreau. Got a big unch on the screen, which doesn't do me many favours, but that stock was down around 3 to 4%, so I think it has gone into a trading halt, hence why we've not got a price on that one. But believe me, that stock is down around 3 or 4% at the halt because of the reduced dividend and the guidance withdrawal. Meanwhile, chips doing a bit better. We've got Infineon and ST Micro, both those are actually the best performers in Europe today because the US company onsemi, a big rival in the auto chip space, had a conference yesterday and they were talking about an improvement in the market. That is seen as a direct read-through into both Infineon and ST Micro, according to analysts today. So these stocks, as I say, actually leading the gains on the stock 600 today, given that boost for the sector. Obviously, they have been a bit of an underperforming space over the past couple of years, getting a bit of an uplift today. Then moving over to pharma, a couple in that space. Camurus stock doesn't really come onto the radar too much, but it has got a deal with Eli Lilly. This is on some of their drugs, not quite related to the main obesity sector, but in a similar area in terms of treatment. I think it's related to kind of a diabetes kind of area, and they have got a tie-up gaining around $870 million in that deal. So that stock on our radars this morning. Camurus gaining 28%. It's a big move for that one today. And then finally, staying in pharma, Redcare Pharmacy, this one in Germany, one of the worst performers today. It's downgraded at Kepler Cheuvreux. This is all related to a new e-subscription or prescription measure that's coming in Germany, and there's concern around a lack of adoption for this. So it is going to be quite a sweeping change in the German medical market, and uncertainty around that weighing on Redcare today, and one of the worst performers, down 9% on the German market this morning.
All right, Joe Easton from our equities team, we thank you. I just want to clear up the mystery around what happened to Remy just then, because actually it didn't halt trading. It's been flipping between positive and negative. It's back up to by 0.3%. So a bumpy ride for Remy, having withdrawn its outlook.
Yeah, absolutely, quite volatile. And I suppose going into this, we wondered how much of this would have been priced in by markets, and perhaps that's exactly what markets are wrestling with right now. Duncan Fox over at Bloomberg Intelligence suggesting that the removal of the guidance was entirely in line with what the market had already expected to see here, and so perhaps as that dawns at 13 minutes past 8, that's why you see that volatility coming through in the stock.
Indeed, and Joe had said it's already down 45% this year, so, you know, much of it already baked in there. But coming up on the programme, Bloomberg has learned that China may order hundreds of Airbus aircraft in a high-profile deal that could boost the European firm. We'll bring you more on our scoop next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Welcome back to the opening trade. 17 minutes into a European session that looks modestly positive. The FTSE 100 now pretty flat, but elsewhere we see some better gains coming through. The Xetra DAX up by 0.6%, for example. In Paris, we're benefiting from some moves higher in Airbus. That stock is up by 2.5% this morning. Bloomberg has learned that China is considering placing an order for hundreds of Airbus aircraft as soon as next month. The deal may align with a visit by the European leaders to Beijing in July. Benedict Cowell is here with the latest on this story. So what do we know about the extent of Chinese appetite for Airbus aircraft then? Good morning, Benny.
Good morning from Berlin. So yeah, there's generally big appetite from China for aircraft, both Boeing and Airbus. But the problem is that right now, China is not buying Boeing aircraft because of the political spat that's going on between Washington and Beijing. So Airbus is really the player in town. And what we're hearing, this is according to people that we spoke with, is that there could be a big deal unfolding next week. The way China buys its aircraft is a little different to most other countries where, you know, a single airline will negotiate with a plane maker. China does this centrally. They have sort of a central umbrella organization that then distributes the aircraft among its main airlines. So that's why you sometimes get these huge numbers out of China. So we are hearing somewhere between 250 and maybe even as high as 500 aircraft. Obviously not all in one fell swoop in terms of deliveries. That would unfold over years, but it would be a huge bonus for Airbus. It would really help them cement their market share in China, which is already close to 50%, and it would take them above that. So really an important win for Airbus if it does unfold.
So how does a deal like this reshape the battle between Airbus and Boeing then?
Well, we saw a couple of weeks ago when Donald Trump went to the Middle East that that region bought a lot of Boeing aircraft. And that gives you a sense that aircraft purchases, these large orders, particularly when there's a government involved, tend to turn into a bit of a diplomatic tool. So Trump managed to bring in a big business for Boeing. And now we think that the same might happen when French President Emmanuel Macron and the German Chancellor Friedrich Merz go to Beijing next month. So there's always this sort of political component behind it. Both sides, the Europeans, but also the Americans, trying to strengthen their national champions. And that really is sort of what the duopoly is about. You still have only those two plane makers to choose from. China is trying to build its own aviation industry, its own rival to the 737 Boeing plane and the A320 Airbus. But so far, that remains a local and, at best, regional phenomenon. But it's something that they have to watch, Airbus and Boeing, if they want to maintain a foothold in this crucial market that is China.
And you've nodded to this already, Benny, but there's diplomacy always when it comes to aviation orders. And is this a way for President Xi to send a message to President Trump? President Trump wants a meeting. Xi seeming a little more elusive and not quite so keen to have that phone call. And here we've got a trade deal in the works surrounding European aircraft.
Yes, you're absolutely right, Anna. I mean, that sends a very clear signal that right now China remains open to business, but just not to the US. And we had that the message from Trump this morning saying that Xi remains a very difficult customer to work with. He wants a deal, but he's proving elusive. So, and we also know that China has essentially stopped taking deliveries of Boeing aircraft. So while they have planes on order right now, that entire business for Boeing is on ice. And this is a key market. Yes, there are markets like India. Yes, there is global demand for aircraft, but you can't, if you're Boeing, you can't just sort of ignore the Chinese market. So hopefully over time, they will get back into that market. The question is, will Airbus, by the time that Boeing comes back, will they have strengthened their position to a point where it's going to be very difficult for Boeing to really see eye to eye with their key rival?
Penny, thank you very much. Benedict Camel with the latest on that China, potential for a China order then for Airbus aircraft in the face of troubles at Boeing and trade tensions then, Lizzie, between the United States and China.
Well, speaking of Airbus and those who make military hardware, Bloomberg has learned that UK Prime Minister Keir Starmer is considering a Ministry of Defence request to back NATO's proposed new military spending target of 3.5% of national output by 2032. Now, if this is accepted, it'd be a major test of the UK's already stretched public finances. And digging into this has been our very own Caroline Hepker. She's been looking at the costs of rearming the UK. So, Caroline, it's a really great feature you've got on this today. Can the UK actually commit to more defence spending?
Well, that's the thing. At the moment, we're spending 2.3% of all economic output on military spending. The government has said that it will increase that by 2027 to 2.5%. The 3% goal for the Prime Minister is only only an ambition at the moment to reach that by 2034. Now there's this NATO meeting in only a few weeks' time. The pressure is there. We know that the threats have increased, but the issue is whether we are going to be able to pay for that increased spending. So I spent the last month talking to UK defence prime, some of the big contractors in the UK. They are ready, they are poised, but they are effectively paused until they actually get contracts. As part of this sort of deep dive into the defence industry in the UK, Bloomberg Economics also did some analysis about how much it would cost actually to ramp up on spending. If we went to the full 5%, which is an enormous, a colossal target, is what Dan Hansen called it, that would cost £350 billion per year. But as I spoke to a number of former military chiefs, for example, Alan West, who ran the Royal Navy for a long time and then became a minister, he was saying that at the moment the defence cupboard is bare. We have to try to build up after decades of cuts.
Okay, and Caroline, as you mentioned, you've been speaking to a number of voices from the industry, including the chairman of Airbus Defence and Space UK. Let's take a listen.
We're well poised to deliver what we're already working on, both on the defence and indeed the commercial side, and we're ready and set to invest more if that's required with future orders or commitments from the UK. This is the year where we and the UK defence industry will hope to see those words turning into action.
So the message there, ready to invest. So what does the business community want to see here?
They want firm commitments. They want contracts. That takes a long time to do. We haven't even gotten into the MOD procurement, so the process of the Ministry of Defence actually procuring weapons, which has been highly criticised, talked about it being bureaucratic. MPs have called the system broken. So the firms that we went to visit, for example, BAE Systems up in the north of England, went to see one of their munitions factories. They are ramping up, but that's in response to past contracts. Now the industry, from top to bottom, including the SMEs that I spoke to, they want firmer commitments from the UK government. So it's basically about whether there's going to be pressure on the Prime Minister to deliver what welfare cuts, what additional borrowing the government might have to do in order to respond. I was speaking, for example, to Richard Dannett, again, former head of the British Army. He told me only this morning that given the strategic defence review that came out this week and the Prime Minister talking about these big ambitions to rearm, Mark Rutte of NATO is surely going to want to see money committed when actually those ministers meet.
Caroline, thank you very much. Bloomberg's Caroline Hepker with that deep dive, along with the rest of Bloomberg News on the UK defence sector. Let's continue focusing on global geopolitics, shall we, but from a very different angle. Lizzie, we've spent a lot of this morning wondering whether we're going to get any confirmation from the Chinese about whether it is likely that Presidents Xi and Trump will actually speak to each other. Well, some interesting commentary we've just had from the Foreign Ministry in China suggests that maybe some further diplomatic work will be needed behind the scenes to get there, because apparently the Chinese are unhappy by some comments that the Secretary of State Marco Rubio has been making. He praised pro-democracy protesters who 36 years ago, of course, stood up to Beijing in the Tiananmen Square crackdown, and that has not gone down well with China, and as a result, it seems we could be a little further away from that conversation taking place.
Yeah, this just continues Washington's criticism of China's human rights record, but a difficult moment, obviously, for the US-China trade relationship. Yes, we've had the Geneva truce, but it's been eroded day by day by both sides. So really inflammatory comments from Marco Rubio, and the response from China being that this is just wrong. These comments from Marco Rubio, that China is complaining about it, essentially.
Yeah, absolutely. Marco Rubio went so far as to say that the Chinese Communist Party actively tries to censor the facts, but the world will never forget. So clearly that messaging will not land well in China, and as we've seen, there have been some objections to that. So there's the geopolitics. We'll be back in a moment with some of the macro, some of the big names dealing with these macro headwinds.
Yeah, indeed. We've been talking about the push-pull between the US and Europe. It's a theme that Kriti Gupta has been all across at Super Return in Berlin. Next, she's going to be speaking to a guest from BC Partners, so do stay with us for that interview out of Berlin. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
This is the opening trade. We're 30 minutes into today's session, and it's a positive picture for European equities. Half an hour into the open, pretty flat as we look ahead to the Wall Street picture. But let's go from public to private markets now. We can go back to Kriti Gupta, who's at the Super Return Conference in Berlin. Kriti.
Lizzie, thank you so much. As you said, we are here in Berlin for the Super Return Conference. My next guest has lots of thoughts on the key themes here, which of course are going to be the kind of longevity of the private markets, where we are in the volatility story, and of course, where that bullishness around Europe takes us. So let me bring him in here now. Nikos Sotopoulos over at BC Partners joining me here today. Thank you so much for your time. Lovely to see you.
Pleasure. Good morning.
Let's start with the volatility here. Just this morning, plenty of tariff headlines crossing the wire. How do you navigate the private markets, a famously illiquid, long-duration asset, when you're dealing with that kind of volatility?
Well, it's true that volatility has continued to be there since the tariffs showed up. I was talking to one of your colleagues a few months ago, and I was hoping that actually this volatility will subside and we will see some normality coming back to the market. It doesn't seem to be the case. That has really impacted private markets because it had meant that deal making has been slow. It has slowed down. It's natural. People are pausing. They're questioning what impact this will have in deals, and it's more natural. I do think that, however, that means that people may pivot into industries and investing into industries that have potentially less impact from tariffs, like services. We have been investing in services for a very long time. More than 70% of our portfolio has been in services, has been not impacted by tariffs. So I think you might see some shift in where people will end up investing, at least in the short term, until there's more clarity on tariffs.
Let's take that piece by piece. We'll start with the volatility, then we'll get to the kind of the portfolio construction as well. This was supposed to be the year for capital markets to open up. The IPOs are getting delayed further and further. You talk about deal making hitting a snag, but it's already been hitting a snag. That's been the case for a couple of years now. How much pressure is building up from LPs?
A lot. Liquidity has been probably the biggest issue in the last, I would say, year or two in our industry. And you've heard many times that DPI is the new IRR and how much liquidity is required and distributions back to our investors, which is absolutely the case. So I think that's the biggest issue that we're facing as an industry today. We've been fortunate at BC to return more than 14 billion euros of monetizations the last 18 months, mainly by focusing on the mid-market and high-quality companies. But the reality is our peer group needs to come up with creative solutions on liquidity. Capital markets was one of them, especially for the larger end of companies and of private equity firms. It has not been the case. And frankly, our industry has been hit, and generally the world has been hit from shocks in the last 5 years. If you think about COVID, and then the Ukraine war, and then inflation and interest rates, it had started to recover, and confidence has started to build up until tariffs hit. And therefore, you've seen capital markets effectively being shut at the moment. We were able to IPO a very high-quality business called Springer Nature, actually headquartered here in Berlin in October last year. But it was more the exception than the rule. I think as long as this uncertainty is out there, you will probably see the capital markets not being open, I suspect, until the end of the year, most likely. However, we see a lot of block trades being done, which means, especially in European companies, which means that investors still are keen to invest in European companies in public markets. But I think the actual IPO market feels that it has to be, ideally, a post-summer event.
So what does it do to valuations then? If we're talking about a deal glut, essentially, you're talking about pressure from your LPs, does that demand higher valuations at the end of the day?
Not really. I think valuations have been also hit because the truth is, even though there is supply and demand out there, the cautiousness that we were talking before and the tariff concerns, the growth concerns more importantly, let's not forget, tariffs have impacted inflation, have higher inflation and lower growth, especially in the US, which means that by having lower growth in a company, that means you can price it at a lower multiple.
Yeah.
So valuations will end up being hit ultimately. High quality assets will still get premium valuations, but I do think there's a bifurcation in the market in terms of high quality asset getting the top valuation, and so the medium quality asset where people will be very price sensitive. The IPO markets still remain highly selective, very price sensitive, so I do think it has had an impact on valuations.
Highly volatile, price sensitive, sounds something like Europeans are familiar with this concept. It's also creating this move, of course, when it comes to fund flows from American investors, international investors broadly, into Europe. Talk to us about the bull case there. How much of that is a reaction function to the United States, to kind of this scary aspect of the instability emanating out of Washington, as opposed to a structural change in Europe?
Well, you're talking to somebody who has been investing as a firm. We've been 40 years investors in Europe. So we've been in Europe forever. And we believe in Europe because it has high-quality companies and it has a sort of economy which has fundamentals. And therefore, we do think that we can find European or global champions in Europe to invest. There is a bit of a momentum at the moment in Europe, there's no doubt. You probably have heard it from your other guests. I'm sure it's going to be a key theme in this conference this year. And there is a theme in Europe, and rightly so. I mean, as I said, the whole tariff events have impacted mostly, I would say, the growth in the US, and people are seeing Europe as a safe haven at the moment. I do think that Europe, though, has fundamentals, and I don't think it's a short-term exercise that we're facing. I think for some people have noticed potentially Europe more now than they did in the past because US was growing indeed faster. But if you look at the fundamentals, the European economy, Europe and the UK are a $23 trillion economy.
Yeah.
US is around $27 trillion. It's not much smaller than the US. So from a size of market, it's similar size. At the same time, it's trading at the same industries at a discount to the US. And this is purely because companies who have still similar industry, high quality, global operations, are just happen to be headquartered in Europe. We had identified this many, many years ago, that disconnect between valuations between European and US companies was not really justified. I think people are seeing it now. I think there is a bit of a tailwind that Europe is having at the moment. I hope it's not temporary, because Europe has fundamentally high-quality companies. but it's a complex system to navigate. And people need to know how to navigate European economies. It's very fragmented, different currencies, different cultures, different tax and regulatory systems. So you need to have people who have local expertise to be able to navigate that system. I think there's a lot of high-quality businesses in Europe that deserve people to notice them and deserve the investment that finally they're seeing now.
I think that opens a nice kind of segue to the financial services point you were making earlier as well. Time and time again, we're talking to these private market players in London and across Europe as well, and even in the States, we're saying you go to defense, you go to AI, you go to infrastructure, the places where the sovereign players are investing the most. You're taking a different approach. Why?
We're taking an approach that ultimately we look at what are fundamentals, characteristics of companies that we as investors and probably our investors are looking for. And if you look at the fundamentals, you need downside protected businesses who have high margins, high cash generation, and the growth momentum. They don't necessarily only need to be in AI. They don't need to be only in tech. These are of course very attractive industries. AI is impacting almost any industry that we look at today. But there are industries out there which are more insulated from tariffs.
Yeah.
Telecoms being one, utilities, services, as I was mentioning before, which fundamentally nothing has really changed in these industries, and they have all these characteristics of companies that we like. So we're taking an approach of investing in fundamentals, not momentum investing, that frankly was the case for some of the tech investments in the last few years, but flying companies from fundamentals.
You make a key point there that financial services are insulated from the traditional hits on things like goods, tariffs, et cetera, and that kind of volatility. Some would argue that that's about to change, and that if you do see some sort of escalation between the United States and the EU specifically, but also in other jurisdictions, services and that services deficit between the U.S. and the EU could be targeted. Is that something that's factoring into your thinking?
We do like services. More than 3/4 of our portfolio is in services. And
is it tariff exposed?
No, these services are not tariff exposed, and that's the beauty of investing in services, or mostly services sectors. They tend to be more local in many cases. They don't have the exposure. You don't produce goods. You don't export goods. You don't rely on other economies necessarily in order to impose certain tariffs. So we have been big fans of the services sector, being healthcare services, being telecom services, being in any other business services a lot, because they're much more insulated. You're much more in control of your own destiny. And we've seen now that this strategy actually is being rewarded because, again, the external shocks that I was mentioning before are not really impacting that sector.
And it's not under threat from Donald Trump or even regulators here in Europe?
Regulators, depending on the sector, there is always a threat with regulators. And you have to identify, again, sectors that are not as regulated. So that is not something that people can be insulated from. But I think from tariffs and Donald Trump, I would like to believe that these services sectors are much more insulated, yes.
Well, you'll be our first call if that ever crosses his desk in the Oval Office. Nikos, a pleasure to see you here. Thank you so much for joining me. Anna, that was Nikos Stathopoulos, a partner over at BC Partners, really talking about how you marry the macro with the private markets, especially when it comes to that tariff threat, and certainly in the services sector.
Thanks very much. Kriti Gupta, of course, our opening trade colleague on the ground there in Berlin at Super Return. Now, the White House has confirmed President Trump will attend the upcoming NATO summit at The Hague at the end of this month. Trump has said he wants members of the alliance to spend 5% of GDP on the military in what would amount to a substantial increase from current levels. Joining us now from Berlin, Bloomberg's Oliver Crook on the latest, I believe. Yes, there he is. Take us through the details of this then, Ollie. What is the significance?
Yeah, so listen, Anna, we've been sort of anticipating that Trump would come to this NATO meeting in The Hague, this sort of a really sort of very tense moment here for the NATO alliance, and what feels really like a sort of audition for NATO from the Europeans before Donald Trump, and trying to put forward a number of different initiatives that prove to Donald Trump and the administration that Europe is taking its own defense seriously and stepping up in order to safeguard the continued support of the United States, which, as we know from Donald Trump, is not something that is as guaranteed as many of the Europeans would like to see. And And so what we have now been hearing is this number of 5%. It has been swirling around because Trump has talked about it for a long time, but we've heard openly from Mark Rutte, the NATO Secretary General, talking about that 5% figure. We have Friedrich Merz, the Chancellor in Germany, who has all but committed Germany to actually reaching that goal. We've heard about it across the board. And also Marco Rubio, last time he was in Brussels for the defense meeting, he also committed the United States to that 5% goal. So there is a sort of consensus coalescing around that. It is not yet universally adopted. And we should say that that breaks down to about 3.5 percentage points that goes to direct military spending and 1.5 to the sort of infrastructure that supports the military spending. But this all sets up the conversation for 3 weeks from now, for when Donald Trump arrives in The Hague, in those conversations, for, again, what feels more and more like these auditions from the Europeans. And we also have another scoop that came out overnight that another step is going to go forward in that process when we have defense ministers meeting in NATO tomorrow on the European side, saying that they want to quintuple their air defense capabilities over the next couple of years. So you are seeing those incremental steps towards that 5% figure.
Ollie, you mentioned Mark Rutte, a man who knows Dutch politics intimately, and that's the other story that you've been across for us this morning, because, of course, the Dutch government's collapsed after yesterday we reported that the far-right lawmaker Geert Wilders pulled his Freedom Party out of that ruling coalition. So the big question is what happens next for the Dutch government?
Yeah, so now you have the caretaker government. There's going to be another election called. But as you say, Mark Rutte, who I believe had 4 consecutive terms in the Netherlands, he was the longest-serving prime minister over there. He is no stranger to what we've got. And what we have likely in the next election is you likely have, according to the latest polls, Geert Wilders still leading the charge as the biggest party in the Netherlands, though taking away some of the advantage that he had in the election in 2023. But Lizzie and Anna, when we think about sort of dysfunction within politics, you have to look at the Netherlands. The last time they had their election, back in 2021, it took almost 300 days to form a government. That government then collapsed on the issue of migration. Another election was held in 2023. That government was formed about 7 months later, and it only held for about 11 months when it has now collapsed again. The difference that there is between now and then is you have all of these major issues that Europe is dealing with, whether it's defense spending, whether it's a trade war with the United States. And what Brussels would like to project is a very strong, stable, pro-European set of governments across Europe. That is not what you've got in the Netherlands. It is not what you got in Poland from a couple of days ago. So in this idea of basically sell America, buy Europe, as we've been hearing from the private equity conference, when you see these levels of political instability, it certainly doesn't help the case ahead of these meetings.
Okay, Bloomberg's Oliver Crook, we thank you. And speaking of that Buy Europe story, coming up next on the programme, we're going to be talking about someone who wants to be a winner of this US-China trade war. Will reshoring spark an opportunity for European battery makers? The CEO of Norway-based Morrow joins us next. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. Now, Europe's first gigafactory for lithium iron phosphate batteries, LFPs, is gearing up to start commercial deliveries later this year. Morrow Batteries, founded in 2020, is among a handful of remaining European manufacturers seeking to prove that regional producers can carve a niche in the Chinese-dominated market. Joining us now is Morrow's CEO, Lars Christian Bacher. Welcome to the program. Thanks for joining us. So as you're talking to investors and to customers, I wonder how you push back against comparisons with other Scandinavian battery producers that have fallen on hard times. How do you make sure that you don't go the same way as Northvolt and others?
Well, I have 30 years in oil and gas, and when I talk to investors and analysts and companies, the level of competency was extremely high. In this space, it's not at the same maturity level. So there have been different paths into how to do this. When something is very, very complicated, take down complexity. That's something that we have followed. You have to learn to crawl before you can walk, before you can run. So we have taken down the complexity and do this stepwise approach, and are now going to deliver commercial batteries, over the summer. So that's going to be very interesting.
So is your strategy to kind of benefit from the US-China trade war and kind of bet that you need to have a European player in the battery space? Because if that's the way you're going, are you sure that your customers are willing to pay a premium for that?
Well, when we started out, we didn't know about this trade war, and all the tariffs. And in many ways, that geopolitical tension is playing to our strength, our position. And helping us, because more and more people and companies and politicians are talking about friendshoring or onshoring, and that will help. We have always defined Europe as our home market, and but the size of the company and the customers that we are targeting, we are saying that we're not going to compete with Asia, we're going to compete alongside Asia, because there is a space for a company like ours, and yes, customers that we talk to, they are willing to pay more for that diversification.
Okay, and you're serving, it's important perhaps to point out that you are going to be providing batteries for things like trucks, trains, ferries, buses, grid technology, storage, rather than for everyday electric vehicles and passenger cars. Is it different serving that part of the market? Do you need to provide something different?
Well, it would have taken us 4 or 5 years to qualify to become a supplier to an automotive company. We don't have 4 or 5 years, so, and we are not big enough. 3 million batteries a year in production when we produce 24/7. It's not going to make a dent for a company like Volkswagen or Mercedes or whatever. So we have targeted other companies where there is a much higher number of companies and a bigger willingness to kind of pay more, and they can turn around and put that extra cost onto businesses which have a more purchasing power than you and I as an end consumer for an electric vehicle.
If we can switch from demand to supply, you talked about simplifying things, but of course the trade war doesn't simplify things, does it, when it comes to supply chains, and particularly for critical minerals? We've heard the complaints from Washington about that. Where are you sourcing your raw materials from, and how are you preparing for all the volatility?
Well, most of what we source is from Asia. And no wonder that's where the demand for minerals have been. But we also see that there is a growth in number of companies in Europe and North America and elsewhere that want to tap into this market. But I believe that the world will continue to buy batteries from Asia, but they're also going to buy batteries from other places as a sort of de-risking, a dual sourcing strategy, which is typical in all kind of businesses. Huh?
Yes, is it really de-risking and dual sourcing though, Lars, if Asian producers and companies in Europe are reliant on materials coming from Asia in the first place?
Well, we have a list of companies that we can buy materials from so that we are independent. We are also developing a totally new chemistry, LNMO, lithium nickel manganese oxide, which has some really strong traits, which are going to be totally independent and cheaper and better than in many ways what we have in the market today.
And we've been showing some fabulous pictures of your gigafactory just during this conversation. I wonder what's the status on production there? Because I think it was meant to start in the second quarter.
Yep. So we are now finalizing the commissioning and in many ways you could say it's a latter stage of the process that we are now focusing on, which is pre-charge and getting kind of the power into the battery and getting the chemistry to work and thereby create a battery. We have very strong yields, meaning numbers in the earlier stages of the production line. So I'm very optimistic with us being able to deliver in not too many months.
So structurally, Lars, you clearly see a need for products such as the one you're making.
Yeah.
In terms of cyclical drivers and the latest news flow, this feels like a pretty uncertain environment. Do you feel comfortable expanding so quickly at a time of great uncertainty?
Well, we are going to do this in a very sort of prudent way. When the market is ready and when the investors are ready, we will grow. But I think it's also a little bit sad that you're able to make it and not capitalize on the opportunity space that is there for an European producer like us. We see stronger, actually, demand from U.S. after the tariff war has sort of started, because then our batteries are cheaper and more relevant and, so there are pluses and minuses in this.
Why not move a factory there then? All right, Lars Christian Bacher, CEO of Morrow Batteries, we thank you for joining us around the table this morning. Now, just as we've been speaking, we've had a breaking news line that the MSCI All Country World Index has risen to top its February record high. So let's bring back Bloomberg's Valerie Teitel for more. What do you make of this, Val?
Hey, the optimism isn't just in U.S. equities. It's across the globe with that stat that we're at all-time highs in the MSCI All World Index. I mean, it goes to show that the rebound in U.S. equities has really driven a rebound globally. I was just checking, how far we off from all-time highs in the S&P 500. Less than 3% in the S&P 500 off from all-time highs. The NASDAQ less than 3%. Also, the Eurostoxx 600 around 3% away from all-time highs. So this enthusiasm around this resilient U.S. economy seems to be going global, at least for now. Now, remember, we do have a lot more data to contend with. Yes, it was that strong JOLTS data that led the last jump in U.S. equities. We also have ISM services today. Some speculation that the tariff delay could really support that data set today. ISM services dropping later. We also do get some more hard data on the labor market with jobless claims on Thursday and then the big non-farm payroll print on Friday. So it seems like maybe this equity market exuberance can extend if we continue to get data that bucks the trend of the recent soft survey data.
April seems like such a long time ago, doesn't it, Val? I mean, that's really interesting, though, that the US has played a part in the fact that the MSCI All Country Index has gone back to these February levels, because it'd be easy to think, well, that we talk a lot about the trade out of the US and into Europe or into rest of world, but actually the performance of the United States, at least in the last month, was pretty strong.
Yeah, maybe that's more evident in FX with the dollar weakening, but yes, it has been a big rebound in U.S. equities, really strong rebound from those lows. Now we're less than 3% away from all-time highs met on February 14th, and I, for one, am bullish at the prospect.
Valerie, thank you very much. Valerie Teitel, with all of the agenda items that you see in front of you there, that she's been through, and where we find ourselves with stocks. And Lizzie, of course, you're off to Frankfurt.
I am. Going to Heathrow any minute now. My bag is packed.
Excellent.
ECB meeting tomorrow. Looking forward to that cut. That's it for the opening trade. The Pulse is up next. Stay with us. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. President Donald Trump says China's Xi is, quote, extremely hard to make a deal with, dimming prospects for a call between the two. Metal exporters gird for the worst as 50% U.S. tariffs on steel and aluminium come into effect. The U.K. does secure an exemption. Plus, doubling down, Elon Musk describes President Trump's tax bill as a massive pork-filled abomination. We'll figure out what that means. Also coming up, a stellar lineup of guests will be in conversation with the BlackRock Vice Chairman, Philip Hildebrand, as well as the Chief Executives of International Settlement House Euroclear. And then we speak to the Chief Executive of the global accountant giant EY. So there is quite a lot going on. The market's actually holding on to gains. Now, this is something that maybe is a bit of a surprise to some. Gains, look, S&P futures getting some 0.1%. Again, I think a lot of the focus will be on data, further data out of the U.S. on the labor market, which so far has actually held up much better than expected amid this Trump administration's trade war. So we'll have a good look at what this means going forward. It's all about the data points. And then tomorrow we also have the ECB euro dollar 113.87. Because we're spending quite a lot of time talking about China, you can see renminbi at 71912. This is a picture for the European markets map. Now, I think there's a bit of concern in certain industries, for example, the drinks industry, that it's extremely difficult to give forecasts because of the trade wars. Remy Cointreau, one of the big stories that I'm watching out for today. But the CAC 40 and the DAX holding strong. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, economists and policymakers expect President Donald Trump's tariffs to slow growth and boost prices. But the scale of the impact, of course, depends on just how the tariffs are implemented. This week, the OECD slashed its outlook for the second time this year, suggesting the world is heading for its weakest growth since a global pandemic. And while Trump has called for rate cuts, Fed officials have signaled they'll hold them steady until they have a better understanding of how tariffs, immigration, and taxes will all affect the U.S. economy. So there's a lot to discuss with Philip Hildebrand, the vice chair at BlackRock. Philip, as always, thank you so much for joining us. I think last time we caught up was right before the inauguration. It was actually in Davos, and there we were trying to figure out what kind of presidency or what kind of impact it will have on globalization. We're now at the start of June. What have you learned over the last 6 to 7 weeks?
It's good to be here, Francine. It's been a while. Look, I think generally speaking, it's pretty clear that we're moving from in a sense, a long-standing policy equilibrium to a new one. And we're, I would say, in between. And what is not clear is where this new equilibrium will ultimately settle. And so until that becomes clear, and the budget that you mentioned at the outset is another indication, until it becomes clear where ultimately the new world will land, as it were, we are in this transition period, and that is a period of volatility, of very rapid news cycles. You know, you wake up every morning and you have more news and you need to digest it,
obviously.
And watch you and come here. So I think we need to sort of step back a bit and think about where does the world kind of go to in this clearly new regime that has begun.
So where do you see it going to? But also, is there a danger that, you know, we're going from A to B or A to Z if it's radically different, that a lot of things break in this journey?
I think that is the risk is always when you're in these transition phases that, you know, uncertainty is heightened. Heightened uncertainty tends to weigh on demand. And then on top of it, I think as an overarching theme, you have high debt vulnerability. Most countries, all countries virtually, have come out of the great financial crisis and then COVID, industrial policy. These three big forces have led most countries to accumulate huge debt loads, frankly, and that kind of weighs over the entire system. And you can see that in the sense that rates tend to be edging up. There's a term premium that's beginning to clearly emerge in U.S. bonds. So, you know, all these things are indicators that we are in this volatile and uncertain transition, and we just have to kind of stay fixated on the longer term and see where it all lands.
And Phil, I want to come back to actually the debt in a second. But as a central banker, why have we not seen? So we have very concerning surveys about people being worried, not spending, but it hasn't quite materialized yet. So does that come all at once? Is it a laggard, or could we get away with actually the economy being okay?
Well, it's complicated because number one, if you look at trade policy, we don't know where things will settle. Right. And you can see how markets react as soon as there's some pullback of the most extreme scenarios. So that's part of it. The other part is it just takes time. It takes time for these things to settle through. Investment plans don't change overnight. Spending patterns don't change overnight. The U.S. consumer has always been resilient historically. There's also a lot of cash on the sidelines. So if you look at it from an investor's perspective, a lot of incentives to sort of stand ready with the cash and invest when the opportunity comes. So all these forces kind of lead to this slightly uncomfortable interim period, in a sense, between a new equilibrium and the old equilibrium. And it takes time for these things to manifest themselves in the real economy.
So do markets also behave differently because of all of the money in private markets? So
I think that's part of it. You know, there are some great opportunities out there in the marketplace. I was just looking at a statistic the other day. I'm heading to Germany tomorrow. There are apparently 4,000 bridges in Germany that are in urgent need of repair. This is a very kind of basic infrastructure story. Then you think about artificial intelligence. You think about the data centers, the energy supply that will require, the new data centers that will be built. So there is so much, there's so many opportunities, and a lot of them do occur or will occur in private markets, which is one of the reasons we have invested heavily in our private markets capabilities going forward.
Philip, I want to talk a little bit more about the debt, but also the spat between Elon Musk and Donald Trump. So don't go anywhere. Elon Musk has, of course, blasted the President Trump signature tax bill as budget-busting abomination in a public clash with the U.S. leader following his departure from the administration. So to tell us more a little bit about that, Ross Matheson, our EMEA news director. Ross, this feels significant. How significant is it? Would Donald Trump have taken it really badly?
Well, it's interesting because you saw Elon Musk again up in the wee hours commenting further today, saying again he feels that this bill, this big, beautiful bill, is going to undermine the work that he has been doing or was doing with his Doge cost-cutting effort. So he's obviously feeling this quite personally. He spent a lot of time on this effort, whatever you make of that effort, you know, and it arguably took away from his business. And now he's looking at this big bill and thinking it's going to undo whatever the work was that he thought he was doing. But it's interesting in all the comments, even overnight, you know, calling this bill an abomination, saying that people who voted for it, you know, should be, you know, embarrassed or whatever. He didn't actually say anything directly about Donald Trump in all of that. He was talking to the Republicans who voted for this bill, and a warning shot to Republicans, I guess, in the Senate. And the response from the White House is that Donald Trump knows Elon Musk's position on this and understands that. So they're being really careful, each of them, in terms of not trying to come at the other directly. So Elon Musk being very critical of this bill, and through that, I guess, Donald Trump, but not saying those words directly. And Donald Trump in turn, and I guess the question is why, and really they kind of need each other still in a way. Donald Trump benefited from Elon Musk during the campaign and his funds. Midterm elections are not that far away. Elon Musk obviously needs his businesses to be thriving in the US economic environment and policies, but can they hold the line is the question, and do they start to really show a greater level of personal animosity in all of this? But for now, they're being really, really careful.
Roz, thank you so much. Roz Matheson there with the very latest, of course, on this Elon Musk spat. Also, the U.S. and China ratcheting up tensions. Philip, I guess, the concern is about debt. So Elon Musk has ways of doing it which are a little bit unorthodox, going after the president with, pork-filled words. But the bottom line is that he's worried about a debt and that he's cut so much in Doge and that it doesn't go anywhere. How should we view treasuries? Should we start thinking about, is it as safe as it used to be? Does this also change everything?
Yeah, I think this is in a way, the critical question when we talked about the new equilibrium. And again, debt is not an issue just in the U.S. It's an issue in most countries. It's a result of the last 20 years, in a sense. I would say, there are only a handful of countries that have never put in question the sanctity of their sovereign signature, that have never had a sort of outright default. It is extremely important that the U.S. remains firmly in that camp of those handful of countries. The U.S. dollar remains the world's reserve currency. It remains the anchor of the system. The U.S. bond market is the anchor of the financial system. So it is extremely important that Congress, which is deliberating the new budget now, keeps in mind this critical issue of protecting the sanctity of the sovereign signature in the United States as the anchor of the system, notwithstanding whatever changes they want to make to the overall economic order, to the trade order in particular. This question of being able to rely on the sanctity of the sovereign signature in the United States is very, very important.
Philip, I know Larry Fink also penned a really interesting opinion piece, and this is a quote that we picked out, which is basically the thesis of what he wrote, which is, what's emerging now is globalization's second draft, a re-globalization built not just to generate prosperity, but to aim it towards the people and places left behind in the first time. It's difficult to see exactly where it ends up, given U.S.-China and this fight that keeps on escalating every day, including today. It's difficult to know how it ends up because of AI that will break a lot of things. When does it settle?
Well, I think we can see certain things emerging, and Larry says nicely, it's in some ways easier to look at the 7 years ahead than the 7 days ahead, which I thought was a great line. I would say we know that this debt issue has to be addressed. I think that's critical. It'll take time, and frankly, the best way to address it is through growth policies. What we have not seen yet, if you think about the sequencing of the new administration in the United States, much of what has come initially has been contractionary, has raised uncertainty, has in some ways led to more volatility in the marketplace. The next leg of it, hopefully at some point, will be the question of what can you do to promote a pro-growth policy. If you recall early on during the campaign, there was much talk about simplification, deregulation, easing up bureaucracy, things like that can help growth. So there's no question that sustained higher growth would be the best way to deal with the debt and deficit problems in combination with reasonable budgetary policy. And so I think that really is the key to make sure that we can maintain stability around debt. Because with all the other uncertainties that we have, the last thing you want is questions around, again, the sanctity of the sovereign signature. The other thing that you can see emerging, and Larry has been very consistent on this, is the power of capital markets. It is clear that when you have debt levels the way we have them across the world, governments will be constrained in what they can do with public finances. And this is the moment, in a sense, where private capital has to step in. We talked about the large cash balances. This is needed for governments. It's needed for future prosperity. It's a great opportunity.
So do you think, I mean, does capital get deployed differently in, globalization 2.0? And is it being redrafted because of allies? So actually, is it geopolitics or is it about the economics?
Well, I think it's a bit of both. Again, we have this fragmentation of geopolitics. The new system will be different than the 80 years that we've known since World War II. There may be more of a home bias in how capital is deployed. I firmly believe that globalization is not over, but it will be reconfigured in a different way. And a stronger home bias may well be part of the way you deal with these fragmented geopolitical conditions. So take Europe as an example. Europe has extraordinary 10, 11 trillion euros are sitting on bank deposits in Europe. That money sits on bank deposits. It's not entirely idle, of course. Bank balance sheets are being used to support the economy, but it's sitting there in a way that doesn't really generate much of a return. If part of that money can be deployed and mobilized into the capital markets, and that is, of course, one of the key objectives, I think, for Europe, this capital markets union or savings and investment union, if that can happen, you can see enormous growth potential, innovation potential that comes out of that.
I mean, when you look at Europe, how confident are you that this is not going to be a wasted opportunity, that Europe sticks together, comes together with more capital solutions and growth? But is there a danger that, I guess, these, even if trade goes back to normal, that there are deeper issues that stay because of what we lived over the last 6 months?
There is always this danger, Francine, and Europe is a very complicated construct that moves in complicated ways.
That's the understatement of the year.
Whenever I explain Europe to my American colleagues, it's a difficult task. However, I would say Europe is now under maximum pressure. This is Europe's moment. This pressure has always generated responses in Europe. If you look at the last time we've seen anything like this was in '89, when the Soviet Union collapsed. And lo and behold, what happened within 4 years, we had the Maastricht Treaty, which set the foundation for the euro. So I very much see this as a similar moment where there is the new world is exerting maximum pressure on Europe. And I think we talked about the capital markets, completing the single market in telecom, in energy, and finance. There are huge opportunities that Europe can rise to and really change the growth outlook and, frankly, also global investors' outlook. They will reallocate to Europe, at least at the margin, if they can see Europe taking these actions that are necessary.
I'm going to put you on the spot. If I give you $5 million today, where do you, given all the uncertainties, maybe let's say it's a 7-year horizon, where do you put that $5 million?
I think infrastructure is in all its kind of dimensions, is a clear need that the world has. It's a place where you have stable returns. It's a place where governments can support the mobilization of private capital with the right policies. And I think Europe, if this pressure moment that Europe is under can generate the actions that are required, particularly around the capital markets union, I think Europe is a great opportunity. The world is very long dollars. The dollar will remain the reserve currency. That's not going to change anytime soon. But at the margin, the world has gone very long the U.S. dollar, and at the margin, I think some reallocation to Europe is very likely to occur, particularly if Europe can rise to this unique challenge, frankly, but also unique opportunity that it has given the new geopolitical and financial order.
Philip, thank you so much. I could speak to you for another 3 hours, so you'll have to come back really soon. Philip Hildebrand, Vice Chair at BlackRock. Now, coming up, we head to Super Return Berlin, the world's largest private equity event, to check in with the head of the European PE at Neuberger Berman. That's next, and this is Bloomberg.
bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The largest opportunity emerging in private credit is investment-grade assets. Well, that's the view of Apollo President Jim Zelter. He spoke to Kriti Gupta at the private capital conference Super Return.
We're clearly leaning massively into the investment-grade side of the world of private capital. And I would say also in the past, a lot of the issues you brought up, in the past, historically, private has been risky and illiquid, and public has been safe and liquid. We would really challenge that convention, and we're seeing it more and more on these investment-grade opportunities that we've been a leader and owner of.
And Kriti Gupta joins us now from Berlin with another guest. Hi, Kriti. Good morning. Over to you.
Good morning, Francine. As you said, we are here in Berlin at the Super Return Conference, where we're trying to navigate what the major investment themes mean for this part of the financial space. We're talking about tariff exposure. We're talking about people wanting to find some place to park their money amid all of the volatility. And where in this landscape the U.S. versus Europe follows as we see this massive trend, certainly in the public markets, of American funds going and getting retransitioned and reallocated to Europe. Let's talk about what that means, though, in terms of liquidity and in terms of the capital markets right here in this side of the Atlantic. I'm joined now this morning by Joanna Rocha-Scaff. She, of course, is at Neuberger Berman and joins me this morning right here in Berlin. Joanna, pleasure to have you on the program. Of course, thrilled to have you. Let's talk about this dynamic of these capital markets. 2025 was the year where every major deal was supposed to find its home in the IPO market, in the debt capital markets even as well. That timeline has been pushed back time and time again for the last couple of years. We finally crossed that threshold where private markets aren't considered this kind of scary alternate universe. They're very much part of a traditional portfolio now. Could the capital market delays hinder that?
So it's, obviously absolutely correct what you said. We entered 2025, and generally that was the investor sentiment, with a very bullish expectation for capital markets activity. We had a benign macro backdrop. GDP growth was positive and certainly quite strong in the U.S. Inflation getting under control, an expectation that central banks would continue to reduce rates, and that the new incoming administration in the U.S. would somehow facilitate transactions with some deregulation, especially around antitrust measures. And here we are, and the macro backdrop does feel a bit differently. We're seeing deceleration. We get live feeds from some of our portfolio managers around the real state of the economy with real actual data from portfolio companies, and we are seeing a deceleration, meaningful one in the United States. Rates have not come down as fast as expected, and there's increased uncertainty driven by the trade policy. The next big bomb that people are watching is tax policies and potentially a tax war. There's obviously a lot of domestic challenges at the moment in the U.S., some real pressures being put on institutions that obviously were highly respected, and that is causing enormous anxiety. So we have seen the activity decelerate,
And I think investors at the moment are frankly contending themselves that we're perhaps going into the fourth year of muted exit activity in their portfolios. And this is a bit problematic because if you take a mature private markets, private equity portfolio, you typically would see about 25% of your portfolio being harvested and realizing cash sent to you annually, and that is very precious money that you would also use to fund new investment activities or distributions that you may need. And for the past 3 years, that figure has dropped from the normal 25-ish to 12, 13. And that's very much the trend we're continuing to see in 2025. So that's putting enormous pressure in the system.
Well, when we're talking about that enormous pressure, how are GPs perhaps finding a way around that? If the IPO market isn't as accessible as it was or hopes to be down the line, what's the solution to that in the interim?
I mean, one phenomena you've started to see is just hold on to the assets longer. So the average hold period for unrealized assets has increased to about 6 years on average. And that, I mean, used to be closer to a 4. So first idea is kick the can forward, it will get better. I'm just going to hold on to this company, so beautiful, and we'll continue to grow. Eventually, because of the structural limitations of their own funds, right, you will have to actually sell companies. But the solutions we currently see are a bit more interim solutions. For example, partial stake sales in portfolio companies, because there's a minority investors that are keen, and we, for example, do that ourselves, keen to do what we call midlife co-investing, where we will buy a minority stake in a company. The GP can elongate their ownership period, but crystallize some valuation, crystallize some of the value, validate their valuation. Secondaries, obviously you've seen the volumes last year. We continue to see GPs approach the market increasingly with these GP-led secondary solutions, in which they will provide the optionality for investors to hold or to sell, which is great, and new investors come in. And also hybrid forms of capital, be a bit more on the junior debt or preferred equity side of things. Those are types of solutions that we're seeing as much more popular in the current environment.
So we're talking about a way around that. Very quickly, if I can ask this U.S. versus Europe kind of exceptionalism trade, this reallocation you had talked about earlier, is there absorption risk when it comes to this massive momentum into Europe right now?
So go back 6 months. We entered the the year in general very overweight U.S. The expectations for U.S. GDP growth were very strong. I mean, somewhere, depending on which macroeconomists you believe and follow, somewhere around 2.6 to 2.9. And people were generally overweight U.S. and quite bullish in terms of their continued allocations to that market. And let's keep it in mind, it's the largest private equity market, or historically has been in the world, very well established and with a strong history of returns. This instability, the market turbulence, the noise, I mean, and it's not just the international issues that are visible here. I mean, people also pay attention to the domestic issues going on in the U.S. Institutions being challenged, as I said, domestic unrest are causing anxiety. So and frankly, as I mentioned, the tax bill is becoming more and more of a concern. So what I currently see from European investors and other non-U.S. investors we work very closely with is that they are starting to pause or slow down, at least, their allocations to the U.S., but they want to invest.
I think we have to leave the conversation there. Joanna Rocha-Scaff over at Neuberger Berman joining me here in Super Return. Francine.
Critty, thank you so much. We'll have plenty more on private markets. This is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, U.S. President Donald Trump says China's Xi is, quote, extremely hard to make a deal with, dimming prospects for a call between the two. Metal exporters gird for the worst as 50% U.S. tariffs on steel and aluminium come into effect. The U.K. secures an exemption. Plus, doubling down, Elon Musk describes President Trump's tax bill as a massive pork-filled abomination. Now, in other news, the International Settlement House Euroclear says the impact of President Trump's tariffs have been limited so far. Now, settlement activity increased in the first quarter because of market volatility driven by geopolitical uncertainty. The organization settles and clears a wide range of security transactions and has almost 41 trillion euros of assets under custody. Now, they also hold most of Russia's frozen state assets. Well, I'm delighted to be joined by Valérie Urbain, the chief executive of Euroclear. Thank you so much for joining us. I mean, people don't quite understand the scope and the size of Euroclear because you do the things that we shouldn't hear about, that should be smooth playing. It's like the pipeline. Valérie, first of all, are you quite confident that everything is okay in the markets? We've seen massive volatility, but everything seems to have held up.
Well, we always touch wood when we have this kind of question. But yes, clearly, I mean, everything is okay. You know, we are used to manage huge volumes. Fair to say that the recent weeks have seen very impressive volatility. But it's not the first time neither. You know, with COVID, I mean, we have had sufficient crises, unfortunately, in the past. So we are used to that, and that's our raison d'être. You know, its purpose is really to support this kind of massive volumes activity.
Are you expecting much more volatility? And again, how does it work? If you're expecting about volatility, do you have to try and change the systems, or do you just work at them, you know, almost like month by month to make sure that they're as strong as possible?
No, we always have, you know, a huge buffer. Because clearly we expect and we have to be there, because it's very much at the time of volatility that our clients are expecting us to be there, to be reliable. So we have massive buffer of CPU, and therefore, you know, we are prepared to handle any type of business. Of course, we have then the teams who are also ready to support and to ask, to support questions from clients. So that's also from a people perspective. These are moments which are very, you know, active for them. But that's why we are for.
Is there anything that worries you in the markets, in the market functioning, really, in the kind of, again, the pipeline?
I think so far the market is very well reacted, you know, so I wouldn't know. I'm not worried.
Some of the planned announcement about the Savings and Investment Union seems to have been leaked. I mean, do you like what you've seen and heard so far?
Well, you know, I'm very optimistic because I really like to see, you know, the momentum around savings and investment union. The capital market union is something that we have talked about for 10 years with no real progress. I feel now that there is something different in the sense that we're not only talking about regulation or whatsoever, we are really talking about real economy. We are talking about, bringing investors, the savings of the European to support the real economy in Europe, to start supporting startup, innovative companies, scaling them up, So I feel that now it's really a lot more in view of supporting the European autonomy. So there is a political will, there is an economic will behind all of that. There is also a pride of being Europeans. So I feel that this time, if we can make a change, it's now.
And you're confident that it's coming up with this package, that the markets will be turbocharged by this, that it's not going to be another wasted opportunity.
Well, I think in Europe often we are negative. So we start by looking at the weak points or what doesn't work. So I think we should rather, on the contrary, think that, this is the right time to do it. And this is the moment that we all need to join forces. So, of course, everybody will have to play. The European institutions are coming with their proposal. But the private sector also needs to play its role. And definitely that's what we want to, on our side, we want really to contribute to the development of the SIE.
Does it mean that the clearing industry should potentially also consolidate?
But, when you talk about consolidation, there is already a consolidation into place. Euroclear will represent 62% of the volume in Europe, 51% of the assets in Europe. So there has already been some consolidation. But fair to say that on the equities market, we really need to go further to start offering a more one-stop shop, towards the equities market. We need to look at how we can harmonize market practices, laws, anything we can do to ease access to the equities market.
So what does that look like? Again, because it's difficult. Is it negotiation? Is there low-hanging fruit that actually could let you get there quicker?
Unfortunately, I wouldn't say there are low-hanging fruits, otherwise we would have done that, So I think it's a matter of finding also the right support from a regulatory perspective to a fit-for-purpose regulation. I think it's also about, agreeing in every market to think maybe more about Europe rather than national, reality. So, I think everybody will have to give up a little bit to make it more European and to make it more effective.
Can you talk to us a little bit about private markets? So we've seen a huge rise, actually, in private markets, and I feel like this changes everything in terms of deployment on cash. Yeah. Does it complicate Euroclear's life? Does it change the transaction landscape in terms of what's on offer to trade and transact?
Well, I would say that it is opening new opportunities because today the private market is not settling through the central securities depository. But fair to say that now that we see the retail market joining as well, the private markets, we start engaging with BlackRock, Apollo, iCapital to see how we can address the pain points and come with solutions that we have already used for other type of funds, like the ETF, for example. That's a solution that we brought about 10 years ago, where we are offering access to multiple trading platforms, but with one settlement solution. And so we are starting to look with, the companies I mentioned, how we can create, new solutions to reduce the inefficiencies of the markets.
I also want to ask you that, we talk every day about, trade tensions and the fact that globalization may be go through a different phase, but it looks very inward-looking, like domestic-looking. Yeah. Does that change anything for the clearing industry? Is there a danger that you get caught up in this?
Well, there will be an impact. The financial markets have been pretty globalized. And I think you're right that we are seeing now more and more, pool of liquidity which are being fragmented. Now, having said that, Euroclear's strength has always been to provide interoperability between the different parts of the world. And so clearly there we are again, looking at how we can continue to offer this gateway to the world for the European needs. But also we are seeing with the Asian markets, for example, how we can continue to support their own development with our know-how. So I think, again, whenever there is changes in the market, there are threats, but there are opportunities. And frankly, continuing to see how we can link together the different pools is certainly something that we are looking at.
How do you view currently the debate of using these Russian frozen central bank assets? It seems to be gaining traction.
It's a debate that we have for 3 years, unfortunately. So, I mean, since the beginning, we are there to execute decisions which have been taken by policymakers. We are also, as practitioners, there to inform them about the potential consequences of any decision that they will be taking. And indeed, the seizing of assets come back and forth. Now, what we always advocate is to think about the stability of the financial market, to think of the attractiveness of the European markets, and linking back to the Savings and Investment Union, you want to make sure that the European markets, the people remain trustful, confident in the European markets, given the gigantic financing need that we have. So legal certainty, respecting the rules of law are extremely important, even more so in the context of SIU.
What are the main risks, actually, for the Euroclear business?
So for Euroclear business, as I say, it's really a loss of confidence in the European markets. I mean, if indeed the central banks of the world start feeling that the legal certainty of the European markets can be attacked, that would certainly reduce the attractiveness of euro for them.
And this is actually even more crucial, as people are saying, this is the euro's moment to try and get more global weight, given that the dollar is a reserve currency.
You're absolutely right, because I've been touring the world recently, and in November, Europe was a little bit of an anecdote in the Asian markets. Last 2 weeks, I was also in Asia. Now Europe is back again on the agenda. So I think Europe is again an alternative to the US market. It will not replace the US market, but it is an alternative.
But what can Europe do to actually be a real alternative?
Well, continue to develop, to deepen the capital markets. I think this is what is missing. On the fixed income, I think we have a very buoyant market, which is recognized around the world. But on the equities market, I think there are very good companies, but they are not yet sufficiently known. I mean, the depth of the market is not strong enough.
Valerie, thank you so much for joining us. Valérie Urbain, the chief executive of Euroclear. Now to some other stories making news today. In South Korea's main index jumped by over 2% after Lee Jae-myung's presidential election win lifted sentiment, pushing the Kospi into a bull market. Now South Korea's new president has pledged to revive economic momentum following 6 months of political chaos spurred by his predecessor's martial law declaration. Now to the Netherlands, where the Dutch Prime Minister Dick Schoof has tendered his resignation and assumed a caretaker role. This after the government collapsed when far-right lawmaker Geert Wilders pulled his Freedom Party out of the ruling coalition, while the outgoing PM criticized the withdrawal.
In recent days, I have repeatedly informed all 4 party leaders that, in my opinion, the fall of the cabinet was unnecessary and irresponsible. We face significant national and international challenges, and decisiveness is required more than ever. This is crucial for the security of our resilience and the economy in a rapidly changing world.
Well, the White House says President Trump will attend the upcoming NATO summit at The Hague. Now, this comes as Trump steps up pressure on alliance members to increase defense spending. Separately, Bloomberg understands that NATO is asking European members for a 5-fold jump in ground-based air defense capabilities to counter Russian aggression. Now, Bloomberg has learned that UK Prime Minister Keir Starmer is considering a Ministry of Defence request to back NATO's proposed new military spend target of 3.5% of national output by 2032. Now, if accepted, it would be a major test of the UK's already stretched public finances. Well, we're now joined by Caroline Hepker, who's been digging into the cost of rearming the UK. Caroline, so good to have you with us on the call. So does the UK actually have the scope to do this? Does it have the money to commit to more defence spending?
Well, at the moment, we're spending 2.3% of our whole economic output on defence. The government has committed to 2.5% with an ambition to go to 3%. The thing is, Britain is now under increased pressure. In a few weeks' time, there'll be the NATO summit. The Ministry of Defence wants the government to commit to more, but our own deep dive, speaking to a whole host of defence contractors, to think tanks and to people who've actually run the British military in terms of the Navy and the armed forces, is that there is a huge gap to make up. Our own Bloomberg economics analysis says trying to reach that NATO goal of 5% would mean £350 billion in terms of costs. So there is an absolutely enormous issue for Britain about how we make up for decades of cuts to our defence and now bolster our military spending.
So, Caroline, you've also been speaking to the chairman of Airbus Defence and Space UK. So let's take a listen to that. don't know if we have it or we don't, but basically, what has he been telling you?
Yeah, so Ben Bridge was in the radio studio to speak to us for this special UK Defence podcast that we've done at length, talking effectively about how he's got 3,500 people in the UK. He is ready to invest more, but only effectively if he gets a contract. And that's the same sort of message that we got from BAE Systems, which is the largest defence contractor here in the UK, from Leonardo UK, which is the big Italian defence contractor, again, that has a big aerospace business in Britain. So the issue is not just for the so-called primes, the big defence contractors, but also for the SMEs. Everybody's waiting to see whether there will actually be money committed to this or not.
Yeah, and how quickly. Caroline, great reporting. I know you can follow all of course, our number analysis and Caroline's great in-depth look at the defence spending on the terminal, on our website, and we'll push it out on social media as well. As always, thank you, Caroline Hepker. Now, coming up, we hear from the EY Chief Executive on what it takes for business to succeed in today's ever-changing world. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Well, just half of the businesses surveyed by accounting firm EY say their approach to risks from technology are sufficient, while nearly a third of C-suite leaders say their organization have fully integrated and scaled artificial intelligence. Now, the findings come as EY celebrates its 25th annual Entrepreneur of the Year award, with AI, of course, a key theme for many of the finalists. Well, on this, I'm delighted to be joined by EY's Chief Executive, Janet Trunkale. Janet, as always, thank you so much for joining us. So when you took over EY, you're basically a year into the role. There's, a lot to deal with. Are you happy, first of all, with the current structure? Anything you'd like to do differently? How are you servicing your clients?
No, first of all, it's great to be joining you here from Monaco, where we're celebrating our 25th anniversary, celebrating entrepreneurs here from across the world. And so, yes, it's an interesting time that we're focusing on right now. But we're advising clients all over the world. I'm seeing CEOs all over the world. And yes, times are uncertain. But in times of uncertainty, we're really seeing our clients and the CEOs focus on the muscle memory that they have. And uncertainty is the new norm. And so we are seeing our clients focusing on transformation that is still top of mind. We're seeing them focusing on growth and the customer, and we're also seeing them focus on cost cutting as well. And I'm really proud to be taking the helm. I've been here for 1 year, And I know with our scale and our breadth and our scope of services, there's nobody with a better footprint to serve our clients during uncertain times, from the core strategy all the way to execution.
EY, Janet, of course, like many of your rivals, is embracing AI, and we talk a lot about AI, especially where you are in Monaco. What are the ways, big and small, in which this technology is changing the way you work? What do you think this will, mean longer term for headcount and operations?
There's a lot to cover there. Now, first of all, when we launched our strategy, we wanted to make sure that technology was underpinning everything that we do. And I think that's critically important. We're focusing on disrupting ourselves. We're focusing on helping our customers disrupt themselves as well, and also making sure that we're using technology for good. 37% of our entrepreneurs that are here with us in Monaco really have AI-focused businesses. That's up from last year, and we fully expect that to be continuing to grow, going forward as we see our entrepreneurs in future programs. But I think it's really important. When I think about technology, there's 4 key principles that we come back to when we think about it for ourselves and also when we think about it for our customers. And first and foremost, we have to really look at the business value. Last year, if you ask me, a lot of the focus on technology and AI was about productivity. We've seen a major shift there, and we're seeing focus on growth and new opportunities as well. So I think the business value is really critical. Then I go back to data. That's really important. That's important for us. We have so much data across all of our businesses that we want to be harnessing. And we want to make sure that our clients are focusing data as part of their big strategy around transformation and technology. Some are at the early end. Some are very much evolved as it relates to their data strategy. And then I really want to talk about humans at the center. I'm talking to entrepreneurs here over this entire week. And they keep reminding us that with all the technology enhancements and improvements, we still need humans. Humans are there for judgment and to make sure that we're using all of this technology for good. And then lastly, trust. I think trust is more important than ever. We just launched our Responsible AI survey, and we are reminded that we have to balance the speed to market with the customer and the consumer confidence. And we really need to be making sure that trust is embedded in everything that we do. And when our clients are deploying new technology, that they have the risk framework and the controls around it to make sure that when we release technology, that it can be trusted.
Janet, when you look at, when you talk to entrepreneurs and some of the smaller firms, do they ask more about what to do with AI, or do they worry about the Trump tariffs and trade wars?
So it's interesting. There's all types of conversations happening here in Monaco with our entrepreneurs. First of all, we have winners from all over the globe, small and big companies. I'm really proud to say we have 53 winners coming from 42 jurisdictions around the world. And for the first time, we actually have a winner from the Ukraine. And so we're reminded that in certain times, we have entrepreneurs here that are really demonstrating perseverance and agility. So we're really reminded of that. And they're really coming from all sectors. And so, yes, they're talking about tariffs, they're talking about technology and AI, but there is something that we can all learn from the entrepreneurs that are here with us this week. And that is all about determination and agility. And I'm telling you that I know confidence has been up and down in the C-suite over the last year, but we could all take a lesson from the entrepreneurs that are here with us in Monaco, because their confidence is really admirable and inspirational.
I mean, but at the same time, we have a lot of chief executives saying it's easier to see what happens in 7 years rather than in 7 days. So what's your best piece of advice for some of these entrepreneurs to keep cool and keep their head down? Is there a magic secret sauce?
I wish there was, Francine. And look, I say all the time, I don't want to, over pivot, under pivot. We need to really remain steady. And I think, lessons that I've learned over the last year, lessons for all of our entrepreneurs and for all of our clients, is to stay the course. Remember that muscle memory. Uncertainty is going to be the norm. It's going to be there for some time. And go back to what you know and make sure that you don't go it alone. We've been talking to a lot of entrepreneurs who got to this point of their business without taking outside capital, without outside advice. And I think it's really important in our strategy and for all of our customers, you don't need to go it alone. With technology, there are broader ecosystems, there are alliance partners that really can help you transform your business to make sure that you're here to stay and that you come out of this time even with a stronger business going forward.
Janet, look, consulting firms, certainly have had a tougher time than the heydays back in 2021, 2022. What does it take for actually customers to want to come back and you see a concrete rebound in your services? Is it more predictability from the U.S. in terms of policy and regulation trajectory that would help you win more business?
Look, we have such a diverse business across, our foundational businesses like audit and tax and risk management, and then to new and emerging areas. We just launched relaunched the EY Parthenon brand that really talks about strategy from the tip of the spear all the way to execution. We've got the #1 brand within transaction tax and transaction diligence. We actually just announced our Studio Plus offering because we're seeing the focus on customer and consumer and that transformational customer experience to be so important and to be a board and C-suite discussion. And so we've got such a balanced portfolio. But of course, we're starting to see the transactions market pick up. We're starting to see, again, more confidence in the system as the tariffs start to settle down. But I'm really confident that we've got such a breadth and scale to our business, that we are very satisfied with where we are, but I see great opportunities and greater growth in the future.
Where would those opportunities and growth come from? Is it different industries? Is it different segmentations or just different markets?
We cover all of our industries. We've seen in this last year that financial services continue to be resilient, industrials and energy. We definitely see a little bit of a mixed bag in the consumer area. But again, I think it goes back to those key principles of focusing on transformation during this time, focus on the consumer. Right now, people have different challenges to deal with. Where are you going to make things? Where are you going to sell things? And I think the consumer experience is going to continue to differentiate our clients in the future. But again, we're seeing really strong growth from financial services, industrial and energy, and a little softer in other areas.
Janet, you have a global mobile workforce. Are you going to redeploy staff? Do staff want to move from certain places to other places?
Oh, absolutely. I think coming out of the pandemic, we saw a greater need and a desire for our younger workforce to travel. And look, we can serve clients all over the globe from anywhere, and that's one of the things that we've learned. And the next generation, we have 5 generations under one roof at EY right now, and I think mobility and career agility more broadly. So not only seeing different parts of the world, but working across sector and across service line is truly going to be a definition and something that the younger workforce is looking for a lot more quickly in their career than maybe folks of my generation did. And I think the firms that can really focus on meeting the needs of that generation where they are will be the winners. I'm reminded all the time, we have 30% of our workforce today is Generation Z. In just 9 years, they will be 70% of our workforce. And they're really going to dictate to us what they want in an employer. And we're really focused on a new employee value proposition that really focuses on learning, development, career agility. And let's not forget wellness. I think that's really going to continue to be a focus of our employee workforce as well.
Janet, so great to speak to you. Thank you so much for making the time. Janet Tronquel there, the Chief Executive of EY, speaking to us from the French Riviera. Now, up next, it's a Bloomberg Brief. We look at markets, we look at data, and we look at jobs in the U.S. And this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Double up. 50% tariffs on steel and aluminum kick in. Meanwhile, President Donald Trump struggles to strike a deal with his Chinese counterpart. Seoul's impasse. Senate Majority Leader John Thune says the president's big, beautiful bill will have to change to pass his chamber. And leaders in private equity flock to Berlin for super return. Don't miss our interviews with Blackstone Vice Chairman Thomas Nides and Ares Management Co-President Blair Jacobson throughout the hour. Now let's get a look at where markets are standing as we look towards futures. We are seeing another day of potential positive gains for all the major indices. Remember, we've had two nice sessions this week with the S&P 500 up 1% so far on the week. It looks like we might have another positive one today. In terms of the Nasdaq 100, we're seeing another 0.1% in gains, at least according to futures. We have that index up 1.5% on the week, and the Russell 2000 also looks to be staying positive as the whole market really looks to the jobs report Friday. And to that event, let's take a look at bonds, because we did see a little bit of selling in bonds yesterday with a more risk-on tone. We saw a few basis points of a move higher, holding steady relatively today. That 30-year yield, though close to that 5% again. We've been testing it all month so far, at least Monday and Tuesday, and we may test it once again today. Well, let's get a look at some individual stocks to watch now. We'll head across to London and Joe Easton. Joe.
Hey, Vonnie, so it's a big day for Wells Fargo. The company is coming out of some restrictions that were slammed on the US bank around 7 years ago, restricting its growth and potentially costing it tens of billions of dollars following several scandals at the firm. So this really boosting that stock today. We're up almost 4.1% on Wells Fargo. Keep an eye on that one as we progress. One stock not doing so well, though, CrowdStrike. This one was slipping, actually extending those losses now. We're down more than 6% on CrowdStrike. We'll all remember that big shutdown on their systems back in July. I was traveling that day myself, so it's scarred on my memory. But the earnings report today pretty much just missing the top end of the buy-side expectations, which were lifted headed into that report. So that stock weaker today. And then finally, to finish on another green one, this one is Hewlett-Packard Enterprise. It's actually beating expectations. This is hardware, a lot of it driven by the AI hardware demand. Actually, analysts are pretty pleased with that one, Vonnie, on HPE, not to be confused with HPQ, of course. And check out the Before the Bell opening wrap for a summary of all these, as usual, Vonnie.
Amazing, Joe. Thank you so much. We'll be back with you in a little bit. And coming up this hour, live from Super Return in Berlin, we'll speak to Ares Management co-president Blair Jacobson, plus an exclusive interview with Blackstone Vice Chairman Thomas Nides. But first, President Trump's 50% tariffs on steel and aluminum imports kick in.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs. If not for this president, that steel plant in Pittsburgh, Pennsylvania would have closed. Those jobs would have been lost, and the president saved that company, he saved those jobs, and he's saving that community.
Joining us now is Bloomberg's Brendan Murray. Brendan, thank you. We were waiting on President Trump to fulfill this promise to have 50% tariffs kick in. Indeed, he did. What is the next step in terms of challenges?
Well, the next steps in terms of challenges are to try to convince all the American trading partners that that they shouldn't retaliate. Basically, this is going to really not create a great mood with countries or economies like the European Union, with South Korea, with Japan. This is only going to ratchet up the pressure and the tension in these bilateral talks that the administration is having ahead of the July 9th reciprocal tariff deadline. So it just extends the pain to exporters like Germany, and it creates an environment where if you're on the other side of if you're on the receiving end of these 50% tariffs, that's just going to create more pain in your economy. So it's going to make the goal that the administration has to reach these deals even harder to reach.
What kind of time frame are we looking at? The USTR, Jameson Greer, is in Paris today. There's a ministerial meeting, a trade ministers meeting on the sidelines of the OECD. Is it possible that things could change very quickly?
It doesn't seem likely to change very quickly. Now, the administration would argue that a lot of these deals are coming together as planned with India, with Japan, with South Korea. They've said that these are on track to happen, not imminently, but over the next several weeks. And so we'll see what happens with Jameson Greer, the USTR in Paris. He's going to meet with his G7 counterparts, which would include, the major U.S. trading partners in steel. So we'll have to see if we get any readouts from those closed-door meetings. But it certainly sets the stage for a contentious air in the room if you've been greeted with a 50% steel tariff that was 25% yesterday.
Yeah, exactly. And Brendan, if I could move to another trade theater now in China, we were anticipating some kind of call, and then we got this Truth Social from President Trump last night saying that Xi Jinping is, quote, very tough and extremely hard to make a deal with. It seems the tensions are increasing, if anything.
Yeah, exactly. President Trump seems to think that the one thing that he needs to do to release some of the tension between the U.S. and China is have a call with President Xi, and China is just not willing to make that happen, apparently, or at least want some major concessions for that for that call to go forward. And in the meantime, Bloomberg is reporting that China is looking at a bunch of Airbus jets to purchase. So that says to a lot of analysts that China is kind of giving the U.S. the cold shoulder and looking more favorably at Europe. So that you have to weigh that part of the calculus into the relationship dynamic here, that China is basically turning away from Trump's approach. It almost looks desperate. I believe that social media post was at 2 a.m. last night. So apparently he's losing sleep over it, and it's only going to make the relationship between Europe potentially even and China even more stronger.
All right, Brendan, we'll see if that call ever happens between President Trump and Chinese Premier Xi Jinping. That is Brendan Murray there for us, and thank you, our trade czar. Well, over on Capitol Hill, the Senate has begun deliberations on President Trump's, quote, big, beautiful bill, and Majority Leader John Thune warns changes will have to be made to the SALT deal. For more now, let's bring in Josh Gallo. So, Josh, this SALT problem, if you want to call it that, is only one of the problems. What are the priorities for the Republican senators?
Well, that's part of the problem. The priorities are different for many of the marginal senators that they need to fall in line to pass this bill. So the SALT tax, the state and local deduction, was basically something that got Trump installed in 2017 in his original program and set a cap of $10,000. The House wanted that to go up because, of course, these are states like California, New York, New Jersey have high property taxes, high property values, and they want a bigger break for their constituents. That was a critical piece of moving this legislation through the House, but in the Senate, there are far more senators concerned about the impact on the deficit. So they're less concerned about SALT because those states that really care about it are represented by Democrats, and their votes aren't really needed there. So look, fundamentally, this is a conflict over spending. The bill as it stands coming out of the House would add about more than $1.5 trillion to the deficit over 10 years. And that has a lot of fiscal hawks like Rand Paul, Mike Lee, Ron Johnson, really balking at this and looking for more cuts. But the problem is, there are a lot of other rural states that are going to suffer from those cuts, like less spending on Medicaid, for instance, in rural areas, and also states that are benefiting from credits and subsidies for clean energy, like North Carolina and others. So, there are a lot of conflicting priorities right now that it's hard to see the path forward immediately, but some people will definitely be unhappy with the result.
Yeah, and one high-profile business person, if you want to call him that, also now an opponent, Elon Musk, blasting the tax bill. He posted on X, quote, "This massive, outrageous, pork-filled congressional spending bill is a disgusting abomination. Shame on those who voted for it. And also, it more than defeats all the cost savings achieved by the Doge team at great personal cost and risk." Does Elon Musk's opinion hold sway here? Do opponents, for example, of the bill in the Senate now perhaps have just that marginal bit more momentum, Josh?
It does hold sway. It depends on the senator and the issue, but honestly, you've seen what Elon Musk is willing to do in terms of weighing in on politics and spending money on getting people either pushed out or into office. So anybody who is now thinking about supporting this bill after having seen what Musk wrote has to be thinking in the back of their mind, what is he going to do when I'm up for election in the midterms next year? So this is something that's going to certainly weigh on them, and it's a very tough position for any lawmaker to be stuck between President Trump and somebody like Elon Musk.
All right, Josh, we will continue to watch the negotiations throughout the week. That is Josh Gallo. Thank you so much for joining. Now, on to other top stories trending on the terminal this morning. It's a day before the ECB rate decision and President Christine Lagarde's news conference, where she's about to face scrutiny on her commitment to lead that central bank. Lagarde has been courted to lead the World Economic Forum, despite having another 2.5 years on her term at the ECB. Walmart is terminating some jobs in Florida following recent immigration rulings by the Supreme Court. According to people familiar with the matter, employees in at least 2 stores were told they will lose their jobs if they don't get new work authorizations. Walmart declined to comment. Rémy Cointreau withdrew its long-term sales guidance, blaming tariff policies in America and China and a slow recovery in the US market. The company forecasts mid-single-digit organic sales growth this year. The maker of Rémy Martin Cognac appointed a new CEO last month. Coming up, Super Return is underway in Berlin. We're live with our own Danny Berger, speaking with Aries co-president Blair Jacobson. That's next. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's Jobs Day, and Bloomberg has the report under surveillance.
The risk was a downside surprise, the reality an upside surprise.
The shock has affected outcomes.
There's a pretty big cliff from an economic perspective.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
American exceptionalism continues.
This is not what we're going to experience in the upcoming months. Is it going to be Biden data or Trump data?
The May Jobs Report, Friday on Bloomberg.
Right now, while the tariffs and Liberation Day got a lot of the headlines, the market forces, the so-called BOD vigilantes, have woken up those to the concern about the growing deficit in the United States. So in the marketplace right now, with a little bit slower growth and some concern, a lot of hand-wringing, the deficit issue has taken the main stage versus the impact of the tariffs. Now, this administration, we can't get too comfortable. There can be a headline in the next few minutes that change that. But right now, the big focus is on rates and the deficit, obviously, as the current administration is focusing on their big, beautiful bill.
Apollo President Jim Zelter there speaking to Bloomberg as the private credit world gathers in Berlin for super return. Let's head over there now to Danny Berger at the summit. Danny.
Bonnie, thank you so much. You're right. That is the topic of conversation, and I'm pleased to say that joining us is an excellent guest. It is Blair Jacobson, co-president of Ares Asset Management. Blair, thank you so much for joining this morning.
Great to be here, Danny.
Fantastic to see you in Berlin. And look, it's been half a year that's, let's be honest, has felt like a decade. It's also half a year in which you were elevated to co-president, so you have a more holistic view of the business. In this moment of volatility, just how challenged are corporate business models for funding and liquidity right now?
So we're clearly in an interesting moment. We came into this very, very well positioned. You know, our company's book is roughly 70% credit, 90% of that senior secured. Earnings did very well in 24 and into Q1 25. Clearly, this is the year where we see the results of politics. A lot of twists and turns, but when we think about how the businesses are performing, we're more focused on the mid-market, so our company's a little bit more local focused and international trade focused. They're also in sectors which tend to be a bit more resilient, less manufacturing, a bit more services. But we're still getting the numbers in for April and May, and we'll see, but so far we haven't seen any real negative KPIs or liquidity signals that would lead us to be overly concerned around business activity.
Is there anywhere that there's stress? I mean, there's got to be, right? Things are so upended. You feel it certainly in public markets. Is that nowhere in private markets?
I think what does make us nervous, what we're monitoring very, very closely, are the derivative effects. Even if you don't have tariff-impacted businesses, certainly all of the dislocation in the markets would make a CEO hesitant around new business decisions, CapEx decisions, growth decisions. So we're very focused on CEO confidence. It also goes into consumer confidence, consumer big force in the economy, thinking about how they're allocating their spending, especially because it's very discretionary. So I'd say those are the two areas that we're really focused on from a risk perspective.
And any signs of any stress there yet?
Not yet, but we're monitoring it very carefully.
Well, elsewhere, there has been deal volumes that have really started to plummet. M&A is on the back burner at this moment. Banks are also still competing at a moment where private credit has raised a lot of capital. Ares itself, a lot of dry powder. You mentioned 70% credit. Does that mean that more money is chasing fewer deals? Is that a problem for this industry right now?
Good question. I feel like this comes up every couple of years. You're right. We feel great. We have $140 billion of dry powder, record for the firm. And the question is, how would we invest that? If you go micro, look at Europe. We talk to something like 1,400 companies every year. We only make new loans to between 30 and 50 companies. So again, we're very selective. There's a lot more going on in the markets. Also, if you look at the dry powder of private equity versus credit, credit's maybe 15 to 25% of that. So again, as long as there's confidence, in particular in the mid-market, private equity needs exits, their LPs need DPI. So even though things have slowed a little bit, still active on the M&A side, but also very active on the refinancing side and the industry consolidation.
Do you think others are being less selective, though, with all that money that needs to be put to work?
I'd say potentially. You know, again, we don't comment on what our competitors do every day. I think we're more focused on what we're doing. And again, this is a market where due diligence, credit discipline, documentation discipline is especially important.
Very diplomatically answered, Blair. I appreciate that. But within this era of competition, the banks are still big players. In fact, we see a lot of deals where borrowers are trending more towards banks in prior periods of dislocation when private credit was really their only option. Has that surprised you?
Not really. I think that private credit, the foundation has always been in the mid-market where commercial banks are less active. When you think about bigger companies, they've always accessed the capital markets. It's very efficient. I think the interesting thing today is when you see what happened in 2022 and 23, when the capital markets were closed for a long time, private credit came in and financed a lot of these businesses. So companies and their owners now know that they have options. This is really advantageous for us. Bloomberg reported on a really big loan we just signed in the U.S. We're working on similarly sized loans here in Europe that are big and companies that could access the capital markets, but at the same time find private capital more compelling.
Well, the other big change that maybe is starting to be underway for this industry is the so-called convergence of public and private. And part of the way that's taking shape, Apollo, our reporting suggests that they're opening up a trading desk, trying to get more liquidity into the asset class. But this is an asset class that one of its benefits had been low volatility. So is it an issue if it starts to trade more and there's more mark-to-market and more volatility?
So I think our view on that is public-private convergence is happening. We first saw that in the loan space, again, as I just mentioned, with larger companies. The next question that's been brought up is, will private credit ever trade? I think we take a bit of a skeptical view on that. Private loans are private for a reason. Their owners want it private for a reason. They tend to be smaller companies, more concentrated holdings. And in fact, in some of those documentation provisions, you're actually prohibited in some ways from trading. So might things move around a little bit? Perhaps more stress names potentially, but does it become big? I think we have to wait and see on that.
So just structurally, the mechanism isn't there, from what I'm understanding, to get more widely traded.
It's a challenge.
Okay, it's a challenge, but part of the reason, presumably, funds like Apollo are trying to do this, it's because they want the liquidity to package up into more retail-type wealth management products. I know it's something Ares has been very active in, wealth management, but if the industry as a whole is pushing to retail, the criticism is they're packaging up the worst stuff and selling it off to retail. Is that a real risk?
I think for us, retail's been part of our DNA for 20 years. Started really with our first loan vehicle in the U.S., which was a publicly traded BDC, which has gone through all types of different macro environments, micro environments. When we think about the loans that go into those vehicles, it's the exact same loans that our institutional clients get. That's how we allocate them. So again, I don't view that at all as a negative.
We have seen some of your peers team up with more retail-type companies. So you have KKR and Capital Group, Blackstone with Vanguard and Wellington. Would Ares ever do one of these partnerships?
We're always exploring those partnerships. Certainly from our perspective, again, around a quarter of what the firm does touches retail in some way, shape, or form. That's not only in publicly traded vehicles. Increasingly, that's on the wealth side. I think with any partnership, you have to explore the benefits for both sides. I say currently we're doing fine with what we have, but we're always looking at additional opportunities.
What's sort of the precipice and when you say, okay, we need to bring a partner on, that we don't want to just go at this alone? What is that line in the sand?
I think what we always are mindful of is accessing different distribution channels that perhaps would be a challenge for ourselves and our existing team. We're obviously very mindful that a lot of these companies, for example, there's discussion in the U.S. About allowing 401ks to invest in private markets more, and some of those businesses that you mentioned have very good lines of sight into those clients. That's something we're monitoring closely as well.
It's interesting because in some ways hedge funds underwent this stress. When all of a sudden ETFs became really popular, one of the things it did was it brought fees down, because all of a sudden you're competing with these retail products that have lower fees. Could that possibly be the destination for this industry? Could fee models be challenged if all of a sudden you have cheaper retail products out there?
So I think the way we think about it is, broadly speaking, the fee model needs to match the risk-adjusted return of the underlying asset. In particular, private assets are hard to originate. We have hundreds of people all over the world seeking unique assets for our clients. And again, that demonstrates a certain fee level that our institutional clients pay and our retail clients pay. Do people always want to pay less for more? Of course they do. But again, we think that that's under a good trajectory.
Well, it's part of the hard work you do, and why we're so pleased to have you now as co-president of Ares. Blair, thank you so much for joining. We really, really appreciate your time. I know there's limited amount at this conference, so you're very generous. Bonnie, with that, I'll hand it back to you. That is, of course, Blair Jacobson of Ares.
Fantastic interview, Danny, and we will be back with Danny Berger at Super Return later on in the hour. Time now for our front page news, a look at what's making headlines around the world. First up, the Wall Street Journal leads with how 4 major automakers are racing to find a workaround to China's stranglehold on rare earth magnets. According to people familiar with the matter, makers of traditional vehicles and EVs are considering shifting some auto parts manufacturing to China to avoid factory shutdowns. Next, on the Financial Times front page, Germany's plans for corporate tax breaks. The package of incentives will cost €46 billion in total by 2029. It's looking to pass the package over the summer in an effort to jolt the country out of stagnancy. And the Washington Post reporting on ICE, saying they had taken into custody the family of the man accused of injuring at least a dozen people in Boulder, Colorado. Homeland Security Secretary Kristi Noem said the agency was investigating whether the family knew and provided support for the attack. Well, let's get a check on the markets now as we head into the Wednesday session. In just a few hours, we'll see the open in New York City. Right now, S&P futures are still pointed higher to the tune of 0.2%. That would be a third day of gains if this continues. The S&P, of course, rose 0.6% yesterday. It's up 1% on the week so far. And another thing to point out, the regular S&P outperforming the equal-weighted index now year to date, and that's the first time since just after the February record. The dollar index continues lower, down more than another 0.1%. That's continuing weakness for the US dollar index. And we did see some buying in treasuries to start off the week. A little risk-on tone as we look towards potentially a better labour market report. So far, the labour market data this week has been pretty sanguine. We'll get ADP later on today. If you look at the euro, we're trading just a little stronger. And the same for sterling off the back of that weaker US dollar index. And in terms of treasuries, we may test the 5% mark again today on the 30-year yield. We'll have to see, but we have been testing it quite frequently, but not breaching it, at least in terms of a closing level. Coming up, trade tensions mounting between Washington and Beijing. President Trump says President Xi is extremely hard to make a deal with. More on that next. This is Bloomberg.
Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Double up, 50% tariffs on steel and aluminum kick in. Meanwhile, President Trump struggles to strike a deal with his Chinese counterpart. Salt impasse. Senate Majority Leader John Thune says the president's big, beautiful bill will have to change to pass his chamber. And leaders in private equity flock to Berlin for super return. Don't miss our interviews with Blackstone Vice Chairman Thomas Nides and Ares Management Co-President Blair Jacobson throughout this hour. Let's take a look at how we're shaping up for the Wednesday session. Looks to be another green one. That would make 3 this week if it holds. S&P futures pointed higher to the tune of 0.2%. We have a gain so far this week for the S&P of a whole 1% after 2 positive sessions. It's looking similar for the Nasdaq 100. That index is actually up 1.5% on the week so far. And the Russell 2000 also positive to the tune of 0.4%. Markets, it seems, looking towards the jobs report Friday. And so far, the labour market data this week has been good. That's prompted some selling in treasuries too. You see the 2-year yield back up to close on 3.96, the 10-year at 4.46. And that 30-year yield very close to 4.99. May it test the 5% mark today? Potentially, but will it close above that level? Unlikely. We've seen it test that level and breach it intraday several times over the last several weeks. Well, let's look to some stocks to watch now individually. Here's Joe Easton. Joe.
Hey, Vonnie, so CrowdStrike really the one that is suffering in the pre-market at the moment. We're down more than 7% on the cybersecurity company, actually only missing expectations by a very small amount in terms of the guidance for the year. But that stock had rallied around 40% over the past few months into the report. Now, we all remember, of course, that big shutdown of their system in July. I was traveling myself, stuck in Stansted Airport in a queue specifically. They are recovering from that, according to their guidance, with the stock down once again. Then we've also got Wells Fargo, a big day for that company. They are released from some restrictions that were imposed on the firm around 7 years ago due to concern around their growth and following a couple of scandals. That stock gaining around 3.6%, losing my vision on that one today. Wells Fargo boosted by that news from the Federal Reserve. Then another stock gaining, HPE, that's HP Enterprises stock, up 5.2% today, beating expectations on their AI data storage hardware, according to analysts. That stock continuing to pair a recent decline, so HPE, another one moving in the pre-market today, Vonnie.
Brilliant, Joe. Thank you so much. That is Joe Easton there. Well, back to our headline story. President Trump's doubled steel and aluminum tariffs of 50% take effect.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs. If not for this president, that steel plant in Pittsburgh, Pennsylvania would have closed. Those jobs would have been lost, and the president saved that company, he saved those jobs, and he's saving that community.
Joining us now is Bloomberg's Brendan Murray. So President Trump did follow through. He did sign the order doubling the tariffs. What have we heard from countries that are affected by this now with us, Brendan?
Well, the message from a lot of these countries is that this is going to make the bilateral trade deals that Trump is trying to strike with them harder to reach. This is going to inflict much more pain on their steel makers. We had an Austrian steel maker today saying that this really clouds their outlook. So this is going to make the Europeans even more difficult to strike a deal with. The Japanese will not be happy with this. Remember, they also have auto tariffs on their exports to the U.S., South Korea as well. So this is really going to complicate the Trump administration's goal of striking these trade deals. Now, the U.K. got a 5-week reprieve based on the deal that they struck a few weeks ago. So, and Mexico, which is also looking for some sort of reprieve from Trump's 50% tariffs on steel. So we're seeing a number of countries around the world really frown on what the president has done. Of course, the president would say this is protecting our national security interest in the steel and aluminum industries. So there's a bit of a trade-off here that the administration is playing, and we'll see how it plays out in the ultimate goal of trying to get a lot of these bilateral trade agreements before the July 9th deadline.
And then, Brendan, when it comes to China, we started out the week thinking that it was very possible there might be a call between President Trump and Chinese Premier Xi Jinping. But in fact, what we got last night on Truth Social was President Trump saying that Xi Jinping is, quote, a very tough and extremely hard to deal with character. It seems like, you know, tensions might actually be increasing, and it's a lot less likely, it would seem to me, that we'll get that call, at least this week.
Yeah, that's the way it would seem. Of course, anything can happen, right? You know, you could read that social media post as a bit of flattery, saying, "Wow, he's really difficult to deal with." But most analysts that we're talking to say this is really a sign of President Trump's urgency to get on the phone. President Trump thinks that is the way to unlock the impasse that they're at with China. But China is sending signals that is not the way to deal with them. They want some concessions. You know, there are 30% U.S. tariffs on Chinese imports at the moment. That's putting a lot of hurt on the Chinese manufacturing industry, which some numbers we've seen this week show that is being hurt by the trade war. So we're really at a standoff right now where President Xi is denying President Trump the phone call that he so wants to show that he is the deal-making president that he was elected to be, but that's not happening. And as you suggested, a lot of people think that it's not imminent by any means.
All right, our thanks to you, Brendan Murray. And just on that, we're getting a headline crossing the Bloomberg from Margo Sevkovich saying that trade talks with the U.S. are going in the right direction and at pace, commenting on, of course, a post on X, and this is the EU trade chief, Margo Sevkovich. Jameson Greer is actually on the sidelines of the OECD in Paris right now, and so we'll see if anything comes out of that. But moving to Capitol Hill, Majority Leader John Thune's office says the SALT deal in the House agreed to there may have to change in order for it to pass the Senate. Joining us now is Bloomberg's Josh Gallo, and it seems this is one of the sticking points, one of many, but it's one that Republicans seem to be, deciding that it's their hill to die on. What's going to have to happen in terms of negotiations this week to advance this bill, Josh?
Well, it sounds like there's going to have to be some kind of compromise on the state and local tax deduction, the SALT deduction, because this was a main point coming out of the House. It may not have passed if they had not raised the cap on that. It was set at $10,000, and it's been in the House bill. It moved up to $40,000 that you're able to deduct from your federal taxes. But there are so many concerns about the amount that this bill is going to add to the deficit that people in the Senate are really balking at the SALT the SALT cap, and they want to push it back down. Senator Thune, as you said, has sent a really clear signal now that there's going to have to be a compromise, and we can expect that it won't stay at 40,000 when it comes out of the Senate, but it's going to have to come down because they're looking for revenue to cover all these cuts that they're making. That, of course, would eat into it. The SALT deduction eats into that, and meanwhile, you have other camps that are pushing for not getting rid of the clean energy subsidies that have been in place under the Inflation Reduction Act, because that's supporting a lot of wind, solar businesses in their states that will otherwise not be able to compete or stay in business. So it's really getting down, again, it's down to the plus and minus columns here in terms of what the costs are. And we can expect, though, that there's going to be a change in the state and local tax deduction. Not sure how that'll go over in the House.
Yeah, and as you say, sharp split among conservatives, but also outside of the Senate, we're getting opponents too, including Elon Musk. He posted this on Twitter last night, that the Trump tax and spending bill was a disgusting abomination, and he also said that it was pork-filled. Does this give any more momentum to the opponents of the bill, Josh? Does it hold sway?
It does, more with some than others, but of course, Elon Musk has become a very loud and powerful political voice, and he has signaled in his social media posts about this bill that he is ready to go after people who vote in favor of this if they do. So, in midterm elections next year, you can expect that he is ready to spend money in their districts, and they don't want to have to go up against that kind of political force. He's willing to throw millions into these races. So, that puts these lawmakers in a very difficult position of, going against the desire of Elon Musk or President Trump.
Josh, thank you so much. We appreciate your time this morning. That is Josh Gallo for us. Coming up, we're going to be taking you back to Super Return in Berlin, this time an exclusive interview with Blackstone Vice Chairman Thomas Nides. That's next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We're monitoring very, very closely are the derivative effects. Even if you don't have tariff-impacted businesses, certainly all of the dislocation in the markets would make a CEO hesitant around new business decisions, CapEx decisions, growth decisions. So we're very focused on CEO confidence. It also goes into consumer confidence. Consumer, a big force in the economy, thinking about how they're allocating their spending, especially because it's very discretionary. So I say those are the two areas that we're really focused on from a risk perspective.
Ares Management President Blair Jacobson there speaking to Bloomberg's Danny Berger earlier this hour. So let's go back now to the Super Return Conference in Berlin with Danny Berger. She's standing by with an exclusive interview. Danny.
Bonnie, thank you so much. I'm so pleased to say that joining me now is Tom Nides, the Blackstone Vice Chair, who also previously served as the ambassador to Israel, along with many other government and private sector roles. Tom, thank you so much for joining this morning.
I'm honored to be here.
It's really great to see you, also just because of the wealth of background you bring, that we can get into more than just private equity, which I think is a relief for many here. But we are in this moment where there are a lot of global conflicts going on right now, and global conflicts that when this administration came in, very forcefully said, we want to bring an end to, and we're going to speed that up. It hasn't yet happened. Is America's sphere of influence, has it diminished? Is it still as strong as it once was?
Well, first of all, thank you for having me. It's great to be here in Berlin. Listen, as we all both know, the world is a complicated place, and President Trump realizes, as he did in his first term, things don't turn out right away. So it takes a little time, a little energy, and I'm confident over time, between the Russia-Ukraine issues, the Middle East issues, our relationship with China, over time, the administration will get our sea legs. But America's influence is America's influence. It's about working with our neighbors in NATO, in not only in Europe, in Asia, around the world. It's create a sense of community, and which is why it's important. That's why I'm here. That's why I'm in Berlin. Look around here. This has brought the world together for this conference.
It's true, but I mean, we are in Europe. That's brought somewhere together. The things you say about building community, you could argue that that's been challenged by this administration this year.
Listen, again, we know President Trump. President Trump has a negotiating style that some people like and some people don't. But at the end of the day, our resolve to work together as a community in NATO, Europe, certainly from Blackstone's perspective, this is a really important region for us. In our view, we'll work together as we see all these challenges. And there's a lot of challenges. The world is a complicated place. But as we see each one of these issues, we'll talk about them and try to get through them.
They are quite complicated. We have seen in Israel, Benjamin Netanyahu, the prime minister, saying that the operations they're doing in Gaza are in order to bring an end to this war. Is it realistic that we could soon be facing an end to the conflict?
God, I hope so. Listen, I talk to the hostage families almost every week. Hamas needs to give the hostages back, okay? Number one. They need to put down their arms, absolutely. Number two, Israel needs to do a better job on the humanitarian crisis. I've said it over and over and over again. We can feed people, and we can get rid of Hamas at the same time. And yes, the war needs to end. It's not good for Israel. It's not good for the Middle East. But we need to get this resolved. But most importantly, we need to get these hostages home, and we need to continue feeding people. Innocent Gazans need to be fed.
Well, I know at the start of the year, you penned an op-ed saying that the number one goal, the number one thing needs to be that concentration on hostages. Of course, the humanitarian effort important too. Has this administration done enough work to help speed that up when it comes to Israel? I know President Trump also was very clear when he came into office that the hostages needed to be brought home or there would be hell to pay.
Listen, Steve Witkoff actually I guess maybe in December, right before the Biden administration ended its term, stepped in, even though he didn't have to help release probably another 15 to 18 hostages. So I give him credit for that, and the Trump administration credit for that, even before they even assumed office, the inauguration. That said, there are more hostages. There are more bodies of kids sitting in Gaza need to be returned. So obviously, the Trump administration Bibi Netanyahu, but most importantly, let us not forget, it's Hamas's responsibility to give these people back. And they took them in the first place. They kidnapped people in the first place. But as I like to say, our goal as a country is to do everything we can to eliminate the threat of Hamas, but most importantly, bring these hostages home.
Along with your wealth of experience, you also sat in USTR. The administration has a lot on their plate, a lot of trade negotiations to be done, a lot of deadlines coming up. How realistic do you think it is for them to achieve these types of deals?
Well, as John Gray, who's the president of Blackstone, likes to say, we're in the midst of tariff diplomacy. And tariff diplomacy is difficult. You're right, I was at USTR. These trade agreements can't happen overnight. You can announce frameworks, as the president has done in London. But as you know, these are detail by detail negotiations. It's like you look at my tie and you decide, well, you can't just put a tariff on the tie. It's the thread inside the tie. So each line of each negotiation. So as President Trump knows and understands, these are going to be complicated. So my hope is over the next few months, and quite frankly, maybe over the next year or so, that they will get these trade agreements resolved. But it's going to be tough and difficult, but we'll get through it, and that's why it's called, tariff diplomacy.
Tom, that sounds like more uncertainty, and as you know better than me, business hates uncertainty. What does that mean for Blackstone and the many, many companies you work with who have to navigate, again, maybe even a year where we don't necessarily get those deals in hand?
It's interesting. We're in a unique place. Blackstone is a unique place. I mean, again, I've only been at Blackstone for a year and a half, so I can brag about it without feeling like I'm an egomaniac. But we're a unique place. First of all, we have an enormous amount of capital. So in a time of uncertainty where people, obviously the capital markets aren't robust right now, so they come to us to look for the ability to invest. So between our private credit business, our infrastructure business, our core private equity business, we're very much open for business, and we've done a really good job both in Europe. We have a massive business here in Europe. We have a massive business in this neighborhood, importantly so. And so from our perspective, the uncertainty, although it is uncertain, is beneficial to how we think about our investment thesis. And remember, we're investing for the long term. We're not really, yes, are we aware of what's going on in the next 3 months or 6 months? Of course we are. But we're investing for the next 5 and 10 years, and our clients are doing so as well. So yes, it is uncertain, but we seem to be able to thrive during this uncertainty.
You could argue, though, that we're going under a structural change that will impact the next 5 years, that global business is being rewired, that the lines of trade that were usually open are getting challenged by what we're seeing from the Trump administration. Does this industry that really thrived off of the idea you grow a business and you grow it internationally, does that business model also come under strain?
It's interesting. You look at that, so you say, okay, we have a massive infrastructure business, okay? We've talked about our data center, our port business, our energy business. Those businesses aren't going away. Those businesses aren't going away because of tariffs. AI isn't going away. In fact, it's only expanding. Healthcare isn't going away. It's only expanding. We have a massive healthcare life science business. So you have to innovate. One of the things that C. Schwarzman and John Gray and the leadership of Blackstone has done, you got to keep innovating every day. You got to come up with new products. You got to have new ways of going to market. You have to think about it, and that's what I think why this firm is. I'm actually leaving on Monday to go to London to celebrate our 40th anniversary in our offices in the UK. You have to innovate. You have to think about what a good neighborhood is, and you got to invest in those neighborhoods.
You mentioned AI, and I know that this is an area that you, like so many others, are also investing in. I wonder what you make of the Anthropic CEO telling Axios that he thinks 50% of white-collar jobs are going to be wiped out in the next 3 to 5 years. Of course, that is something that would affect Blackstone heavily, considering the talent pipeline that comes in. Do you think that's actually a realistic change that might happen?
I don't know. I think some could have argued that the intervention of the internet had also a massive impact, and it did. It will, and there's no question about it. You and I are living this right now. How we're going to have to, people have to rethink their training, think about new jobs. Listen, I have a 30-year-old and a 27-year-old. I know you're thinking you're so young to have such old children, but I know you were thinking that. And I think the reality of this is, I think, innovation, people will have to innovate. They'll have to think about new skill sets. So I can't tell you what's going to look like 5 years from now, but AI is not going anywhere. That's why we made a bet, 5 years ago when we bought a company called QTS and then ultimately Air Trunk. We believe the innovation is going to continue, and that decision was made because of the importance of the phone and the computing power. Can imagine the needs of this as going forward. So yes, it's definitely going to be a challenge, and people are going to have to think about their education and think about what their futures are.
Well, we're going to have to leave it on that question mark. Hopefully next time we talk, it's me interviewing you and not an AI chatbot.
I only hope so, okay?
Tom, thank you so much for joining. Really appreciate your time this morning. Bonnie, that is, of course, Tom Nides of Blackstone.
Danny Berger there at Super Return in Berlin. Fantastic interview, and thank you so much. Coming up, we'll get you set up for your trading day with Fed Speak and lots more earnings on deck. This is Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now let's take a look at what's ahead today. Another jobs data point coming your way with ADP employment. That's at 8:15 Eastern, of course, ahead of the all-important jobs report tomorrow. Then Atlanta Fed President Raphael Bostic and Fed Governor Lisa Cook moderate a roundtable at 8:30 a.m. Eastern. And then we also get ISM services data out at 10 a.m. Eastern, so plenty of economic data points. And some micro movers, CrowdStrike extending post-earnings losses on underwhelming sales forecasts. HP Enterprise higher in early trading after earnings that beat expectations. And Wells Fargo also rising as the Fed lifts the asset cap that restricted its size for more than 7 years. That's it for Bloomberg Brief. Surveillance is next. This is Bloomberg.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Uncertainty affects the economy in a variety of ways. The economy is much better shape than people think.
The economy slows, but doesn't tip over into recession.
The choppiness that we're talking about, we will come through that hopefully with stronger economic elements on the other side.
We're calling this the summer of mud. It means that we're just stuck in this muddle through.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The summer of mud doesn't look so bad. Good morning. Welcome back to Bloomberg Surveillance. It's ISM Services Wednesday ahead of jobless claims Thursday and payrolls Friday, barreling toward a new bull market with the S&P 500 surging nearly 20% since April 8th. Tech darlings basking in the spotlight once again. Investors rekindling their love affair with all things AI, shrugging off worries about tough rhetoric between the U.S. and China as ongoing budget squabbles continue in Washington, D.C. Damian Sassower back on the hot seat for the hour. Thank you so much for being with us. Is this what a bull market feels like?
Well, I don't know. I mean, Eric Robertson's on the tape talking about a bull market, not in equities, but in fixed income and FX. He thinks that lower oil, weaker dollar, the fiscal stimulus that's coming out of China, the U.S., EU, as well as all the monetary stimulus in emerging markets, money markets are mispriced here in the U.S., and so I can't really disagree with him on that.
Honestly, it's sort of this tale of two worlds. Either we're talking about suddenly a recovery, that where all the best case scenarios come to fruition, we get some trade deals, and potentially the resilience of the U.S. economy keeps powering it along, or you get a slowdown in growth that gives the fixed income bull market. So has everyone forgotten about the bill in Washington, D.C. that Elon Musk yesterday called a disgusting abomination?
Well, I think the equity markets have forgotten about it. Certainly if we ask our guest that, I'm going to surprise you. But I mean, basically, yeah, no, it looks like the equity markets and many of the companies that should be primed to benefit from the big, beautiful bill are just not reacting the way they should be. And we'll see if there's still some premium left in those stocks and in the sectors that are supposed to do well.
In the meantime, I was going to call it Beige Book Wednesday, but I didn't want to get that much hate mail. I am curious about what the data is actually telling us about how much people are primed to celebrate anything that isn't bad. The fact that we got a job openings data yesterday that came in higher than expected, this is messy data. People have undermined it for years. The fact that people were looking at that saying, oh, quits rate was solid, it's fine, even though it ticked down just a touch. Does that give you a sense that right now the bias and the indication for this market is to creep higher?
Well, it's going to be interesting on Friday with payrolls just to see which parts of the labor force are doing well and which ones aren't. Is healthcare actually, doing well? Did it do well in May? Which ones aren't? So, I think you're right. I think there's a lot underlying a lot of these data prints. There's a lot of information there that the markets have yet to kind of really react to, and there's a lot to learn from.
Right now, what we're reacting to is everything positive. That seems to be what's going on in markets. We can see equity futures indicated upward, not even trying to go down as they had for the previous 2 days, just adding to some of the gains. The best two-day rally in about a month, which you could see is adding to that with a 0.2% gain on the S&P. A little bit more dollar weakness. This has been a story that has been ongoing despite that bull market that we seem to be approaching with nearly 20% gain since April 8th. 10-year yields just marginally higher, creeping up, not yet seeing that bull market in fixed income and crude, just marginally higher. So let's get to that guest. Coming up, we've got Savita Subramanian. We're so lucky to have her of Bank of America following back-to-back gains on the S&P. Wendy Schiller of Brown University as Trump doubles steel and aluminum tariffs, and Michael Reed of Royal Bank of Canada, RBC, counting down to May payrolls. We begin this hour, stocks holding on to 2 days of gains as traders await more labor market data. Savita Subramanian of Bank of America writing this: although the S&P 500 has round-tripped back to near levels we saw at the beginning of this year, benefits may not be fully priced to particular areas of the market. Savita, thank you so much for waking up early and being with us here this morning.
My pleasure. This is great.
So let's start with what you make of the rally that we've seen so far. This 20%, almost 20% rip-roaring rally that's just come as a drip feed of bad news stays out there.
Yeah.
But the good news has been corporate America.
Exactly. I mean, I think that's the story, is this decoupling of U.S. government policy uncertainty with the corporate sector, which is actually relatively nimble in navigating policy changes. They just need numbers. And I think that's what that's where we are now, is this environment where companies have been able to manage a lot of pressure to margins over the last few years. Today, they're saying they can handle tariffs better than they could back in 2018. You know, a lot has changed since Trump 1.0, but I don't think that companies are getting credit for the idea that they've managed to maintain margins during this massive inflation and rates shock that we've seen already.
Have we actually seen it, though? And I think that that's really the key question. Have we really understood the scope of what these changes could mean, given the fact that we don't know what these changes are still?
We still
there
don't
is
know.
About a month left in these negotiations.
Yeah.
And there's increasingly heated rhetoric between the U.S. and China, let alone a question about whether this bill will even get passed.
Yeah, you know, I think there still is a lot of uncertainty. And I think, you know, I guess when I look at uncertainty, I don't think that we're at new levels of uncertainty. I think that we've always been in an uncertain environment. And, you know, for the last 20 years, it's been kind of unnerving that interest rates have been falling to these uber low levels, and we've been kind of worried about how we're going to get off of that zero bound. We're off of it. We've seen corporations exert efficiency gains. So I think we've seen a lot of proof of concept that corporates can handle uncertainty. You know, I think when I look at earnings season, what worries me is that companies are in a little bit of a kind of pause mode. So if you think about committing new capital to projects, it's really hard to do that right now, right? I mean, it's really hard for us to do that as consumers. So I think that there's an environment where you think about inflation uncertainty, you think about this sort of global, who are our friends, who are our enemies in the U.S., and it's all changing at a very rapid clip.
So who are our friends and who are our enemies in the equity market? And by that, I mean your team's done a ton of work on the companies that are poised to benefit from Trump's big, beautiful bill, right?
Yes.
I think you said those companies would have a high beta to real year-over-year wage growth.
Exactly.
So talk me through those companies. Talk me through why they're not performing the way they should in this environment.
Right. No, I think it's interesting because, you know, there's been this narrative that the U.S. consumer has to roll over because of all of these curveballs thrown, like, you know, higher interest rates, you know, the depletion of savings from COVID. The U.S. consumer has done pretty well. The only area that we've seen fraying is that lower income cohort. And I think that cohort is still pricing in more risk than benefits. But when we look at the big, beautiful bill, it's actually quite friendly to that lower and mid-income cohort. So if you think about more take-home pay from no taxes on tips, no taxes on overtime, if you think about even, you know, the SALT cap, the SALT reductions were capped at a certain income level. So it does seem to be skewed more towards President Trump's base, which has been the one area of the consumer spectrum that has been showing signs of weakness. And, you know, that's where inflation is felt most acutely.
a few weeks ago when we spoke, the world was in a very different place. Certainly the equity market was. I mean, vols were considerably higher than where we are now, and you rightly pointed out that this might be the right time to, write some equity protection, take on some income. What about now? Where are we now? Because, to me, I look at volatility in the FX and the fixed income markets as well, and it's relatively well behaved. I'm just curious to hear what your team is seeing there.
Yeah, I mean, equity volatility, I think, is going to remain at a higher kind of run rate over the next few years for a number of reasons. One is the fact that we have been in this ample liquidity flowing into equities environment, and now we're starting to see liquidity withdrawn, and that's the number one reason that you see volatility tick up. I think that the S&P 500 is well poised for that environment because if you look at corporations since 2008, what they've done is get higher quality. So they've paid down debt, they've sort of locked in low fixed obligations over a long tenure. So we're in an environment where I think you've got a corporate sector that's really healthy, very high quality from a balance sheet perspective. Corporate earnings have kind of decoupled from a lot of these credit indicators. So, my sense is that volatility could remain elevated, but it's not necessarily an environment where you want to sell all equities. In fact, a lot of equities could do really well in this sort of inflationary backdrop. And, going back to your point about extremes, we've either been extremely bearish or extremely bullish. I think you're right. I think we're in this environment where all we're thinking about are the tails. And there's this big middle ground, which is the base case, right? I mean, normally we're in kind of a Goldilocks or a pseudo Goldilocks environment. And I think that's kind of what's in place right now. If you think about inflation levels, if you think about average hourly earnings, real wage growth, the jobs market, not too hot, not too cold. The Fed's not cutting, the Fed's not hiking.
Hold on. You're saying that right now this is Goldilocks.
I mean, it doesn't feel like
Goldilocks.
It doesn't feel like Goldilocks.
I'm curious. It's one thing if it's Goldilocks right now.
Yeah.
But equity markets, as you know, are a forward-looking instrument.
Yes.
So you have to try to game out some situation.
Yeah.
And good luck coming up with the parameters for that situation. What is this new normal? I mean, are we looking at higher inflation, lower growth? At what point does that become punitive? And does that really change the scenario for an equity market that grew up under the tutelage of a Federal Reserve that was really easy and that was really kind of gifted by this idea of low inflation for a very long time?
Yeah, well, here's the thing. High inflation doesn't always have to be accompanied by lower growth. In fact, most of the time, higher inflation is accompanied by higher growth. And I think that's what we could be moving into. I mean, when you think about most environments, inflation has actually been good. It's only during these very rare stagflationary environments that inflation has gotten too high and has actually started to choke off growth. And I don't think we're there. I mean, I just feel like we're at a point where there are puts and takes. There's efficiency gains from tech that are going to put a cap on inflation. I mean, tech is disinflationary and it's still in force, right? Think about disruption around professional services jobs. That's disinflationary. But then you've got this tighter immigration, a tighter labor market, which is potentially inflationary. So there are puts and takes in most of these areas of the economy. Oil has come down a lot.
So in other words, if the bond yields out there that are rising have scared some people, how much can you say to them, don't let this scare you? Because this is bond yields rising and bond prices falling for the right reason, not the wrong reason.
I think that's right. I mean, when you look back over history, bond yields aren't really that high today. And I know this sounds crazy, but pull it up on the Bloomberg, pull up, 10-year yields going back to the 50s. We're kind of average. And if you think about real rates, they're not necessarily at levels that would make me worry. I mean, I know this is weird coming out of a zero interest rate environment, but I think we're just anchoring to the last 20 years and not necessarily thinking about, the full spectrum.
We are going to carry that conversation forward because there's a big question about, yes, it's not that strange. At the same time, the rest of the world has started to look very strange with valuations.
That's true.
Does that start to check?
Real yield differentials with the U.S. are widening and the dollar's declining.
So you
get a rate strategist in here. We're done, Savita. No, I'm just kidding.
No, absolutely, we are not done with Savita. Savita Subramanian at Bank of America will be sticking with us for the hour, which is a good and beautiful thing. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anna and Yahaira.
Hi, Lisa. President Trump has signed an order doubling steel and aluminum tariffs to 50% effective today. Trump says the additional levies will support domestic industries and eliminate what he calls the national security threat of imports. Tariffs on the UK will remain at 25% to allow the two sides to work on new taxes or quotas by a July 9th deadline. Staying on trade, U.S.-China negotiations may be keeping President Trump up at night. He posted on Truth Social just after 2 a.m. Washington time, writing, quote, "I like President Xi of China, always have, always will, but he is very tough and extremely hard to make a deal with." The Post is raising questions about whether the two leaders will have a call in the near future, as the White House has promised. And Dutch Prime Minister Dick Schoof has resigned, setting the stage for a snap election. He was forced to step down after far-right leader Geert Wilders pulled his Freedom Party out of the coalition government over a dispute about asylum and immigration policy. Schoof will continue in a caretaker role until a date is set for fresh elections. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Walking the Walk.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs.
Wendy Schiller of Brown University joining us next, and can I say, I don't think he sleeps. I think that he is one of those people who just doesn't need it, which is pretty impressive. This is Bloomberg Surveillance.
Headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Building on 2 straight days of gains as the S&P 500 careens toward that bull market, up nearly 20% since April 8th. Now adding to that with 0.2% gain on the S&P, on the NASDAQ, Russell up about 1/3%. Really a question is, are people overly shrugging off this question of how feasible is it for Congress to get that big, beautiful bill passed by July 4th? Under surveillance this morning, walking the walk.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs. If not for this president, that steel plant in Pittsburgh, Pennsylvania would have closed. Those jobs would have been lost, and the president saved that company, he saved those jobs, and he's saving that community.
Here's the latest. President Donald Trump raising steel and aluminum tariffs from 25% to 50%, escalating concerns about U.S.-China trade negotiations negotiations. Trump posting on Truth Social earlier this morning, "I like President Xi of China, always have and always will, but he is very tough and extremely hard to make a deal with." Bloomberg's Tyler Kendall joins us from Washington with the latest on whether he sleeps and what is ahead for the day when it comes to some of these trade negotiations.
Yeah, hey, Lisa. Well, it definitely feels like these trade tensions are escalating when it comes to China after the thawing that we saw last month. And former acting chief of staff Mick Mulvaney perhaps put it the most succinctly in an interview with Bloomberg Television earlier this week that there is a, quote, fundamental disconnect here between the two leaders that we're seeing play out. On one hand, we know that China would like to see key advisors iron out the issues before putting Xi Jinping on the phone, whereas President Trump wants to take that call directly, and it appears he wants to take it now. And I can tell you that the sense out of the White House is that officials do feel that direct contact could help perhaps speed up easing some of these differences. I spoke with Deputy Treasury Secretary Michael Falkender earlier this week, who told me eventually these two leaders are going to have to get on the phone, perhaps to address one of the biggest sticking points at the moment for the U.S., and that's accusations that China is slow-walking the export licenses when it comes to critical and rare earth minerals that are essential to supply chains here in the U.S. Now, of course, the other side of this is that those accusations go both ways, that both sides are violating the trade agreement reached in Geneva as China raises concerns about new AI chip controls or plans to revoke Chinese student visas as just two prime examples. But Lisa, some pretty incredible reporting from Bloomberg News this morning, which adds a new dimension that we're going to be watching closely here, which is that China is considering buying hundreds of Airbus aircraft in a bid to shore up ties with Europe amid this escalating trade war with the U.S. Now, people familiar caution that the plans are not confirmed yet, but it's likely not welcome news for Boeing or for President Trump either.
Bloomberg's Tyler Kendall, thank you so much. As always, we'll be catching up with you for some more in a little bit. Wendy Schiller of Brown University joins us now. Wendy, wonderful to see you. Thank you so much for being with us. I want to start with the idea of some of these trade negotiations as part of the three-pronged stool that President Trump's administration has put out there. What do you make of the progress being made, both racing ahead when it comes to trade deals as well as the deficit discussion down in Washington, D.C.?
Well, Lisa, I think that they are related in the sense that President Trump wants to shore up, particularly in the Senate now, Republican support for his big, beautiful tax bill, and to settle the trade environment and not put inflationary pressures on the U.S. economy, and also sort of raise consumer fears about future price increases. That's really important, not only for him, but also for members of Congress that have to go back to their town halls and hear all about people's concerns. First, it was DOGE and the budget, and now it will soon be inflation, deficit spending, bonds, treasuries, all those sorts of indicators of economic health. So it's important for the president to inject, I think, more stability into his trade negotiation persona or platform, because that will also affect Congress's, particularly the Senate's, willingness to try to really pass this bill by July 4th, which was supposed to get passed, as we recall, by Memorial Day, and that deadline came and went.
Wendy, China's lead negotiator with the United States, He Lifeng, says that the nation is ready to discuss all major issues with the U.S. Does that include Taiwan? I mean, what sort of messaging do you take out of that?
Damien, I think it's a treacherous path for the president and his staff to sort of conflate, not sort of, just conflate tariffs and economic policy with our military stances. You know, he's got a complicated situation with Ukraine, a complicated situation, obviously, with Israel, Gaza, and the Taiwan issue is something that if it's loaded up onto the plate without really a consistent U.S. foreign policy right now, that will complicate his negotiations, not make them simple. And I think the president likes to cut deals, and he likes to cut relatively clear, straightforward deals where he can claim victory. Taiwan's going to be more complicated, and it puts the United States in a position that affects its military stances in other conflicts around the world.
Wendy, Treasury Secretary Bessent's on the tape discussing global imbalances and points to China's inability to shift from an export-oriented economy to one that's driven by consumption. I mean, this flies in the face of decades of conditioning, as Chinese households' propensity to save is grounded in an overall lack of trust on Beijing themselves. So, you know, what do we really hope to accomplish here? You know, what comes next? What is Treasury Bessent really trying to accomplish here? I'm just curious.
I mean, I think Treasury Bessent has seemed to, from what we can tell, exert influence on the president, right? Stabilizing the president, getting to back off really huge tariffs, and and trying to add more consistency and more justification for the tariff policy. So I think his public remarks about China and saying, okay, you've got an economy that really depends on the United States consumption tendencies, and we want to produce more of our own goods. Let's strike a balance so that we can do that, and you can still have U.S. markets, but you've got to shore up your own consumptive markets. I think that's a sensible public persona when you're trying to get China to come to the table. You know, what that actually results in terms of internal economics in China, we'll have to see. But on the steel plants, you know, we've lost hundreds of thousands of jobs in steel over the last 30 years. And we can't bring steel back completely at all. And it was interesting that the president's going to take credit for saving existing jobs that are in the United States. And they're relatively small compared to the rest of the economy. So there are some imbalances we will not be able to fix.
Wendy, you know, I'm curious. So we've been in an environment where demand for U.S. assets, bonds, equities is sort of imperiled. Do you see Section 899, which is this remedy against foreign, you know, unfairness in foreign taxes, do you see that as a big hit to demand for U.S. assets?
Well, and I think it produces instability. I mean, the president could wake up in the morning or in the early hours of the morning and decide, okay, I'm going to change the rules of the game today. And that just wreaks havoc, you know, on markets, but also on small business people. And then, you know, as they in their own communities get concerned and get worried and think about passing on costs to consumers, then those consumers in those communities start to worry about the economy. And we've seen some real dips in consumer confidence. So I think there are ripple effects to this sort of ping pong or yo-yo-ness of the president's trade positions. And certainly we rely on the rest of the world and internally to buy our treasuries to float our debt. And that's where the really big debt ceiling increase comes in. And that's what Rand Paul is complaining about, that it's not just deficit spending, it's also creating, you know, unsustainable, literally unsustainable debt, because sooner or later people will stop buying it. And if they stop buying it, you know, we have no way of floating our expenses.
Wendy Schiller of Brown University, thank you so much for being with us. It's not just Ron Paul, it's also Elon Musk, who's come out over the past few days and called this bill a disgusting abomination.
Abomination. I love, you know, it's a great choice of words. No, but I think it is interesting. And some of the congressmen who pushed the bill, I mean, they've pushed back on Elon Musk and saying the reason he's not happy is with the EV stations and all the things that are layered in there. So he's got some self-interest, and I really can't argue with that either.
Well, we actually saw Tesla put out something about how these EV credits, if they're taken off, will really push back the industry in a pretty serious way. I'm curious what you think about Section 899 and how concerned you, Savita, are about that possibly getting in through the final bill.
Yeah, I mean, I think that Wendy is absolutely right. It just adds to this layer of uncertainty, this inability to actually plan. I think that U.S. bonds are imperiled by this aspect because, you know, again, everything we're seeing right now is putting pressure on the long end of the 10-year. I think, you know, if you're right about the short end, we're in an environment where the yield curve is actually, you know, could potentially steepen. I think that's good for some sectors and bad for others.
And that's the reason why people are keeping an eye on that 30-year bond, the risk asset, as J.P. Morgan's Bob Michael has called it. Coming up, Connor Teskey of Brookfield Asset Management will be joining Danny Berger over in Berlin. He'll be talking about mergers and acquisitions under Trump and how much they can revive in the second half of this year. This is Bloomberg Surveillance.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Can we make this day 3, the first 3 days of the month of June, potentially following May in very much the same way, which is very much a rally and potentially leading to what looks like increasingly a bull market in the S&P 500, building on gains that are almost 20% since what we saw on August 8th, up about 0.1% in the S&P and the NASDAQ, outperforming yet again this morning the Russell 2000 futures as people take a look at whether maybe some of those smaller companies have been a little overlooked. Right now, we are looking at 3 hours away from the cash open. Your morning movers with Yahaira Anand. Yahaira.
3.6% on big news that the Fed has lifted the asset cap that has shackled the bank since 2018. It marks a new era and is a major win for CEO Charlie Scharf. That's because, according to our calculations, the cap had cost Wells Fargo an estimated $39 billion in lost profit. But now, for the first time in 7 years, the bank can grow its balance sheet, gather deposits, and boost lending, and of course, boost its trading and investment banking. Next up to the downside, we have shares of CrowdStrike. Those are down 7% now after the cybersecurity company gave a revenue forecast for the current quarter that fell short of analyst estimates. Part of that is fallout from last summer's global IT outage tied to a software update from the company. After that, it offered customer commitment packages, and the CFO says those are still dragging on revenue and will do so for the rest of the year. And to the upside, we end with Hewlett-Packard Enterprise. Those shares are up 6% after the company said that tariffs will hit profits less than expected. CEO Antonio Neri saying the impact is more mild than feared. Meanwhile, AI demand continues to grow for the server and cloud software company. It pulled in $1 billion in revenue related to AI, beating estimates, though still trailing its rival Dell Technologies. Though investors seem past that this morning. Lisa?
Thank you so much, Yahaira. On our radar this morning, continuing with the tariff discussion, President Trump doubling steel and aluminum tariffs to 50%. The White House casting the move as necessary to help domestic manufacturers and protect national security. This is a real question, Damien, going forward about whether this is just the beginning of what we might see in terms of sectoral tariffs.
Yeah, well, I think policy transparency, while that is important, policy credibility here is everything. And I think, our last guest just pointed it out perfectly. The uncertainty, the volatility off the back of that, and the inability for businesses to make decisions is really key here.
Yeah, I mean, I think that tariffs are being discussed by corporates, though, in a much more mitigation-oriented way. So, I mean, it's interesting because our analysts think that at least 70% of companies can pass some or all of the potential price increases on to the consumer. So I think that there are a lot of nuances here, and what we've heard from corporations is far more positive around tariffs. Also, we've seen the rates come down demonstrably, but I think that the idea that tariffs are going to be just an immediate margin hit is not necessarily the case. That oversimplifies the problem.
Well, a little less subtle, perhaps, is the ex-post that we got yesterday from Elon Musk condemning President Trump's big, beautiful tax bill, calling it, quote, a disgusting abomination, saying it defeats the purpose of Doge cost-saving efforts that he had been working on. To me, this really highlights one of two things. Either this shows the divorce that a lot of people thought was going to happen, or the decoupling of Elon Musk and Donald Trump, or it's an apology tour to revive Elon Musk's view in the eyes of shareholders at a time when his companies are feeling the brunt.
It's a very interesting point. I mean, look, Lisa, this comes down once again to credibility, be it shareholder credibility, you know, constituent credibility, and the lack thereof in the Trump administration and those that are affiliated to it. But here's the interesting thing, just to go to that trade argument. I mean, you know, what does this all mean? I mean, I agree with you. Supply chains can correct themselves. They've proven to be pretty nimble and pretty, given what happened during COVID. But, you know, where are the bodies buried? You know, who is going to bear the brunt? Is it going to be dumping into emerging markets? Is that going to suppress inflation domestically there, which allows them to cut rates more and stimulate that much more, raising their debt loads? I mean, again, these are the things that you have to kind of think about.
Hold on a second. And Savita, I want your thoughts on that. And this sort of speaks to that. China considering order hundreds of Airbus jets as soon as next month when European leaders visit Beijing. Sources telling us here at Bloomberg that negotiations are still underway. A deal could involve about 300 planes, but really it ups the ante, Savita, and it kind of goes to what Damien is talking about, which is how much China is trying to really reignite some of its relationships with other countries, Europe, emerging markets, and using them, sure, as dumping grounds, but also as replacements to the United States.
Right. Absolutely. I mean, I think it's just bolsters the U.S. out of U.S. into rest of world trade. But I mean, historically, and I don't know if it's that different today, what's good for the global economy is usually good for the U.S. corporate sector. And I think that could prove to be at least partially true going forward. So when I look at positioning, I don't see investors set up for a global economic boom. I see them set up for stagflation. I see them set up for, you know, some kind of muddle, but not necessarily a global economic boom. I think that's what we should be gearing expectations to, because to your point, we are seeing a lot of signs that the rest of the world can kind of get out of its own way and really do something interesting.
Well, I think, and I think the way that outlet comes out in the market is in currencies. And I think that's what you're seeing right now. That is that's where you see the differentials kind of really hit.
And we're going to be talking about that more in just a bit. Right now, though, I do want to take you back to the Super Return Conference in Berlin, where Danny Berger is standing by with a special guest. Danny.
Lisa, thank you so much. Indeed, I'm pleased to say that joining me here is Connor Teske, the Brookfield Asset Management president. Connor, thank you so much for joining. Really wonderful to see you here in Berlin.
Thank you for having us. It's great to be here.
Look, it is a first half of the year that's felt like a decade. And within that, Brookfield is very global, from every corner of the world to infrastructure, to real estate, to buyouts. In this moment where it feels like we're rethinking global trade, has there also been a rethink in where capital is being deployed?
There's no doubt that things are evolving, but they're always evolving. This is no different than some of the different trends and supply shocks we've seen in recent years. And what we're seeing on the ground is relatively constructive. Businesses are performing well, capital's flowing, capital markets are very, very robust right now. And the key themes that have been driving our investment in recent years, they're not continuing, they're accelerating.
Surely there's pain somewhere, Connor. I mean, you look at the fundraising for this industry. The first time in the first quarter, no fund has raised more than $5 billion in a decade. So where is that pain if you're not seeing it?
So maybe to contextualize the comment that the sentiment is good, no doubt the sentiment is stronger this year. And the way I'd characterize it is perhaps 12 or 15 months ago, market participants were waiting for pockets of stability to start doing work on transactions or raising capital or large initiatives. This year, it's the opposite. Market participants have done the work. They're sitting there. They're ready to go. The hand's on the button. And if we could get a short period of pockets of market stability, a short pocket of market stability, we think all that pent-up demand and volume of activity that people were expecting at the beginning of the year, we think it unlocks very, very quickly.
What's the likelihood we get a pocket, though? Because it has been nonstop volatility.
We'd be pretty encouraged. And what's driving that is, well, some parts of the market are a bit slower, as you say. Large transactions, certain public market transactions are difficult in a volatile environment. Other parts of the market are seeing tons of activity. Within our private equity business, we're seeing a huge increase of activity in things like partnerships and corporate carve-outs, where you can bring more than just capital, but also operating capabilities to bear. And we're seeing that on the infrastructure side. Just this morning, we announced a $10 billion infrastructure, digital artificial intelligence infrastructure partnership in Sweden. A couple months ago, earlier this year, we launched a partnership with Barclays Bank in the UK, where we're going to partner on their electronic payments business. So we're still seeing lots of activity. Maybe it's just not so much in the buyout business that often generates the headlines.
It's interesting. As you know, I ask about fundraising. There have been reports, Apollo and KKR have talked about on their earnings call, that there have been some government influences, especially from foreign LPs, to invest in very U.S. type brands of funds. Yeah. Does it help to be Canadian right now?
You know what's interesting is we get that question a lot, and what's sometimes underappreciated about Brookfield is we're known for investing capital all over the world. We also raise money all over the world, and the one thing that is always constant is there is an ongoing evolution of where capital is coming from and where it's being directed. And for years, that's been driven by politics, that's been driven by business performance, that's been driven by liquidity. It does feel a little more sensitive right now because some of it is driven by geopolitics, but the capital reallocations we're seeing are not unnatural in the history of what we've seen, and it's certainly not changing our investment themes or what we're seeing in terms of opportunity or valuation.
To be specific, how is the geopolitics affecting that flow? Is it that your American rivals are getting less? They're looking for other types of funds?
I would say it's different everywhere around the world, and you're seeing it in many different ways. I feel like Europe is getting a lot of focus right now. It's seeing perhaps more activity today than people expected earlier this year. But at the same time, the U.S. is still the largest and deepest market around the world. We've been very active there in the first half of the year, and we expect to continue to be. Large organizations such as ourselves, we're well positioned to navigate some of this uncertainty and perhaps capitalize on the opportunities it presents.
Connor, but before I let you go, I do want to talk about one other risk that's been presented. And it's that AI spend on things like data centers is too much. Joe Tsai of Alibaba has been one of the chairman over there. He said, oh, it's a bubble. We're spending too much. When you're committing these levels of capitals to these huge products, how do you ensure that it doesn't turn from a boom to a bubble?
What's incredible about the capital that's being deployed into AI infrastructure, whether it's the shells or the racks, whether it's the power that supports the data centers, whether it's investing in the chips and the servers, moving up and down the value chain. What's different about this type of investing is it's all backed by long-term contracts with some of the largest, fastest growing, most profitable companies around the world, the large hyperscalers. And that's certainly a tremendous support for the business and gives us incredible confidence. And what we would say is while more and more capital is being deployed into the space, the demand still certainly outweighs the supply. The supply-demand imbalance is in favor of those that can provide that capacity where the market demand is overwhelming.
Well, we look forward to learning about more deals like your Sweden one today. Congratulations on that. And Connor, thank you so much for joining. Really generous with your time. We appreciate it. And Lisa, with that, I'll send that back to you. Connor Teskey, the Brookfield Asset Management President.
Thank you so much, Danny. Great work this morning. And there's a real question and focus around private credit markets, not just in alternative asset management, but also in some of the public markets. And we've seen that increasingly, Saviti, even when it comes to equities.
Yeah. I think at the beginning of the year, there was this expectation that we're going to see a massive IPO boom, massive M&A activity, and it's been crickets. I wonder if that changes. I mean, I think that there are a lot of IPOs, like companies waiting or private enterprises waiting to go public. that are not tethered to this higher interest rate environment. So I think that's why we've seen this pause in IPOs, is that these companies can't get the prices they want in the IPO market. I think it's interesting, though, you know, the Canada angle. I mean, Canada looks really interesting right now. It's got better balance sheets. It's got, you know, they're selling hard assets, new government. I think this is an interesting area of the economy that doesn't get as much playtime as, say, Europe or, you know, emerging markets. But it's also interesting to hear, you know, the guests talk about, the speakers talk about how they're seeing more opportunities outside of the U.S. than maybe a couple of years ago.
Yeah, a lot of people have been looking elsewhere, potentially, that they've overlooked the rest of the world. Right now, let's get you an update on stories elsewhere this morning. We have not overlooked the Bloomberg Brief with Yahira Anand. Yahira.
Thank you, Lisa. Well, Senate Majority Leader John Thune says the House SALT deal will have to change. The House increased the maximum deduction to $40,000 in President Trump's One Big Beautiful Bill, which is now making its way through the Senate. But lawmakers like New York Representative Nick LaLota are pushing back, warning changes could sink the bill. Meanwhile, Maersk saying its U.S.-China bookings have increased after a recent pause in tariffs. The shipping giant also expecting a, quote, tightening space across all Trans-Pacific services in the coming months. Maersk's Trans-Pacific bookings slowed in April and May, with many importers waiting to assess the tariff environment. And shares of Rémy Cointreau are trading higher in Paris. The cognac maker forecasts organic sales growth returning to a mid-single-digit rate this year, but withdrew its long-term sales guidance due to tariff policies in the U.S. and in China. Shares of Rémy Cointreau are down more than 40% so far this year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Coming up next, the labor market on hold.
The labor market's in a bit of a holding pattern. I think that's a general nature for the economy as well. So until you really see demand destruction, there's a point where, like, forecasting, you just don't need that labor supply. I think companies are going to hold on to labor, hiring will be moderate.
Michael Reed of RBC joining us next. This is Bloomberg.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Building on the gains of the past few days, building on the gains of May, the biggest May that we have seen for S&P returns going back to 1990. Adding to that with just about 0.2 of a gain on the S&P, almost 0.3 on the Russell 2000. Bond yields not exactly doing much, which is a good and beautiful thing. They are, though, creeping higher on the front end. This is the right kind of move that you want to see on the downside on the long end, as there does seem to be this everything rally, bleeding demand into duration. Dollar weakness continues and has been a theme over the past 3 months. Under surveillance this morning, the labor economy on hold.
A slowdown in growth is already expected. We've yet to see that in the data. So I'm a little bit, at this point in time, kind of the boy who cried wolf on the data. I want to see the data actually kind of roll over. The labor market's in a bit of a holding pattern. I think that's a general nature for the economy as well. So until you really see demand destruction, to the point where like forecasting, you just don't need that labor supply, I think companies are going to hold on to labor, hiring will be moderate.
Here's the latest. Investors counting down to May payrolls out on Friday. Bloomberg survey looking for 130,000 jobs added and unemployment to hold steady. Michael Reed of RBC writing this: we expect to see 162,000 jobs added. Uncertainty after the 90-day pause meant businesses and consumers likely avoided making major decisions, and yet here he is with some of the higher projections for what we can expect to see in payrolls. Michael joins us now. Thank you so much for being here.
Thanks for having me.
Why is your expectation so much higher than the vast majority of economists out there?
Well, there's a few things going on, and the first thing I always point to when we're above consensus is, look, half of the gain is coming from healthcare, and that's just a demographic story. That's not going to change. We saw a huge number of retirements in March and April. We have an aging of the population, and that segment of the population demands a high level of healthcare services. So that's a huge tailwind for healthcare hiring moving forward. Tariffs aren't going to change that.
So you don't think that we're necessarily entering a period where just structurally the payrolls figures are going to be lower, and that could still be a good market, but it just is demographically what we're seeing. You don't believe that kind of theory?
I don't, not right now. And partly why we believe that is, number one, you have services that are still kind of recovering from COVID. By that, I mean, we mentioned healthcare, but other sectors that are benefiting from that older demographic include leisure and hospitality. That's one that still has to recover from pre-COVID hiring levels in terms of the service that they can provide. So that's another sector that we see as gaining this month. And that's one that we do expect will have a tailwind, again, coming from that older demographic, which tends to spend on services over goods.
Michael, you're at 162 on Friday versus 130 consensus. What do you think that's worth in terms of the equity market? Are we talking 1%, 2%? And for that matter, let's talk 2%. What is that, 200K? I mean, what do we need for that market to kind of shoot up and get really bullish here?
I think the estimates are rather tight. So when you look at the spread, I mean, we're at 160, consensus is at 130. You have a few that I saw come in below 100,000. I think the market gets worried if you get something below 100,000. I think over 200,000, maybe you get a bit more optimism. But for now, there's a very tight range of estimates. Part of that, too, I think, stems from the fact that you have to factor in the birth-death model.
Yep.
And that's something that's kind of mechanical. It's baked in. It has a certain amount of momentum. So for us, when we're thinking about what we're seeing in hiring trends, going from about 177,000 the previous month to 160 makes sense in our view.
So talk about the underlying sectors within the labor force that are still strengthening here. I mean, take us through some of those.
Yeah, well, I mentioned healthcare, leisure, hospitality. Those are quite strong. We expect financial services is one that will add.
Interesting.
And despite some weakness coming from DOGE cuts, professional business services still has the potential to add jobs. Other services is a bit of a mix. There are some sectors there, including kind of those nonprofits that are risk kind of losing funding. So we do have some job cuts penciled in there. Manufacturing as well is one that we do think is at risk of shedding jobs this month.
So over 100, less than 200, Goldilocks. I mean, I'm just going to say it. But I agree with you. And I think what's interesting about what you're saying is that the areas where you're seeing a tighter labor market are high demand from an older demographic and jobs that are kind of hard to replace by AI, bots, automation. And it's kind of interesting because I think healthcare and some of the more labor-intensive areas in the U.S. Equity market, which is my world, are under more pressure than, let's say, I think IT services, professional services, those are areas where they could actually use automation. What do you think about that as a potential, kind of loosening force for the labor market in those areas?
Yeah, I think there's a lot of talk about AI and how that's going to impact the labor market. To us, that's a longer-term trend.
Yeah,
that's going to play out over the next 5-10 years. When you think about, and as you rightly point out, there are a lot of in-person service jobs that just can't be replaced by AI.
Right, right.
Leisure and hospitality is probably a prime example. Health services, another one. Also thinking about other services is one that I mentioned, and I find that to be kind of an underrated sector, right? It's kind of a hodgepodge. You have vehicle repair services in there. AI is not going to replace that. You have personal care services, things like, hair salons and the like.
Right. AI can't replace fingers. I think fingers are impossible to automate.
Now we'll leave the robots to that.
Yes,
right?
we need robots for that. What do you think about the idea that deregulation, if it happens, and it seems like it's happening, is negative for labor? Because there are a lot of jobs associated with regulation.
The area where I would expect jobs to be lost if you see some deregulation would be in legal services.
Yeah.
That's already one that's been kind of shedding jobs. I think AI is one where that's kind of infiltrating in more of that entry-level area. So it's already, in our view, on the kind of downtrend.
Got it.
Not a particularly large sector that would kind of move the top-line number.
Michael Reed of RBC, thank you so much. And we do get the ADP employment change coming out at 8:15 a.m. Eastern. That's about in an hour and 20 minutes. The expectation is for 114,000 jobs at a time, when a lot of people are seeing the potential for numbers to come down, and that still not be a bad thing, Damien.
No, it may not be a bad thing. And look, I think the markets, again, you look at recession probabilities coming in, you look at these sell-side indicators at B of A going up, people are getting bulled up here, and maybe they're justified in just that. Oil prices are down, the dollar is weaker. These are good for global growth.
And as Evita has pointed out repeatedly this morning, it feels a lot like Goldilocks, and people shrug it off because it doesn't feel like it, maybe, just in terms of volatility of headlines, but not when it comes to the underlying data.
Right, right. And I think, but actually the fact that everyone's getting more bullish is more bearish for equities, so that's obviously the counterbalance.
So just, the yin and the yang there of Goldilocks. Evita Subramanian, Damien Sassower, both of you, thank you so much for spending the hour. Really wonderful to have both of you. Coming up next, we've got Kate Moore of Citi, Bloomberg's Tyler Kendall, and Lei Chu of Alliance Bernstein, all coming up as we get ADP employment. At 9:45 and 10, we get a slew of ISM and S&P services index data. And then later this morning, we do get ongoing discussions about what that economic data means for Friday. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, it complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
People are still buying U.S. equities, but not buying U.S. bonds.
It's not that people don't want to hold U.S. long bonds. They don't want to hold long bonds.
The Fed doesn't have as much control of the long end as they've had. People are afraid to be bullish.
The most important factor right now in the market is the momentum factor.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Goldilocks, evidently. Global stocks hitting new highs, U.S. equities approaching a bull market, and focus shifting away for the second from Washington, D.C. to any positive news, any positive surprise in economic data. Very happy to say Romain Bostic is joining me for the next 2 hours. Just to remind you, John Farrow is on vacation. This week, we'll be back next. Anne-Marie is on assignment. Romain, thank you so much for being here.
Absolutely, Lisa.
You had to come in from the close to the morning just because.
I know, it's like wire to wire here. So I finally get to see how you guys do things here.
Yeah.
This is before my wake up time.
Let's see how it works for you, because it's really fun. I am curious about this idea of the bull market and the idea that we were just talking with Savita Subramanian of Goldilocks returning despite some of the uncertainty and the fact that we still have a lot of question marks.
It's kind of insane, right? A couple days ago, coming into this week, someone said, hey, have you actually looked at where kind of the MSCI All World Index is, where the S&P is? And I said, well, yeah, I do every day. I haven't looked at it since, from 4.8, that sort of bottom that we saw after this whole Liberation Day freak out. We'll look at it. You have the MSCI All World Index at a record high today. The S&P still has some room to go, but you look at what's taken us there. Mag 7, 43% of those gains, at least here in the U.S., and a lot of non-Mag 7 companies, but again, it's tech. It is a lot of those, I wouldn't go so far to call it Goldilocks, but a lot of those big names that kind of got us that big rally in 2024 and at the start of 2025.
Yeah, to put some numbers in what you're talking about, we're about 3% from that all-time high on the S&P 500, all world stocks already there. But it is this question of, do people just throw the babies out with the bathwater? And if we just turn to nowhere, because basically we're almost flat on the year when it comes to some of those big tech stocks, it raises a question about how much people have accounted for what is going on in Washington, D.C., the animosity between China and the U.S. that does continue, and this question of whether that big, beautiful bill can actually get through.
Do people have to pay attention to that? Because I've asked this question to so many people, right? We have not seen the real effects of the tariffs and just the chaos in Washington yet. And a lot of folks on Wall Street say that will come. We don't know the severity of it. But in the meantime, maybe you can sort of whistle past the graveyard and look at the complexion of the rally and how many people we've had on Bloomberg who've talked about this idea of this is a retail-driven rally. A lot of the institutions are still on the sidelines, at least not to the extent that what they were prior. And this gets to this idea of participation and whatever conviction there is that has led us to where we are.
And I guess if you push what you're saying forward, which is a really good point, how long can this everything rally continue without the participation of either the dollar or U.S. government bonds? And that raises this fundamental question, does it have to be the linchpin, not necessarily the dollar so much as yield space, for any kind of further gains, or is that now a separate story that can kind of shift on its own business?
Well, short term, I mean, history says, yeah, it can. Long term, it says no.
We have that conversation coming up. Right now, we are building on gains after 2 straight days of gains. We are building and looking for a third, with people pouring into small caps in particular, up about 1/3%. You can see S&P futures up at 0.2%, as well as the NASDAQ. Yields quiet. And this, again, raises the question, what is driving the long end and the short end? Right now, people are seeing positive news is possibly shifting yields marginally higher on the front end. The 30-year getting a bid. This is a risk asset. On days that are risk on, the 30-year does well, yields lower. This has been an interesting trend when you take a look at the dollar space, a little bit of dollar weakness. But this, to me, has been the story of the year so far. Just how much froth has come out of the dollar over the past 3 months, down about 6% over the past rest of 2025. Almost 9% declines. Coming up for the next hour, Kate Moore of Citi, with stocks posting their best 2-day streak since mid-May. Bloomberg's Tyler Kendall, as President Trump's big, beautiful bill faces Senate roadblocks. And Lay Chu of Alliance Bernstein on growing AI spending opportunities. We begin this hour with stocks steady, holding on to 2 days of gains ahead of more labor market data. Kate Moore of Citigroup writing this: we view the market as exhibiting the relief due to the recent tariff roadblocks. However, uncertainty remains, and corporate management teams will resist large capex and hiring plans until further clarity on trade rules. Kate joins us now with a dose of cold water on the Goldilocks.
Sorry.
It is so good to have
the
you.
porridge is too cold apparently this morning.
Well, I'm just wondering, what do you make of all this Goldilocks talk? I mean, not all this Goldilocks talk. Savita Subramanian was just talking about that, but this feeling companies will adapt and adjust and get it through, and that's what we have continued to see.
Yeah, look, I have all of the faith in large cap companies being able to adopt, but we just don't know what they're adopting to. And this is the big question mark. Everyone says, okay, we're going to get past tariffs, or we're going to get past the worst in terms of tariff news. But we know that all of these sectoral tariffs can have much greater, impact than some of the reciprocal tariffs. And if I was a company making investment decisions, this is what I was writing in that note, I would say, I can wait it out for another couple months or another quarter or two before I make decisions, because I want more clarity into what my margin story is going to look like. And I think that's a prudent thing to do. And it is the behavior that these large cap companies have exhibited through many years, over a decade at this point, and really managed their bottom line. It's one of the reasons why we love them, and one of the reasons why we want to continue to own them.
And there's this larger question, and we were talking about it at the open, this idea of how long can this sort of feeling of adapting and adjusting continue without recognizing the structural framework that could be shifting. We just got news that the European Commission is recommending that Bulgaria joins the euro next year. There is this question about whether the euro is getting fortified as a viable alternative to the dollar at a time where we have seen the dollar really lose steam. How much do you give credence to that? The idea that outside of the U.S., you can rely more considerably on the adapting and the adjusting, and the framework remaining the same.
I think it's too soon for us to call the end of dollar dominance, not just because of trade, but because there is, to this point, not a viable alternative. But I think all these moves on the margins are very much worth watching. Like, if we see different governments, if we see different policymakers, if we see different investment communities start to take a good look at other currency alternatives and just incrementally shift their own positioning, and many of them do it at the same time or over a number of years, that can really start to move the needle. I think most currency strategists would agree the dollar was a little overvalued even before all of this stuff. And so kind of we're getting back to a more normal valuation for the dollar. But this idea that we're going to have a massive and consistent decline and there are going to be these viable alternatives by the end of 25, I think is probably too far gone.
And does there need to be a viable alternative? I mean, there's been a lot of talk about this is just kind of rebalancing that equilibrium. And when you look at the currencies that have performed so well over the past few months, you look at the Swiss franc, you look at at some of the other European, or even the euro, which that probably won't last. But I mean, let's take the Swiss franc, for example, because I think a lot of people have talked about how a lot of asset managers have shifted some allocations over to the franc as a way to hedge against what's going on here in the U.S. Maybe that's not a structural change, but over time, that can whittle away at the value of the dollar.
What I will say is a lot of our clients, particularly some very large clients, and I'm going to highlight clients in Asia specifically, have been asking about ways to hedge their dollar exposure. They just want to kind of neutralize that in portfolios, and that makes a ton of sense. So we're seeing this across all segments, but particularly the larger clients who have this outsized dollar position, or if it's had, we've seen that kind of drift in the dollar position over the last couple of years, looking right now that there's relative stability as an opportunity for making that move.
Is there, though, a long-term case to be made for a certain level of instability, a certain lack of trust in the U.S. system that had bolstered the dollar for basically the last, 50, 60 years?
I think it's a fair question, honestly. And I think as we go through the discussions around tax and as we watch what happens to the deficit, and we understand that there are going to be some significant challenges to the bond market over the next year or two, unless we have a significant reverse, of course, it's fair for global investors to revisit their portfolios and say, hey, we may have the best companies in the world in the U.S., the most innovative, the best free cash generators, but we're not as confident that we should have this much of our fixed income allocation in U.S. bonds. And again, this is on the margin. We're not talking about a wholesale reversal.
Right.
But when this happens over a period of quarters or a period of years, it can have a really significant impact on yields.
But Lisa was showing the 30-year yield at 4.9, and I look at 4.9 and change over there. Let's just round it up to 5.
Yeah.
That's not attractive with a 10-year at 4.5. It's not attractive if I look at the contours of this tax bill. Great. I love the tax cuts. I'm not so great about the fact that they're not making that up in any sort of way, shape, or form.
Right.
So if you're a long-term investor, why would you go longer out on the curve right now?
I mean, we certainly aren't. Like a lot of asset allocators, we've been hiding in the short end, maybe a little bit to the belly, but really being very concentrated there. And we keep on having this debate within the team and across all of the city. At what point do we want to buy duration? And it's not just the level; it's how do you get to that level? What the drivers of that move to that level, and whether or not we feel it adequately compensates us for the risk on the fiscal side, on the risk on the tax side. And the truth is that growth is okay right now. It's not phenomenal, and we're not looking for kind of a 3 to 4% GDP world or for the U.S. in the next couple of years. So it's pretty tough.
It also raises questions about what drives that kind of desire to own long duration assets. Is it a good thing? The idea of fiscal responsibility or some sort of sense that maybe you can get compensated with this kind of yield? Or is it the idea that we're really going to hit some sort of slow patch? And this is something that was introduced by Savita. At what point are we looking at bond yields going up as a positive thing? As a sign of risk on elsewhere because it's coming with growth? I mean, can you get your hands around that argument?
I'm not at a place where I think bond yields are reflecting better growth in the future, right? And a lot would need to happen. By the way, I thought the economy was slowing even before the introduction of these tariffs, which I think are quite growth negative, even if, as I was saying before, the reciprocal tariffs don't end up coming through, and we're just talking about the sectoral tariffs. This is a headwind. We just need to acknowledge that. But the consumer and certain segments of the consumer were showing stress at the end of last year and the beginning of this year, even if the aggregate data looks pretty good. And we were starting to see more cautious spending from companies in general after a prolonged economic cycle. So all of that was in place before this uncertainty. So I think it's really too soon for us to say we're going to be able to forecast an acceleration in the U.S. economy, maybe based on tax cuts or based on consumption looking good when there are so many other challenges.
Just to sum up, would you sell this rally?
I would not be adding a lot of equity risk to this rally. But again, I think large caps are going to be the better place within the U.S. market.
Kate Moore of Citigroup will be sticking with us for the next hour, which is a wonderful thing. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Elon Musk blasted President Trump's tax bill as a budget-busting abomination as Republican fiscal hawks also step up criticism of the package. Musk's attack comes days after he left his temporary post leading government cost-cutting for the Trump administration under DOGE. Meanwhile, the Federal Reserve lifted the asset cap on Wells Fargo that had restricted its size for over 7 years. The Fed says the bank met all conditions required by an enforcement action imposed back in 2018. The removal of the cap marks a major win for Wells Fargo CEO Charlie Scharf and will allow the bank to pursue growth again. Meanwhile, a check on Dollar Tree shares, they are falling 3.5% as the company warned investors that its second quarter profit could be down significantly from a year ago, that overshadowing a strong previous quarter where it beat earnings forecasts and boosted its full-year EPS forecast. The discount chain also expects to mitigate the impacts of higher tariffs. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Coming up next, Trump's big, beautiful bill facing roadblocks.
It'll be the largest increase in our debt ceiling in our history, and I think it's a mistake. I'm not going to be one of the Republicans who's going to be responsible for this debt.
We will not be able to pass the bill without finding some more spending cuts.
That's coming up next. We'll be speaking with Bloomberg's Tyler Kendall. We'll also be touching on the steel tariffs, with which President Trump is shifting to 50% from 25%. You've got the UK Prime Minister out this morning saying that they're working on bringing those down to zero on UK steel. We'll discuss that as well. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Building on gains in the equity market in the U.S. and frankly around the world this morning, we're seeing about 0.2% gain on the S&P and on the NASDAQ. You could see gains are trending just a touch. Similar kind of move right now on the Russell 2000. A question about whether people are paying attention at all to what's going on in Washington, D.C. Under surveillance this morning, Trump's big, beautiful bill facing roadblocks.
It'll be the largest increase in our debt ceiling in our history, and I think it's a mistake. There's no more pointing fingers at the Democrats and saying, oh, they're the big spenders. It'll be all on Republican shoulders, and I'm not going to be one of the Republicans who's going to be responsible for this debt.
I would like to see some reforms to Medicaid.
We will not be able to pass the bill without finding some more spending cuts. We can do that without going after Medicaid benefits.
Here's the latest. A cohort of GOP senators are vocalizing concerns over President Trump's massive spending package. Rand Paul, Ron Johnson, and Mike Lee are among those vowing not to approve the bill in its current form. Bloomberg's Tyler Kendall joins us from Washington. Evidently, Tyler, President Trump is not sleeping. He is talking to all of these senators. What are the biggest hurdles right now?
Yeah, hey, Lisa. Well, he's definitely ramping up the pressure as he faces conflicting demands from Republicans that want to make changes to this House package. And there's a few different factions here. One, of course, is that group that's emerging, pitching themselves as those fiscal hawks that you mentioned a few of the names there that want to see some deeper spending cuts. Now, of course, we also saw this on the House side, and that package is ended up projected to add $2.5 trillion to the deficit over 10 years. But perhaps these senators might have a little bit more leverage because they're not up for re-election as often, so could push President Trump to make some changes. One of the biggest sticking points is going to be lifting the debt ceiling to this package. You have Rand Paul saying that he won't vote for a package that hikes the debt ceiling, whereas Ron Johnson has said perhaps he could vote for a one-year increase. But then you have other Republicans saying that they want an even bigger increase than the $4 trillion currently allocated in the House plan because they don't want to have to deal with this until after the midterm election. Other than that, of course, this squares with the idea that there are some Republicans that are concerned about what spending cuts could look like, particularly when it comes to benefit programs. That speeding up of the work requirements connected to Medicaid. Also plans to freeze the Medicaid provider tax and shift some of the cost sharing on to states. Lisa, I really could keep going, of course, because this is one big, beautiful bill. We're also looking at some of those, what the tax cuts could look like. But at the end of the day, President Trump can really only afford to lose 3.
Well, Tyler, let me stop you there because I am curious just about the math on this. And maybe you can help me. I've got 5 fingers. We put 5 people up on the screen there. We can take 2 of those guys out because we'll know they'll flip-flop, and you know exactly who I'm talking about. A 53 majority, right? 53 is what the Republicans have right now. So even if they lose Rand Paul, even if they lose Johnson, isn't that still going to be enough, maybe, assuming that they can sway Tillis and Lee to flip-flop? Isn't that still going to be enough to get this bill through?
Yep, it ultimately will. So Republicans can only afford to lose 3 senators. That's the key math that we're watching here because they chose to do this through reconciliation, which means they only need that simple majority so that they can fast track this legislation. So they don't have to negotiate with Democrats, but they do have to negotiate with each other. But we really are starting to see some of these senators dig in on some of these key issues, such as changes to Medicaid, which we know will be a politically fraught issue for the White House ultimately. And then, Romaine, we have to keep in mind they're going to kick this back to the House too, and that's where we're starting to see some of these disagreements really creep up into the conversation, such as changing when it comes to lifting that SALT cap. We know House Speaker Mike Johnson has urged senators not to change this bill too much because that was one of those key sweeteners to ultimately getting it over the finish line. At the end of the day, we do know President Trump has a key meeting today, 4 p.m. Eastern at the White House. That's with members of the Senate Finance Committee. Romaine, as you well know, these are really the senators tasked with writing the bulk of the legislation when it comes to both Medicaid and those tax cuts.
Tyler Kendall, thank you so much, as always, for your great reporting. And this has been the issue, the SALT tax cap, and whether they do lift it the way that the House bill has said. One, just congressman, to your point, Nick LaLota, a New York Republican, came out last night after seeing that some senators had proposed taking out some of the caps or lowering that cap area. No SALT, no deal. For real on X.
And this is getting messy, but it's going to get to the point. They're just going to have to pull some stuff out of this if they want to get this through. It's just a question of what.
Exactly. And Kate Moore of Citi is still with us. And Kate, I'm curious how closely you're watching this and how much you think this has been driving some of the action that we've been seeing, not only when it comes to bonds and the deficit, but also with equities.
Yeah, I've been watching it really closely, but it's one of these things where the market can only pay attention to one thing at a time. And there are moments when it pays attention to the tax bill, but I don't think that's what's getting reflected in prices today, for example, or the move higher in futures. I think people are reflecting the fact that growth looks okay, and that the likelihood that some of these reciprocal tariffs are going to be biting in the near term is low. But the tax bill is a really hard one to handicap at this point for all of these reasons. Lots of different personalities, there's lots included in the tax bill, and the likelihood that what we saw in the House version ends up in the Senate version, that ends up getting voted on, is close to 0.
When you talk about the big personalities, and I'm going to get you into trouble, so good luck. I'm curious. Elon Musk last night saying, "I'm so sorry, but I just can't stand it anymore. This massive, outrageous, pork-filled congressional spending bill is a disgusting abomination." Definitely one for some pretty good hardcore language here. Shame on those who voted for it. You know you did wrong. You know it. I mean, how do you view this type of rhetoric coming out of the best buddy, the first buddy of President Trump, but also a very big business owner? who's been very polarizing.
Well, thanks for remembering and reminding me, I'd say, about pork. When we thought about politics and we learned about this in U.S. history and pork and bills, I'd forgotten that term until just this moment. But I do think this conversation is important. And I think we're going to see more and more of the debate played out on social media, on TV interviews, in op-eds. And that noise is going to make it very difficult to meet that July 4th deadline, in my assessment. I'm not going to comment specifically on Musk, but what I will say is some of this pushback from Republicans and from Democrats who are concerned around the deficit going ever higher without any governor on it, I think is a very fair concern and something we should be discussing. It goes in not just to the bond yield, but also to the sustainability of U.S. growth.
I mean, and let's take Musk out of this because it's not clear how much influence he's going to have. I do wonder how much influence the market will have. And I know there was a lot of hay made over whatever happened in early April with that, let's just say that move in the bond markets, whether that was directly related to it or not. I am curious if the market, A, has the capacity to push back on this, and more importantly, the willingness.
I think at the extremes, or at speed extremes, I would say, the market is really sending signals to all of these different political leaders and policymakers. But, if it's kind of a little bit of a grind in one direction or another, I'm not sure it's telling them much, or they're going to pay that close attention to it. You get the big gap downs or the big moves up. People feel concerned or significantly more confident.
But this gets to like the way Lisa started this hour, which is, we have stocks, at least on a global basis, back to record highs. The S&P on its way. Yields are in check. I mean, maybe not where they should be, but they're relatively in check. The VIX is subdued. And I guess with the exception of maybe the dollar, I mean, most asset classes are faring pretty well.
Yeah, well, I think there is a lot of complacency in the market, I would say. The move in May was fast and furious. The decline in the VIX also catching my attention. And again, I don't think it's reflecting the balance of risks in 2025 or into the beginning of 2026. And this is accepting, what's going on in the tax bill.
And this is the reason why so many people have said the pain trade is higher, because from a logical perspective, the uncertainty doesn't necessarily feel great. But at the same time, what you have seen is just climbing that wall of worry and grinding higher and higher, higher.
Yeah, Lisa, can I just make a point here? I've been talking to a lot of investors, institutional investors around the street, my community, and also, through official meetings, we'll say. And everyone is talking a more cautious story, right? They're concerned about growth. They're concerned about what could happen to earnings. Many people share my view that 2025 consensus estimates for U.S. large cap earnings are a little bit too high. But no one is really positioned for it. I mean, in the worst case scenario, people are neutral. And I would say we're neutral on equities and still, as I said, have this preference for large caps. But I think this is important because the gap between narrative and action is pretty high right now. People expressing concerns but haven't acted on it. That said, if there are significant issues that actually show their ugly heads over the course of the summer, the beginning of the fall, I think there is room for people to cut risk.
That is the reason why people say, honestly, if one bad economic print, if you get a bad non-farm payrolls number, and it won't happen on Friday, but if it happens in a couple months' time, that's when the proof really is going to be in the pudding.
And inflation data as well. We have a lot of people saying, look ahead to June and July, where maybe you'll start to see the impact show up.
Of course, then you're going to start talking about transitory, and then we'll play the drinking game, and then we get back to this question of what the Fed does with it.
Oh, is there drinking on this show?
There is. There's drinking coffee, although, you can put whatever you want in here. Coming up, Kate Moore of Citi is going to be sticking with us. Lei Chu of Alliance Bernstein will be joining us on growing AI spending opportunities that has once again emerged as the golden child of a market that just can't quit. This is Bloomberg Surveillance.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Just 2 hours until the start of the open, and you can see futures heading on and building on 2 days of gains, with a third seemingly underway, up only 0.1% pretty much across the board. Kind of the opposite of what we had been seeing over the past few days, starting softer and then building into the open and then onto the close. Are we fading into the open today just a touch after reaching all-time highs on the world equity indices and really getting only 3% away from that here in the United States? With your morning movers, let's head over to Yahaira Anand. Yahaira.
Hi, Lisa. We start with some M&A news. Driving these two stocks this morning, we have Chart Industries up about 0.3%, Flowserve down 2.5%. The Wall Street Journal reporting the two companies specializing in industrial process technologies are close to merging. They're reporting this all-stock deal will be worth roughly $19 billion. I will also add we have seen signs of life in M&A this past week. We had some pharma deals and as well as Snowflake buying Crunchy data. We'll see if that momentum continues. Next up, we have CrowdStrike sinking here. It's down nearly 7% after the cybersecurity company gave a revenue forecast for the current quarter that fell short of analyst estimates. Part of that is fallout from last summer's global IT outage tied to a software update by the company. They're saying that after that, it offered these customer commitment packages, and the CFO is saying those are still dragging on revenue and will continue to do so for the rest of the year. And last up, we do a check on Wells Fargo. Those shares are still up 2.6% on the big news that the Fed has lifted the asset cap that has shackled the bank since 2018. It marks a new era and a big win for CEO Charlie Scharf. That's because according to our calculation, the cap had cost Wells Fargo about $39 billion in lost profit. But now, for the first time in 7 years, the bank can grow its balance sheet, gather deposits, boost lending, and of course, ramp up its trading and investment banking. Lisa?
Thank you so much, Yahaira, and really builds on this question of how much this administration more broadly will unshackle some of the risk-taking that big banks have been curbed from taking over the past few years. On our radar this morning, President Trump raising steel and aluminum tariffs to 50% from 25% today. The new levy is kicking in just after midnight Washington time. The White House saying the tariff increase will support domestic steel production and serve as national security protections remain at a time when a lot of people are wondering, have we fully factored in what sectoral tariffs could be coming down the pipe?
No, we haven't. I mean, that's really clear. I mean, we haven't. I mean, you can see that in the price action. You can see that when we speak to analysts here. The idea here is that no one really knows, so no one really can price that in. Look, he went through on those tariffs as he promised, and as, Caroline Levitt made clear, he walks the walk, and at least he did on this particular issue. The problem is there are about 20 other issues that still have to be resolved.
Yeah, and this is one of the things when we've looked at guidance, when we've looked at earnings revisions, which, these two things should be somewhat related. We can't really tell if companies have any visibility of, beyond the next 2 or 3 months. And that's largely because they don't know how to handicap these sectoral tariffs. They don't understand how deep and painful they might be for kind of next year. And so as a result, they're only making these tiny, cuts on the margin to their guidance. That's getting reflected in analyst revisions. So it doesn't look so bad, but it's more about paralysis than actually a continuation of where things were in 2024.
Also, you wonder about just the cost aspect of it too. Like when we had the pause on tariffs, I forgot which pause it was. You know, there were a couple of retailers saying, "Okay, now we're going to start ordering a bunch of stuff now."
Totally, bring it forward.
Yeah, but how does that sort of end up impacting margins and bottom lines? Because you're now at a completely different model here that is it's like a stair step. You know, it could be 10% here and it could be 20% the next month, or it could be 0 if you are in paralysis, like Kate said.
Or potentially you could end up with a lot of inventory with a style that completely changes, and suddenly Lululemon pants are back in going to work, and suddenly, you know, you have to really shift your entire inventory. Meanwhile, there's a real question about...
I don't own any Lululemon pants.
Really?
Are they popular?
I've actually heard that
you
from
know,
men
I actually
they
sleep
are.
in my suit, by the way.
I think that you do. I can see that, actually. Senate Majority Leader John Thune, meanwhile, talking about suits, saying the $40,000 SALT deal that helped President Trump's tax bill pass the House will have to change in his chamber. This is kind of the key question. Negotiations are ongoing as a cohort of GOP senators continue vocalizing their concerns with this bill. The SALT tax, such a huge point of contention, which is a no-go for a lot of particularly New York and New Jersey Republicans.
I will say that if there are any group of politicians right now that might hold the line when it comes to this bill, it is going to be the New York contingent, because this is obviously a big issue for at least voters locally. Whether that's going to be enough to completely derail it, who knows?
Yeah.
Yeah.
I mean, right now people are looking at whether we end up having some sort of come together moment for the Republicans, or whether we could actually go beyond that July 4th.
Isn't Trump going to, at some point, he's going to, you know, use that bully pulpit? I know he's supposed to meet with a lot of these folks today in Washington. At some point, he's going to use that bully pulpit and probably threats and say, look, get on board or else.
President Trump is not shy of using the bully pulpit, and President Trump was posting on Truth Social his favorite bully pulpit last night, quoted saying this, or this morning: "I like President Xi of China, but he is very tough and extremely hard to make a deal with." The post raising questions about the state of U.S.-China trade negotiations. And Kate, I'm curious about whether this idea of the relationship between the U.S. and China has fully been teased out in markets, given the fact that these are two economies that are intricately intertwined, that have largely been decoupled, in fact, when it comes to the shipping volumes over the past month.
Yeah. Well, I think let's step back outside of these tariffs and say China and the U.S. were in a period of really intense strategic competition for a long period, for the last couple of years. This, you know, transcends Democratic and Republican administrations. This is just kind of the state of play. And what's happening right now is an acceleration of this decoupling, an acceleration of this strategic competition. And one of the things I'm watching, and again, these are just little snippets on the sidelines, is what different companies and countries are saying about aligning with China versus aligning with the U.S. We need to remember that there are many countries out there for whom China is a much more important trading partner than the U.S. And if that's the case, then, you know, we can push on China as much as we want, but we may drive away other countries and companies that may be partners.
Well, there was a story today about the European Union and that deal for Airbus planes with China.
Yeah, and potentially whether they end up having a closer relationship. This really goes to the heart of tech. And I think that we have to really focus in on tech. NVIDIA shares staging a $1 trillion rebound over the past 2 months, leading investors to believe there is more room to run in artificial intelligence. Lei Chu of Alliance Bernstein writing, "There seems to be continued skepticism over the return on investment of AI, but we believe we are at an inflection point where we are seeing real AI revenue from privates and publicly traded companies." Lei joins us now. Lei, thank you so much for being with us. Just to build on the conversation that we were just having, how does the sort of ongoing tension between the U.S. and China and where people will source their technological instruments, how does that factor into how people evaluate some of the tech behemoths that are benefiting from the AI trend, but it depends on where and how and in what bulk?
Well, I think, first of all, it seems like there's a lot of controversies in tech, and particularly with all the tariff that's going on. And I really highlight tech is sort of the epicenter of it. Tech is strategic. At this point in the economic cycle, how good you are in technology really define how superior you are as a company or as a nation. So we should just assume that uncertainty and this back and forth on tariff is here to stay, and it will continue to drive volatility in the tech sector. But that said, I would also say, because tech is so strategic, we just really look at, instead of trying to figure out the supply chain, maybe it's more important to focus on who has pricing power, who can actually pass on the pricing, right? Because we can analyze the chip, where it came from, where is it assembled, and ultimately where's the final goods coming from. You can do it all day long. And what's the point of doing that? But what's more important, perhaps, is just to see how strategic the product is, how differentiated it is. Can anyone else make it? Can you do without it? And that's kind of a starting point.
So that raises a really good question, and it's a fabulous point. How much are you seeing the hardware continue to be the point that has pricing power versus the software of how you apply it?
Well, I think there's hardware and there's hardware. There's the hardware that is really unique and you absolutely cannot do without, right? That's why there are certain giant companies with huge market cap, because you can't do without it, because we're at the beginning of a compute paradigm shift, and that's perhaps once or twice in a lifetime. So that's at the hardware level. You want to find the most strategic asset. But then when I say like there's real applications already in AI, you're seeing it as certain it's not so much software, but you're seeing at large language models, and you're seeing new applications coming up already. So ultimately, if you look back, we have benefited tremendously from these huge network effect companies, and it's asset light. And we're used to thinking, okay, that's where the strategic differentiation is. But going forward, perhaps how we think about the network effect is also changing, right? Everything is being disrupted with AI. And I always say this, historically, tech has the ability to disrupt all the other industries. We've gone through digital media versus traditional media. We've gone through brick and mortar stores versus e-commerce. But AI is unique in the sense that it's redefining tech. So it's actually disrupting tech itself. So rather than saying it's hardware or software, you really have to focus one by one and to see which one is going to be the new leadership in a new paradigm versus, what has been.
So does that mean this becomes kind of like a winner-take-all situation, or is there going to be room for everyone?
And historically, I think, I always say historically, because you go back in history and go through product cycles, and I think what we've seen is initially there'll be a lot of companies coming up, but everybody can benefit from entry barrier coming down, and everybody says, I can do this, I can do it cheaper. But over time, most of the time in tech, it is winner takes all, right? Because ultimately, if you're truly unique and you can deliver something that no one else can do, and you are constantly innovating itself, then you can actually take majority of profit. So it's almost usually like an 80-20 rule, where the bigger ones would take 80% of the profit.
Yeah, so I want to tie this back into the conversation we were having around China a moment ago, because I hear you on the winner take all, that there may be a couple big companies that really dominate. But is it possible that we have this parallel or kind of bifurcated system because chips can't make it from one country to another? How do you think about the opportunities in AI in China versus the opportunities in the US?
Well, I do think, and we just assume the political situation is what it is and it's a given, that we do see China developing its own proprietary system and they're going their way. And currently, a lot of it is still based on some of the US technologies, but they are moving pretty aggressively further, and there's a lot more available data in China also. Yeah. So, and then there are a lot of companies going pretty aggressively at it. So I wouldn't put it out of realm possibility that, the Western world goes one way and China will continue to move forward. But all that said, it's just assume the current political situation is what it is.
Do you believe, and just to finish up here, this idea that Jensen Huang has talked about, the fact that China is really close to the U.S. and can create their own. Could you see a time, based on your understanding of the technology, where that supersedes and becomes more dominant in the rest of the world? Because there might be a divergence between these two economies, but not in the rest of the world that might have access to both.
I think it's probably too early to tell. It's certainly the way that it's going right now, where U.S. is going one way and China is pushing forward in their own way. And I would say, let's wait and see. It's really too early, and we're really only at the beginning.
2025, the year of wait and see. Lei Chu of AllianceBernstein, this was wonderful. Thank you so much. Please do come back again. We have been talking about this at a time when big tech, once again, front and center when it comes to U.S. exceptionalism, although is it really global exceptionalism?
Yeah, well, I thought it was interesting. There was a great story in the Bloomberg today about how Thrive Capital, Jared Kushner's firm, Capital Group, had actually made this trip over to China specifically to seek out AI opportunities. You had that deal with Butterfly, that deal with Manus. I don't know how that's going to sit with the president in the White House, but there obviously are U.S.-based investors that do see opportunity over there and aren't just going to sit by idly and let China take everyone's lunch.
Yeah, just if Washington, D.C. has an issue, they're not going to have an issue because at the end of the day, money speaks. So let's cut you right now an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The Office of the U.S. Trade Representative has sent letters to trading partners to remind them of an upcoming deadline in tariff negotiations. The White House says the letters are a friendly reminder and that the president expects good deals. Reuters earlier reported that the administration drafted a letter demanding countries provide their best offers by today. Meanwhile, Airbus shares are rising in Paris trading. Sources telling us here at Bloomberg that China is considering placing an order for as many as 300 Airbus jets as soon as next month. The order would be a significant win for the company, which has gained an upper hand in the Chinese market due to trade tensions and issues affecting its rival, Boeing. And shares of Hewlett-Packard Enterprise are rising more than 6% in the pre-market. The company reported quarterly revenue that topped estimates and said it expects a reduced impact from tariffs this year. HPE has been one of the companies benefiting from the rise of AI with increased demand for its servers and other hardware. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, a bit of caution.
We do remain a bit more cautious on the long end of the curve because you've got to ask yourself, are you being adequately compensated to take that long duration risk given the current U.S. fiscal situation?
Molly Brooks of TD Securities coming up next. This is Bloomberg.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer is not here for that. As small businesses doing under $50 million, you know, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
When you look at equities right now, it feels pretty great, at least after the past couple of days and after a May that was the biggest May going back to 1990, the biggest return that you've seen in 18 months. We have been building on that for the past 2 days with the biggest two-day gain going back to mid-May. In the bond market, it has been more of a question mark. Can you get that kind of rally? Right now, you are not seeing it at the front end of the yield curve. 10 years and 2 years, you are seeing up about 1 or 2 basis points. The 30-year, though, getting a little bit of a bid. At least it isn't rising, which is, I guess, a relief. 4.98%, still hovering near that 5% level with a real question about this risk asset. Under surveillance this morning, a bit of caution.
Parts of the bond market we really like. The short, the middle part of the curve, high quality spread has been a key part of the portfolio, but we do remain a bit more cautious on the long end of the curve because you've got to ask yourself, are you being adequately compensated to take that long duration risk given the current U.S. fiscal situation?
Here's the latest. The U.S. 30-year underperforming short-term debt year to date as investors continue to monitor fiscal risk, leading to speculation the Treasury might scale back or even halt auctions of its long bond. Molly Brooks of TD Securities writing this. Rates have been very focused over the last weeks with passage of one big, beautiful bill. However, if we see the macro data turning, the markets will react to recession risk. Molly joins us now for more. It's sort of a question of what would you like to focus on today for every market, it seems like. Molly, I want to start with that. This question of if we get negative economic data, do you believe in your core that 30-year yields will truly rally substantially and could even potentially outperform?
I think that they would probably rally, however, not as much as the front end. In the last couple of weeks, we have seen kind of the correlation between the 2-year and the 30-year declining. So that's showing that the 30-year isn't being driven right now as much by Fed cuts and macro risk. It's being driven more by deficit concerns and concerns of the quality of the long bond. So I do think that while it'll rally on Fed, you'll probably see the front end rally a little bit harder than the long end there.
Is there a risk, though, at those two worlds kind of converging, meaning the concerns about what's going on with the deficit and obviously the macro read-through?
Yeah, I mean, at some point, if 30-year yields increase enough and they're high enough, then conditions are going to be tight enough that we might see that feed through to growth. And then that would therefore be feeding through to Fed cuts as well. So it's kind of circular in that you could see that the pure level of the long end bond is impacting growth concerns.
But what becomes that light? I mean, because we kind of already know what's in the bill. I mean, you can model out the increase in debt servicing costs based on what we know already. So what becomes that light that the market is going to look to as sort of, okay, now we finally reached that Rubicon? Is it the labor market? Is it, as you said, actual economic recession of some sort? What?
I would say they don't really need a recession in order to begin this rally. Investors might need more of a kind of catalyst that is more recessionary for them to actually be able to jump into longs, just because we've been burnt a lot in recent weeks of just kind of sell-offs here. But I do think that if we see any type of weakness in the labor market specifically, and on Friday, specifically the unemployment rate, that's what the Fed is going to be looking at. So if we're seeing the unemployment rate rising and rising quick enough, that's when markets are going to get concerned and that they're going to react to the likelihood of Fed cuts in the near term.
Molly, I wanted to ask you, because I've seen a lot of wringing of hands and gnashing of teeth ahead of all these auctions in recent weeks. People have been really stressed about it, and of course they've gone really smoothly. You know, if it's not the auctions and we continue to get that bid, what should we be watching to really kind of signal a meaningful change in the direction of yields, especially at the long end?
Yeah, I think right now, I would say stay focused on the macro data. The Fed has continued
to be... Is it payrolls, do you think, or at this point?
Yeah, I would say less so the headline, but we're looking more at the unemployment rate, just given that it's a little bit more of a clear signal there. So if we see unemployment rate go up to 4.4, 4.5, that's when we think the Fed will get concerned, and that's probably when we'll see most investors more comfortable to step in.
Kate, I'll turn that question back to you. I mean, how much do you expect this to really turn from supply concerns that have been on the peripheries but really aren't center stage? How much will that shift immediately the second we get some sort of pessimistic print in the data?
Well, I think we have to be very careful around the labor market, because this is the place where, you know, to this point, it's been holding strong. And in fact, we've seen companies continue to hold on to their workforce, to not really engage in widespread layoffs. But when you peel back the surface, much like if you're peeling back the labor market report, you do find that there are pockets of companies that have been trimming on the margin, or, and this is something else I've been watching really closely, have stopped filling their open requisitions. You know, lots of job openings, but whether it's a CEO or the CFO or some HR manager saying, you're going to hold off there, I mean, that on balance shakes people's confidence in the labor market and their future earnings. And so if that then, you know, feeds through into consumer spending and these, I mean, there could be this sort of slow-moving domino effect impacting growth in the second half of the year, and that's kind of what I'm watching.
And that's just hard to wrap my head around. I assume that has to just make your job, Molly, just a lot harder.
Definitely makes it more interesting.
Yeah.
It's seeing how does this pass through come through. We saw soft data versus hard data, the whole debate on does soft data turn into hard data. We're seeing kind of weakening in different areas of the labor market, to your point, that are maybe not the traditional headline payrolls. And so it's when does this hit these big numbers that then kind of scares the market into rallying a little bit sharper and pricing in more Fed cuts.
Molly Brooks of TD Securities, thank you so much for being with us. Molly Brooks there. I am curious about what we see from ADP in about 20 minutes time and just how much that's going to really have ramifications for markets. It seems like we get it every month. Before we get it, people say we don't care about it at all. And then it happens and it confirms some bias and then the market moves.
Yeah, we don't care until we care. But I mean, just like we never cared about JOLTS until, you know, a couple of years ago. And I am curious about that. I mean, we had a JOLTS report that I guess seemed to show, at least on the surface, I know underneath the hood, there was some issues, but on the surface, if people are still hiring, people are still putting out job openings, that has to be a positive sign.
Yeah, it was. I think it calmed on the surface, but again, when you peel back the layers, not all of it was as strong as we would have wanted, or was kind of, let's say, a year ago. There's a lot of data on the year-over-year basis when we look at May and early June data that really does look to be weakening. And it's just kind of broad-based. And again, I'm not super bearish, but I want us to be cautious on the second half.
How do you determine, though, normalizing or weakening? Weakening, but not weak. Do you buy that?
I mean, it's hard to tell. Here's the other thing I'm going to say, and Molly just touched on this a moment ago. This translation from soft data into hard data is inexact. We don't have the timing on it. But survey data, I think, will be really important for spending in the second half.
All right, we'll keep our eyes on for that. Kate Moore of Citi, thank you so much. That was wonderful having you for the full hour. Coming up in the next one, Jim Caron of Morgan Stanley, Sucharita Kodali of Forrester, Kathy Bostancic of Nationwide, and EU Economy Commissioner Valdis Dombrovskis. Don't miss that. This is Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands
that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
We cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running it like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Uncertainty affects the economy in a variety of ways. The economy is much better shape than people think.
The economy slows, but doesn't keep forward into recession.
The choppiness that we're talking about, we will come through that hopefully with stronger economic elements on the other side.
We're calling this the summer of mud. It means that we're just stuck in this muddle through.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Not a mud kind of day, a bull market kind of day. Here in Goldilocks from Bank of America's Savita Subramanian with the S&P only 3% away from its all-time high. Global stocks already there with investors moving past worst-case scenarios despite ongoing disagreement in Washington, D.C. A new day of data, of trading, of an investors pushing past the word uncertainty. Romaine Bostic here with me, which is a wonderful thing. Romaine, it just seems like people have just stopped caring about what happens.
I think so. I mean, maybe it's numbness. I don't know. And then you feel like, okay, well, you have to be a part of this rally. And there's a lot of FOMO, too. We've heard that from a lot of folks, that as you started to see this market grind higher, people were saying, look, I want back in. You heard that from a lot of wealth managers dealing with high net worth individuals. Didn't necessarily hear that from the institutional side, but certainly on the retail side.
What we were just talking about with Kate Moore, I think we should pick up this idea that everything is good and fine, and feels like a bull market, and feels like Goldilocks until the data tells us something different.
Yeah.
And that is the reason why at this point, any print that doesn't show negativity is confirmation that we're okay to go, and it's sort of a green light to keep rallying. But if we get that negativity in some kind of key metric, suddenly that picture changes.
And I do wonder, like, is it going to be just one report that does that, or do you need to have that proverbial string, a trend, if you will, 2 or 3 reports to kind of confirm that data? And also the severity of it, right? If you do see a spike in unemployment, how much does that spike have to be to really rattle investors?
And we are just about 15 minutes or 13 minutes away from 8 ADP employment report. Then we get some services data, both from S&P and the ISM, and this follows what we saw from manufacturing earlier this week. It seems like people are shrugging off all of that kind of negativity as it passed, and the idea of what we see in terms of economic surprises being positive as really the road forward.
Well, I'm glad you brought up the ISM stuff, because, I mean, we saw the manufacturing data. It was awful, but we expected that to be awful. Services, I mean, that could be a key here, and I think Kate Moore was getting at this in the last hour about what we saw in that JOLTS data. The headline number was great. Underneath the service, you did see a lot of weakness when it came to the services industry, particularly hospitality, travel, leisure, basically the discretionary side of this economy.
And it goes to the point that you were talking about at the outset last hour in terms of how long can big tech continue to power the entire sphere of U.S. equities, because that is what we've seen over the past couple of days.
Absolutely, and if just to put a finer point on that, you know, I was saying you look at the rally off of that April low, about 43% of that came from the Mag 7, about 50 from big tech. That's actually, believe it or not, a smaller percentage of the contribution to those gains than what we had seen when we were talking about this in 2023, 2024.
So does it have to broaden out for this to be sustainable? That was a discussion back in the day. It hasn't been as much of a discussion in the past couple days. Right now, we are seeing in markets is more positivity, but fading from some of the earlier highs, just about 0.2% on the S&P and on the NASDAQ, up about a third on Russell 2000. In the bond space, you could see it's pretty quiet, not a lot of drama, but on the long end, just a touch lower, which is a good news, but still creeping toward that 5% level on the 30-year, 4.97. Meanwhile, in the foreign exchange space, you could see the dollar continuing its weakening trend, but just nothing really dramatic. The euro gaining just a touch after that announcement that Bulgaria has gotten the green light to join the euro as the common currency. We'll be talking about that more with Valdis Dombrovskis later on this hour. Coming up this hour, Jim Caron of Morgan Stanley on how he's rebalancing his equity exposure. Kathy Bostancic of Nationwide Mutual Insurance reacting to the latest jobs data. And as we were talking about, the EU Economy Commissioner, Valdis Dombrovskis, on both the euro as well as trade negotiations with the U.S., which, those two are still continuing. We begin this hour with stocks higher after posting back-to-back gains. Jim Caron of Morgan Stanley writing this: "We have rebalanced by increasing equity exposures, not just in the United States, but also Europe, our highest conviction overweight." Jim joins us now. Jim, thank you so much for being here.
Thank you, and good morning to both of you. Good morning.
Well, it's a real question here going forward about how much this long Europe trade was just a trade or whether it's something that actually can stick. You're making the argument, even with the recent gains in the U.S., you would still be a buyer of Europe over what we've seen.
Yeah, it's really about balancing. So it's not that we don't like the U.S. We just think that Europe has a higher risk-adjusted return profile. They've got fiscal stimulus. They've got monetary stimulus. They seem to have their inflation a bit more under control. Plus, a lot of the investment and a lot of the money that's being put through whether it's the defense spending or it's through infrastructure spending, all of this is actually a positive for them. And essentially, we also have to recognize that their valuations, they're a large cap value area for the markets. People are trying to diversify their portfolios from large cap growth and tech into something like large cap value. Europe is actually the poster child for that in our view. Plus, you get to invest in an asset whose currency is appreciating relative to the dollar, so you get a tailwind.
Okay, I want to pick up on that because we've been talking to your colleagues over the past couple of days, and this is the point that I think is fascinating. Morgan Stanley sees everything rallying except for the dollar. This idea that you could see rates rally, and even in the U.S., you could see equities rally, even in the U.S., but the dollar is going to be the continuing weakest person in the boat. And I'm just wondering at what point that really is the entire trade that you're talking about here. It's a currency play more than anything else.
So I would say it's a rebalancing. It's a global rebalancing. So if we look at the Fed's broad nominal trade weighted dollar index, the dollar has appreciated in value since 2010 to the end of 2024 by 40%. So essentially, the rest of the world became overweight U.S. assets. They had to buy U.S. dollars in order to do that. Now, you have growth coming in other parts of the world. This is the rebalancing. What that means, and this we're doing it too, right? You know, we are actually overweight European equities. So we are seeing other opportunities in other parts of the world. The U.S. markets are going to do fine. It's just that it's not the only game in town anymore. So Ultimately, what that means is that if the U.S. has a deficit, which it will have a deficit, the dollar needs to adjust lower to get foreign capital to come in. So all of this is part of a readjustment. It's not necessarily a bad thing. This is a very common, normal readjustment that's taking place, and we want to get on this.
But do you have conviction that it will last?
I do. I think this is a long-term thing. I mean, look, the dollar rally lasted for about 14 years in the period that I'm talking about, 2010 to 24. I think this is a multi-year process. This is a multi-year trade reset. I mean, tariffs, we all know this is going on too. This is a trade rebalance and a trade reset. We get these types of cycles every, 15 to 20 years, and we're just starting one right now.
But there's a reason why we kind of had that advantage here in the U.S. because we were the growth story globally. And I get this idea that, okay, the fiscal constraints in Europe are loosening just a bit. China and other parts of the world are going to try to sort of fill the void of where the U.S. is pulling back. But at the end of the day, I'm still not seeing a growth story in Europe, or maybe there is one.
Well, I think there is one. I mean, Europe doesn't have sectors like large cap tech, right? So you're not going to see, a stock go up like 200% or something like that, like we have in our large cap tech spaces. So I think this is more of like a slow grinding move. When I look at PEs and I look at multiples and valuations, if I look at, as much as I can, a like-for-like company, say in the financial industry, a big bank in Europe, big bank in the U.S., the PE multiple trades at about a 40% discount. And I'm not saying that they should be absolutely equal, but what I am saying is that Europe has a lot of catch-up. It's going to be a slower, stable, lower vol, higher Sharpe ratio, higher quality.
And it's going to be more than just defense contractors.
Yeah. I think so. Because see, what we have to understand is that an ecosystem gets created. Once Europe decided to spend about close to €1 trillion in stimulus, which they did back in February, early March, you start to develop an ecosystem. You have to develop supply chains. You need energy security. You need to reshape your economy. You need housing if you're going to build more industry, potentially even data centers. So there's a big ecosystem that's starting, and I think that's underappreciated by the markets.
Let's take a step back, because right now we're talking about where is the best place to find value in a ship that is undefined, which is the global economy and where we are in terms of the U.S. and how whether we're entering some period of stagflation-like behavior, whether we're going to have higher inflation and faster growth, or whether we could see an outright recession. And that really matters for all of this in terms of the adjustment of portfolio management. I just wonder how you're viewing the data. We're getting the ADP data just coming up about 5 minutes away. We get the jobs report on Friday. How do you view that within this paradigm of understanding, okay, should we shift around a little bit more to duration? Should we shift a little bit more to risk?
So, the data has been disappointing to the better side of the equation, right? So many people have been focusing on, we're going to fall off a cliff, we're going to fall off a cliff. We've been talking about this, the markets have been talking about this since 2023. We're going to have a recession. We're going to have a recession in 24. We're going to have a recession. And it really hasn't happened. So ultimately what this is really down to is the consumer and the jobs report. So if you have a strong labor market, reasonably strong, and we saw that from the JOLTS data yesterday, then what you have is a consumer that stays relatively robust. You can't really have a recession, a deep recession in the U.S. unless the consumer rolls over. What you end up having is a mid-cycle slowdown. So everything that you're saying matters. There's a lot of uncertainty. But look, people were telling me by June we'd have empty shelves in stores and things like that. It's not here yet. The data, I think, the jobs data will get a little bit worse going forward. That's anticipated. I believe that's going to happen. But ultimately, if the confidence in the U.S. in terms of the direction that it's going with the economy, I think that keeps the confidence alive. And remember, it's deregulation, it's tariffs and taxes. We can't focus on any one. It's the package that we're focusing on. And right now we're hearing the tax component, which could be stimulative, and that could actually, be helpful to employment.
We'll be talking about the package throughout the hour, and Jim Caron, we're very happy to say, will be sticking with us for the hour. We're not just talking about that. We're talking about other things as well, including that ADP data coming up. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. U.S.-China trade negotiations may be keeping President Trump up at night. He posted on Truth Social just after 2 a.m. Washington time, writing, quote, "I like President Xi of China, always have, always will, but he is very tough and extremely hard to make a deal with." The post is raising questions about whether the two leaders will have a call in the near future, as the White House has promised. Meanwhile, shares of Hewlett-Packard Enterprise are rising more than 7.5% in the pre-market. The company reported quarterly revenue that topped analyst estimates and said it expects a reduced impact from tariffs next year. HPE has been one of the companies that's benefited from the rise of AI, with increased demand for its servers and other hardware. And the New York Knicks have fired Tom Thibodeau after their first appearance in the Eastern Conference Finals since 2000. Thibodeau is credited for helping take the team out of a slump that saw it make just three playoffs just 3 times between 2010 and 2020. Thibodeau faced criticism that his hard-driving style and over-reliance on his starters wore down his players. That's your Bloomberg Brief. Lisa?
Thank you so much, Yaira. I wonder, I know they make a lot of money.
Yeah.
Don't you think it still hurts to get fired? Or do you think it's sort of expected?
It still hurts. Yeah, but look, he had to go.
Okay, all right.
I mean, yeah, I speak for all of New York.
Okay.
He did a great job. He gets a pat on the back, but they need somebody to take him over the hump.
And maybe next time they can actually win. Come on,
Yeah.
up next, the morning calls, plus breaking jobs data, and Sucharita Kadali of Forrester with the retail outlook. That is coming up next.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back. We are getting some jobs data. The ADP payrolls data just crossing. Let's get right to it. Michael McKee, Bloomberg Economics and Policy Correspondent. What do you see?
A lot of people questioning ADP, but this number will get your attention. Just 37,000 jobs created during the month of May, according to ADP, in the private sector at least. Last month, they said there were only 62,000. They've revised that down to 60. But the number of private sector jobs, according to the BLS, was 167,000. So take the ADP number for whatever you want, but it does suggest extreme weakness. If that carries through to Friday, we might have some Fed officials paying attention to that. The change in employment was pretty much all in service-providing jobs, 36,000, and of those, 38,000 were in the leisure and hospitality space. That's because professional and business services, education and Health services lost 17 and 13,000 jobs. Manufacturing jobs, according to ADP, down by 3,000 during the month. So this is definitely the worst ADP number we have had in quite some time. The question is, how accurate will it be when matched up against the Bureau of Labor Statistics numbers on Friday?
Mike McKee, thank you so much. And you are getting a market reaction. The two-year down markedly, down 3.93%, was significantly higher earlier. You are seeing across the board a bid into bonds. Before we continue, Jim, how much do you end up actually looking at an indicator like this?
Look, like we were saying, this is a leading indicator into what we think is going to happen to Friday payrolls. It's not always 100% correlated to this, right? We saw that in the last run of this number, but it does make the Fed probably have to step up and look, because the thing that they're worried about the most is a softening in the jobs market, and if this is the first indicator that this may be happening, then like Mike McKee is saying, they're going to sit up and take notice.
Which is the reason why there is just a touch of a move, even though people say it doesn't matter. When it comes out and it's like this, it starts to matter just a little bit. Time now for the morning calls. First up, Needham downgrading Apple to hold, saying increased competition poses a near-term threat. Next up, JP Morgan raising its price target on Amazon to $240, citing better than expected earnings and China tariff relief. And finally, Oppenheimer upgrading Dollar General to outperform, seeing resilience in an increasingly uncertain backdrop. Sticking with retail, Dollar Tree shares sliding, the company reporting better than expected earnings, but warning of a tariff-driven profit hit in the second quarter. Joining us now is Sucharita Kadali of Forrester. And it really goes to the heart of the question when you see Dollar Tree and Dollar General pitting against each other. Is this an execution question or is this a macro question?
It really is a macro question. There is no question that there's just a lot of uncertainty around what will ultimately happen with tariffs. It seems like we are headed toward a direction where this is ultimately a lot of political theater. However, the exception to that is that there will be permanent repercussions in China, with China and with U.S.-Chinese trade, and a significant part of the discretionary items that both Dollar Tree and Dollar General sell are imported from the Far East, and those are definitely going to go up. Dollar Tree already has raised prices on a lot of goods, and it sounds like they are expecting that there will be more of that in the back half of this year.
Is there some sense, though, that maybe they can make up for some of that gap with an increase in sales itself? There's been a lot of talk about the trade down that we've seen from some consumers. I know that hasn't directly, or I guess in wholesale, benefited the dollar stores in the same way that it, say, benefited Walmart. But I'm curious if there is a case to be made for that.
For sure, there is a lot of ability for everybody in the mass merchandise sector to pick up share from other retailers. You do have sectors like sporting goods and apparel, which are doing very, very soft. So where are people spending instead? They are going to the dollar channel, they're going to mass merchants like Walmart, and they are going to the club channel like Costco. So Dollar Tree is absolutely a beneficiary of that, and they will make up some volume, but the question is in which categories. It's most likely going to be in those essential goods. It'll be household goods, consumables, less in things like party items, seasonal items, which do tend to be discretionary and which are going to be very, very vulnerable to the tariff impact.
I'm curious what this means for a company like Five Below, which reports earnings after the bell. And I mean, obviously not everything there is Five Below, but I do want to point out, Sucharita, they do have quite possibly the best assortment of Haribo gummy bears on the face of the earth. So there's that. They've got that going for them. But in terms of dealing with their inventory, their supply chain, and the tariffs, are they in the same boat as the rest?
They are essentially, Five Below has become a small format toy store. And so it is, I would say that it is basically the discretionary items at Dollar Tree just expanded into the entire store. So even though the company has outperformed the market year to date, I am very nervous for them. I think that a lot of the same headwinds that other sectors, that other companies in discretionary sectors are facing, Five Below is absolutely going to be facing as well. They do not have the essential goods that Dollar Tree has. The most consumable items they tend to have are candy, which are very, very discretionary. Mm-hmm. So I think that the tariff situation is actually more of a challenge for Five Below than it is for the Dollar Channel.
So how do you see the demand from the retail client? So just the consumer coming in. I mean, you mentioned prices are increasing. Can they handle those price increases, or are these price increases too much? And is that going to erode margins, do you think, further?
We are hearing that there are actually quite a few suppliers overseas that are picking up some of the price increases. We are hearing the merchants pick up some, but there are absolutely price increases that are being passed on to shoppers. We see that in, again, those sectors like apparel. You're seeing it in footwear. You see it in many of these higher ticket discretionary goods that may be targeting higher income consumers. So that's absolutely where we're seeing it. Now, the interesting irony of that is that it is likely the inelastic goods, so a lot of the essentials that could probably bear the biggest price increases, but that's not where we've necessarily seen the price increases yet. But I expect that many of the grocers, the mass merchants, will likely pass on price increases toward the back half of this year, much like they did during the pandemic. And then we risk triggering inflation issues. Inflation seems to be under control right now, but I think that's the big question mark for the economy, because if inflation goes up again, many of our concerns are back on the table.
So I think that's pretty interesting, right? Because this has been the big debate so far in the economy. Who bears the price of the tariffs? Is it the companies, or is it the actual consumer? And actually what we're seeing is that it's kind of a split. It may not be an even 50-50 split. It really depends on the item, if it's a consumer discretionary or if it's an essential item. But in terms of how you see this progressing out going forward, if we just roll the clock forward and let's say we get some normal tariff rate that sort of comes through, does this have a long-lasting impact, or are we just going to look back at 2025 as sort of a one-off minor price shock and we just continue to carry on our way?
I do think that if the global tariff rate ends up being in the 10% range, it is going to be that latter scenario that you described, which is that there is that shock. And I do think that economists, even in the White House, believe that it will basically reset expectations, but then you sort of revert back to the mean. And that is, I think, ultimately the hope. The hope also of many of these negotiating tactics are that these other regions of the world, these other markets with whom we do trade, will somehow be able to find dollars, or they're able to pony up some support for the United States to either reduce our debt or do something that helps the U.S. economically, even if it is not paying tariffs.
It's super informative.
Yeah, Sucharita Kodalia, always wonderful to get your view of Forrester. Really appreciate that. Do want to bring this to you. The ADP number came out, and we have some truthing. We have President Trump out on Truth Social saying the ADP number is out. Too late, Powell must lower the rate. He is unbelievable. Europe has lowered 9 times. Just expect this drumbeat to continue anytime there is some negative economic data.
Yeah, I'm trying to find the 9 times. I know that Europe has lowered significantly, but it gets to this idea here as to what a rate cut would actually do right now in this particular moment. I mean, I understand why the president is doing this jawboning, but even if Powell came out at the meeting, when I think they meet next week, right? Next Wednesday. I mean, what exactly would that do in the short term?
So, I mean, I think Powell is not going to just jump out and cut interest rates at this point. We can't compare the U.S. to Europe. Europe is in a very different situation, different inflation dynamics, different labor dynamics that are taking place there. I think this is kind of an easy, I'd say it's more of a naive observation to compare the ECB to the Fed at this point. So I just think this is jawboning. I don't really see much.
So you just went out there and called the president naive.
2 weeks.
About, no, I'm kidding. I'm just playing. I'm just playing around. Coming up, we've got Kathy Bostancic of Nationwide Mutual Insurance looking ahead to Friday's payrolls report. As we do get this ADP report, and Jim was making a very important point, which is that you're in a very different place when you look at Europe and you look at the United States. We'll be talking about that and much more.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Taking some heat out of the gains that we'd been seeing earlier this morning in futures right now, after that ADP payrolls report came in with a pretty significant downside surprise, you could see stocks actually now lower on the day, at least when it comes to the NASDAQ, down about a tenth, nothing hugely dramatic. But it's notable how different the momentum is heading into the open today than yesterday and the day before. It had been lower and then heading higher. Today it is higher and then heading lower, which is a bit of a departure. In the bond space, you do see yields lower across the board after that print, particularly on the long end. Again, giving some comfort to the idea that maybe duration will rally if there is negative economic news, 4.93% on the 30-year. And when you bleed it through the currency space, you do see the euro near session highs after that ADP report versus the dollar, heading toward 114 even right now. 1 hour away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Also moving lower are shares of Dollar Tree. They are down 2%. This is the latest company, the latest retailer to report, and they're warning second quarter profit could plunge up to 50%. That's because they say cost related to China tariffs and weaker consumers are weighing on margins. That overshadowing what were otherwise strong results because they say that like Dollar General, consumers are trading down to their stores. Dollar Tree saying they are seeing more customers with a household income of more than $100,000. Wow. Next up, we have shares of Hewlett-Packard Enterprise moving the other direction, and that is because the company said tariffs will hit profits less than expected. Shares are up 6.6%, and they're saying that AI demand continues to grow. It pulled in $1 billion in revenue related to AI, beating estimates, though still trailing their rival Dell Technologies. And we end with a check on NVIDIA, and the reason I want to highlight this company, even though it's just moving about 0.7%, is because it is now back on top, reclaiming the title as the world's most valuable public company as it pulled ahead of Microsoft yesterday. It has seen a torrid rally in the past month, up 25%, despite all those concerns around export controls and, of course, tariff pressures. Lisa?
Thank you so much, Yahaira. I wonder, Romaine, if Microsoft and NVIDIA have their market cap up each on different platforms and everyone cheers when they cross.
Yeah, they would tell you no, but I'm sure somebody must, right?
Somebody must. We do, evidently, and they probably watch with some curiosity. Meanwhile, more economic data and Fed speak on deck. Michael McKee back with us. After looking at that ADP data, I want to focus on that. What stands out as you parse through those numbers?
Well, really just the overall weakness, Lisa. 37,000 is not very many jobs created, and it is the lowest in just about 2 years. Now, the question is that because companies are just not hiring? It doesn't appear that we are seeing anybody getting fired. Tomorrow, we'll get the jobless claims numbers. They've been up a little bit, but sort of stuck in a range at this point. We haven't seen a real rise since last October when we had the one-time spike up to 259. and then immediately you can see it came back down again. So the jobless claims numbers aren't supporting the idea of real weakness in the economy yet, but we'll look again tomorrow. And then, of course, on Friday, how does ADP match up against the BLS and the May jobs numbers? We're looking at 130,000. That would be a drop from 177, but each month over the last couple, we've seen jobs come in higher than the forecast. Private payrolls were 167,000 last time, and ADP only said 60,000. So it isn't necessarily a good forecaster for what we're going to see on Friday. The Fed is going to look at all of these numbers and try to put them into context, and they're certainly not going to be moving interest rates in June. So they're curiosities. There's something to watch. Something to try to model, but nothing that is going to move the needle for interest rates.
So we can expect to hear more wait and see. Michael McKee, thank you so much. Joining us now, Kathy Bastiancic of Nationwide Mutual Insurance. Kathy, I just want to pick up on what Mike was talking about, that, yeah, these ADP numbers and necessarily whether it does or doesn't mean for on Friday, the non-farm payrolls report, put that aside. Right now, it doesn't seem like anything can shake where the Fed's approach is, which is to remain on hold.
Yeah, good morning, Lisa. Yeah, they're in wait and see mode. It's just all the uncertainty of policy, and most importantly, how the policy changes affect the real economy. There's still a debate about that. You know, on the tariffs, how much of the increased tariff, taxes passed on to the consumer versus eaten by some of the importers, and then if it is absorbed by companies here in the U.S. importing, then that means they may have to offset costs, and then you look to payrolls, right? So, but if it's not, then prices go up. So that's where the Fed's dilemma is. How much are things moving away from the dual mandate on both sides, employment and